Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Football Tech, where soccer and technology meet the power of Bitcoin to transform the future of vulnerable communities. This is what Bitcoin philanthropy looks like. Soccer, technology, and Bitcoin. Join the mission. Help change the game at footballtech.org/Bitcoin.
We're Giga, a Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies, while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin. And the future is what we're building. Discover what we're building next.
There's a huge opportunity in digital assets today. We are now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current megatrend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy a dollar's worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims, so that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital.
Debt is exploding. Bond yields are rising. Trust is eroding. But this isn't only about risks. A rare strategic opportunity is opening. Bitcoin is changing the game. And for the first time in decades, financial strategy is exciting again. Microstrategy blazed the first trail, but each company's pathway is unique. While traditional consultants ignore Bitcoin's potential, Orange Wheel helps forward-thinking leaders see the opportunity and act on it. Orange Wheel, strategic guidance through the monetary transition.
Your competitors just pulled ahead? While you held cash, more than 140 companies moved $104 billion into Bitcoin. Strategy made 257%. Tesla gained billions. Your cash? Lost 3% to inflation. The Satoshi Institute trains Fortune 500s to build Bitcoin treasuries safely. Master risk compliance and execution with expert-led simulations. Don't fall behind? Visit satoshiinstitute.com. Lead, don't chase.
Activating Bitcoin yield can feel like facing a mountain of risks and decisions. At Zonaris, we cut through them with precision and expertise. Capital needs guidance, clarity, control, direction. We unify strategies into one institutional interface, built for exactness. Idle Bitcoin becomes activated, merged into a network of opportunity. Zonaris delivers security and self-custody as foundational infrastructure for institutional-grade integrity. In a landscape of uncertainty, the future belongs to those prepared, ready to act, ready to scale. Zonaris, for institutions who demand yield without compromise.
How are the glasses? Do they look totally smudged?
No. Tell me about your creative process.
The creative process involves responding to emails and text messages and then editing those text messages so that they don't look ridiculous. That's basically every day.
Do you ever get rejected?
No. Chris, are you available for an interview this week? No? Are you available to come into the studio for an interview this week? No?
So every time you ask somebody to be on the show, though?
I don't ask people. I just reply to inbound. Elliot, Tim, how are you? Like 5-minute interview? No? No. Let me know when you're back. Check back next year. You don't like my face.
So people come to you?
Yeah, but they get rejected. One person I would love to have on the show would be the Backstreet Boys, Jim Chanos, Roseanne O'Donnell, Ozzy Osbourne, Ninja Turtles, Michelangelo, Donatello, Raphael. Putting on the orange tie has got to be something like what Superman feels when it's just Clark Kent jumping into a phone booth. And then he has laser beams and he's flying around, but like more. So you just feel that you don't need to answer to anyone? I want to hear the truth. You don't think you're responsible to anyone, but you're responsible to the shareholders. I mean, maybe you've heard of them. I demand answers. The shareholders deserve answers, and the viewers want answers. So if you could just answer, no, don't get out of the chair. Nope, the interview's not over. Don't get out of the chair. Can you please answer the question? From the time I step in the office, it's literally nonstop, go, go, go. It's emails, phone calls, it's moving, it's grooving, it's grinding, it's shake and bake. We're wheeling, we're dealing, we're doing deals. We're texting deals, we're DMing deals, we're docu-signing deals, we're calendar hustlers. We're hustling calendars. It's just WIN all the time.
If you think you can win, come on, man.
This video may be amazing, but it is not financial advice.
Tim Kotzman, Ed Julien, and Adrian Pruitt present Thank you to all of our sponsors. The Bitcoin Treasuries Unconference starts now.
Front of house audio. We're live in New York. Hi, everybody. Ed Julene. Adrian.
Tim Kotzman.
A couple of guys in orange ties.
Holy crap. 6 weeks ago, Tim called me and he's like, hey, I think I'm
Hello.
some help.
Is Ed available?
And then the next morning, we get this DM from Saylor on X saying, I'm going to be at your event. And we had to think about it. We said, we got Gladiator.
Yeah.
Well,
I don't know if he's actually here, right?
Yeah, of course not. But awesome. Thank you all for coming. This was a 6-week sprint. We did some things very differently, as you can tell. If any of you are feeling congested back there, you feel tight, it'll help the live stream if we can fill these tables back here, because right now it looks like nobody's here. So if you feel like you're a little, those tables back there will be fine. Thank you for that. We did this differently because we thought people were getting a little bit of panel fatigue, a little bit of presentation fatigue, and we said, let's do something more like what Fred did out in Santa Monica, kind of an unconference format. And we even did the agenda where we had people vote on it and then found the best speakers for that agenda. This is going to be 30-minute sessions, except for Saylor's keynote, where you get 15 minutes of the 3 thought leaders speaking, and then 15 minutes we'll take the mic into the audience. We'll give you some more details on that in a second. Should we go through our 10 rules, which is now 12?
10 rules, and quick shout out to Adrian Pruitt. He is obviously not on stage because he's literally directing the entire show. It would be great if he just appeared on stage and we could do the, what was that movie where it's like, if you're in the back of the van, who's driving? It's on cruise control.
It's him. He'll be up here eventually. He hears us. Okay, we'll get him in a second.
All right.
Okay, I got number 1.
Rule number 1, go ahead.
Okay, hey, no laptops on these tables. Not so much because it's a distraction, but because we have about 11 cameras out here in 4K, and people will get your passwords off of those cameras. So no laptops, please. Keep them closed. If you want to get on your laptop, go into the back of the room or somewhere else. Thank you. Thank you for filling up. It makes it look like somebody showed up. Number 2.
Quiet in the lobby?
Yeah, they changed that from drapes to walls. But
which is awesome. Thank you, Levon.
Yeah, there's going to be people out there with a stick. They will beat you if you're too loud. So please stay in the room. I think you're all going to stay in the room. This is going to be 7.5 hours sprint.
Or Ed, we'll take the gong out there and gong you.
I'll take the gong, which is actually number 3.
Oh, wow. What a setup. Segue.
The gong. So our thought leaders have 5 minutes, right? When they get close to that 5 minutes, they'll see it on the clock. But then we've got a gong, which means you have 10 seconds until audio cuts off your mic. If we bring the mic out to you and you're going to ask a question or tell us about your life story or you just talk a lot, grain of salt, then we are going to...
Who's that?
Then we will hit the gong, and that means you have 10 seconds till
Jeff
your mic...
Walton loves the gong. Jeff and Ben love the gong.
It will cut you off, no joke. So, and then, which takes us to number... Hold on, let's jump around here. Number 4.
Oh. If you're upset because we don't call on you, please call your mother or wife.
Yes. This is not democratic.
Or whoever your person is.
This is not like fair. This is not decentralized. This is us curating an event, so we kind of know who we're going to bring the mic to. Just deal with it, okay? Don't get upset.
I don't know who I'm going to bring the mic to.
I know. Number 5, if you're going to heckle, if you're going to yell stuff out, make sure it's loud enough we pick it up on the live stream, okay? So really get it out there.
Be loud, be proud.
Yeah, because if the speaker goes, hey, what was that? And they don't hear the heckle, it doesn't really count. So make sure that if it's interactive and you're playing, play good.
How many rules are there? 10, 11, 12?
There's 10, but there's 11 of them. We're almost there. 6.
Oh, bathrooms. It just says bathrooms.
Oh, yeah.
There are bathrooms, right?
Yeah, back through that curtain. We had to put the curtain because of the lighting, so usually there's a big sign there that says restrooms. There are restrooms. There's one out in the lobby. We just needed to let you know. I gave you the boring ones. Number 7, Chardonnay. Chardonnay, come back up.
If
Chardonnay.
you are a speaker
Chardonnay.
or a host.
If you like drinking Chardonnay. She has a couple bottles back. No, that's her name, actually. Chardonnay is for speakers or hosts or whatever. 15 minutes before your time, you need to get back there with her.
And if you have no idea what time you are speaking or hosting or doing something, go talk to Chardonnay.
Yeah.
She's going to have the information.
And read your email, for Christ's sake. Okay, number 8.
8, sponsors Sharon.
Oh. If you're a sponsor, we're Sharon. Sharon. It's like this big, bright orange dress. She's not in the room?
Yep. So what is Sharon doing today?
Sharon is in charge of our connections team, so we have a group of people. It's not as organized as well as I thought, but Sharon will come back and we'll flag her down. But Sharon's the one that's going to help you find the people you want, which we should go on. Let me skip 1 to 11 on colors. We got this cool plan to do these colors on these lanyards, but we didn't really explain it. So orange is a treasury company. Look around. If you see someone with an orange lanyard, they're a treasury company.
Bitcoin treasury companies.
Yeah. If you're yellow, you are a service provider. Oh, please, I should have written these down. Is that correct? Yeah. Yeah, yellow service provider. Green is other staff media, and purple is investor. Does that all make sense? Yeah. Okay, so as you're looking around of who you need to talk to, if you're a service provider, you probably don't need to be talking to the investors. You want to talk to the orange. You want to talk to the treasury companies. You're a treasury company. You want to talk to the investors. Okay, so that's how we did it. That should shorten it. And then don't be afraid to tell someone to flip over their name tag. We tried to get the double clips. It didn't work. Okay, so you're on number
10?
Yeah, I think so. Sure.
Success. What does success look like?
Let me do that one last.
Okay.
What do you got?
I'm out. I got
number 9.
Oh. Please repost the stream.
Yeah, if you can go on your phone right now. Let's do this together. Let's just break down X. Get on your phone, go to Tim Kotzman's. I think that's our next guy.
Phone call? Is it Saylor?
Yeah, go to your X right now. Go to YouTube. Look up Tim Kotzman. Repost it. Let's get this thing rolling.
It's
We're
on
expecting
YouTube,
about
but X is
150,000.
probably the best thing to repost.
Yep, and then let me make sure 1, 2, 3, 4, 5, 6, success, colors. Okay, so success. When we thought about how will this be successful. If any of you come up to me afterwards and says, wow, that was the most amazing event, never been to anything like it, I'll say, yeah, I know. We did it that way. What will be real success is if the sponsors come up afterwards and say, we want to go bigger next time. So just keep that in the back of your mind. That'll really work for us because we'll get a bigger venue, you'll get more people, we'll have it just be much more magical.
With that in mind, thank you to all of the sponsors.
Wonderful
What
sponsors.
a list.
Yeah.
Thank you to everyone in the live studio audience. Thank you to everyone on the live stream for tuning in. Thank you for all the support. It's been incredible.
Incredible 6 weeks. Fantastic. Unless we have a surprise from backstage, I don't think our intro showed up, which is fine. We'll deal with it.
You want to introduce?
Nah, you do it.
Ladies and gentlemen, please welcome to the stage, Michael Saylor.
I'm streaming it. Oh, yeah.
I'll be watching it back here.
Yeah, exactly. Backstage.
To the stage, please welcome to the stage, Michael Saylor. Michael, thanks for being here.
Thank you. Nice to see all the orange ties and the orange hats and the orange tennis shoes and the orange shirts and the orange lanyards and the orange dresses. I definitely envy the women that can wear the bright orange dresses and the orange jumpsuits. I've been trying to figure out how to do an all-orange suit that'll work for me. I'm still working on it, but get ready. So I'd like to talk about Bitcoin treasury companies, and I wanted to lay out, the basic principles. There's a lot of ignorant antagonists in the world, and they're like all snivelly, like, why would you want to buy a Bitcoin treasury company when you could buy the Bitcoin? And you hear that a lot. I mean, we're the first year, in my opinion, this is the first year in the launch of this business. If you got in more than 12 months ago, you were sort of ahead of ground zero. I would say the business really legitimized, took off November 5th, 2024. That's the point when you had the red sweep. That's the point when Bitcoin went from 60,000 to 95,000. Very quickly, what we saw was 12 cabinet members flipped pro-Bitcoin. The president flipped pro-Bitcoin. The Secretary of Treasury flipped pro-Bitcoin. And guidance from the SEC, the CFTC, the OCC, the FDIC, even the Federal Reserve and the Treasury, all flipped to unequivocally pro-Bitcoin. If you look at crypto policies with the mega banks, you know, the too big to fail banks, Bank of America, Citigroup, Wells Fargo, et cetera, they were constructed over the previous 4 years. In that environment, after the execution of Signature Bank and Silvergate, both of those were healthy banks that were destroyed by the previous administration due to their involvement in crypto. I think most large systemically important banks, most banks in general, adopted a policy out of an abundance of caution, and the result of those policies was so vague, it kind of meant that everyone in the industry was unbanked, you couldn't get credit, and those policies still remain, by the way. You could post $10 billion of collateral to those banks, you can't get a nickel loan today. Okay, so that's not because of government guidance. The government guidance is exactly the opposite over and over and over again. But the banking system of the Western world is uncramping itself, and it'll probably take 4 years for that to happen. And during that time frame, we're just in this epic of institutional adoption. You've got the right accounting, you've got the right guidance, you've got the right law, you've got the right tone at the top. And that just means large, risk-averse, bureaucratic organizations are going to take their time to work through it. But it's not like every single week I don't have a conversation with the president or the CEO of a bank or some other large financial organization where I point out that they're about to miss out on trillions of dollars of opportunities. And this is why the private bank, the commercial bank, the investment bank should get involved. If you have I couldn't have those conversations 4 years ago. Now we're going to have those conversations every day for the next 4 years. We're going to convince 10%, 20%. And so we're in this transition. I think there's two massive forces in the world today. There's digital intelligence, there's digital assets. And if you look at financial institutions around the world, what's amusing to me is you've got financial institutions that embrace digital intelligence, like my company. I sit down on a Saturday afternoon, I play with the AI, I design a security, I redesign the security, I design the security for the third time. The AI says it's never been done in the history of the world. I send it to the lawyers, they say it's never been done in the history of the world. I send it to the bankers, they say it's never been done in the history of the world. And then they come up with one little quibbling concern like, there might be a fast pay issue and it's unsolvable. And then after 2-3 weeks of tradition, I go back to my AI and I say, is there a solution to the fast pay issue? And it says, yeah, make the liquidation preference floating. Okay, where's the floating liquidation preference come from in our prefs? It's because there's a fast pay issue in the prefs and you can't sell them above par without that floating liquidation preference. I could hire 10,000 lawyers and wait 10,000 years. I wouldn't get the answer. I got the answer in a few minutes from the AI because the AI has no prejudice. It has no inertia. Okay, that's a finance company that uses digital intelligence. What happens next is we print $6 billion of those. What happens without AI? We sell zero. Everyone says, well, what's the killer use case of AI? Well, maybe design a security and sell billions of dollars a month of it. That might. How many people do that? One. I'm sitting at a table with a lawyer that works for a mega multi-trillion-dollar financial organization. I said, do you use AI? No, our legal department won't let us use AI for security concerns. They don't want us to put confidential information into the AI. Okay. You literally have a set of megacorps that won't use digital intelligence for security concerns, and they basically make everybody that works for the company slow and stupid. And then you have another set of companies that use AI, and those people are smart and fast. Now, if you take digital assets, it's the same thing. Those, a different set of banks, they're like, well, we don't touch digital assets, because the government, because something happened 4 years ago. Well, what I would say is poor and weak. And if you embrace digital assets, you become wealthy and powerful. And so, by the way, I can show you finance organizations that embrace digital assets, reject AI. I can show you ones that claim they use AI, but they really reject it. They just tell themselves they use it, and maybe they do or do not embrace digital. But, I think the opportunity for Bitcoin treasury companies, what are they? They're digital companies using digital capital, hopefully using digital intelligence to create digital securities, digital equities, digital credit instruments to sell into the digital economy. Nothing that we've done would have worked without digital capital. Bitcoin is digital capital. And most of our more compelling ideas came from digital intelligence because no one ever did that before. When we designed our prefs, we set them as par value 100, made them perpetual. No one ever does that. You can find 5,000 examples in the modern world where people don't do it. They normally make retail prefs $25 or they make institutional prefs $1,000. Okay, turns out if you go back and read the history of the Rothschilds and the history of money, the British government in the 1780s did it. The British government issued consols. They were perpetual bonds, par value 100 pounds, yielding 3 or 5% that floated above or below par. And I look, backed by gold. We created something, 100 par value, perpetual, backed by digital gold. Okay, and so what happened in the middle? For 100 years, the world went backwards. And now we rederive these elegant instruments that, by the way, every French, Austrian, British, Spanish, Italian central banker, they used the same instruments 300 years ago. In fact, the entire world ran on gold-backed credit for 300 years or more. That was the currency system of the world until 1971, with varying degrees of collateralization. So we're in year one of reinventing the finance system, issuing digital securities and digital credit on digital capital, and we can do it into digital channels. And right now, there are digital channels like the NASDAQ or other standard securities markets, but in time, there'll be the crypto ecosystem, 24/7, 365, tokenized, self-custodied. Your securities will be self-custodied, your credit instruments will be self-custodied. They'll all trade everywhere in the world at the speed of light. Now, let me talk a little bit about, treasury theory. Bitcoin treasury company, what's revolutionary? Well, Bitcoin, digital gold, we all acknowledge digital gold. Okay, digital gold, digital capital, better than gold, right? Capital, economic wealth that lasts forever. You buy 1/21 millionth of all the money in the world forever, right? That's the idea of digital capital. That's a powerful idea. Pure economic energy. Outperforms the cost of capital because it's pure economic energy. When's the last time the human race agreed on something that was pure economic energy? Well, it was gold for 5,000 years. And now we're starting to re-agree. 5% of the world is starting to re-agree that we've got a new form of capital. Instead of metallic capital, which is what gold was, we've now got digital capital. If you've got a digital capital asset that outperforms the S&P, right, you can capitalize a public company on it. That means you become positively polarized to capital. That means that the more securities you sell, the more shareholder value you create, the more capital you can raise. And for the last 100 years, the entire world was capitalized on sovereign debt or fiat credit instruments. They underperform, therefore they're negatively polarized to capital. So there's a profound idea here, a paradigm shift. If people don't get it, right? They're a strategic incompetence, right? A lot of people don't want to get it. If you're just a cynical, curmudgeon-y, short seller, short-sighted trader, you don't want to understand. You just want to hate on it, so you're not going to. But once you embrace the idea that Bitcoin is digital capital, then the next issue is, well, what is Treasury company? Well, Treasury company is just a new kind of corporation, literally impossible in the world where public companies are capitalized on fiat credit. It doesn't make sense to sell equity to buy back sovereign debt because the equity cost of capital is above 14%. The sovereign debt has an after-tax yield of 3%, 2%, 1%. Doesn't make any sense. Doesn't make sense to issue corporate credit to buy back fiat or sovereign debt either, right? Makes no sense. What does make sense? Well, issue securities backed by digital capital. I'd like to say we understood this business 5 years ago. We didn't, right? Our entree into Bitcoin was first defensive, then it was opportunistic, then it was strategic, and finally it became transformational. Then we realized we're a different company. So what is the basic premise of a treasury company? Well, it's very simple. You have a block of digital capital, raw digital energy. Here, it's commodity. The world doesn't want it. What the world wants is a set of securities, either credit instruments or equity instruments or derivatives that meet their requirements. The analogy I've used before is Standard Oil. Think of a refinery. I have a block of raw liquid energy. Einstein said matter and energy, they're interchangeable. I have raw liquid energy in the form of a barrel of crude oil. The first application was kerosene. Kerosene is jet fuel. Kerosene lights up your house. Kerosene was light. Kerosene is rocket fuel. You can't light up your house with a barrel of crude oil. You can't fly a jet with a barrel of crude oil. So we needed kerosene. We refine it. We mark it up. But there's gasoline, there's diesel, there's asphalt. And then if you actually go on an AI and say, tell me all the specialty chemicals of crude oil. There's also lycra, there's also acrylic, there's also plexiglass, there's PVC piping, your lubricants, you know, every form of plastic, stuff you eat, nylon, polyester, right? It goes on and on. We build the houses, we turn the machines, you know, we look through these things, and they're all products, right? So I can refine it to be a different form of energy, whether it's kerosene or gasoline or diesel, or I can create lycra, or I can create plexiglass, right? And so products, services, forms of energy come from that barrel of crude oil. How big is that? Well, I mean, just think about, at some point, Standard Oil also owned half the gas stations. So you've got gas stations, you've got every type of energy, and then you've got DuPont, and you've got everything that every chemical company ever created. And look at the stuff you're wearing, probably. You're wearing stuff that came out of a barrel of crude oil, right? It's the stuff that's in your tennis shoes, right? So it's not a difficult stretch to say, oh yeah, in the first year when John D. Rockefeller, maybe 1865, when he started screwing around with a barrel of crude oil and out came some kerosene, a lot of haters said, well, there's no future to this industry, right? And of course, the industry today is, what, a third of everything. Now let's take that digital energy. What is the role of Bitcoin? You know, we say Bitcoin miners, they recycle stranded electricity or stranded energy. Well, Bitcoin treasury companies recycle stranded capital. Okay, more than half the capital, 2/3 of the capital is locked up in structured institutions right now. It's capital sitting in a bank, in a pension fund, an insurance fund, in a retirement account, in an institutional investment fund, in an index fund, in a money market fund, right? They're all locked up, the great majority of this capital. And they're in certain places. So what do they want? Well, you know, the insurance companies and the pension funds, they want long duration yield, right? That's what they want. The money markets, they want this very short duration liquidity credit spread. Everybody wants something different. The equity investors want leverage on some underlying business model. The derivative investors want that. Now, if you think about, think about the process of creating a piece of digital credit. What I think in my mind is, this is a block of plexiglass, or this is a block of acrylic. Just think like a big block of plastic that's a meter by a meter by a meter. And then I have a CAD/CAM system and a computer-generated machining, or a machine that's computer controlled, so I can operate the lathe and I can chip out anything I want from that block of plastic. So I put in whatever my image is, I unleash the computerized machine, and I get out some beautiful sculpture, right? Not quite 3D printing, but something like that. I'm converting a block of raw material into something, a beautiful work of art. And of course, what does the person want to see? How many different types of sculptures? There's infinite types of sculptures, and they're all just coming from a single block of some kind of acrylic or plastic. Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are what's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual? What kind of yield does it give me? What's the yield curve? Is it high duration yield? Here's the magic trick, right? You're a Japanese company. You want to create 5% yen, 5% yield in yen forever. How do I create that, right? Is there a market for that? Yes, there's like trillions of dollars of money markets in yen that get 50 basis points. So if I can carve out 500 basis points and I create this currency, I'm going to take the currency risk of the yen. I'm going to create this yield. I'm going to actually create duration forever. And what's the collateralization? Do you want 10 over collateralized, or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument, and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit. Or I can collateralize it 2-for-1. I can create sub-junk yield, right? And I can give you a different instrument. So when it comes to credit, you've got all sorts of investors. The Russians don't want US credit. The Chinese don't want US credit. The Japanese don't want US credit. The Canadians, the Europeans, they don't want to take credit. They don't take currency risk. So you can create a credit instrument, if you're a Bitcoin treasury company, in any currency, with any degree of duration, with any degree of collateralization, with any degree of volatility. I talked to a guy probably richer than everybody in this room, and he's got a bit of Bitcoin, and someone says, well, why do you only have like 1-2% of your portfolio in Bitcoin? He says, well, frankly, I'm like something years old, and I can't handle the vol. Okay, 75-year-old, 80-year-old guy with a lot of money, he just doesn't want a 50 vol, 50 ARR instrument that you have to hold for, if you call it indefinite duration, in theory it's 120 months. So if you're willing to hold this thing for 10 years, somewhere between 120 and 240 months, I'm pretty confident you get yourself like 30% a year ARR. But when you're 92 years old, who wants to actually hold something for the next 25 years? They don't want it. And so there are a lot of people, there are very wealthy pockets, and they can't stand the duration. They can't handle the volatility. Another example of people can't take the vol, corporate treasurer. You've got a Bitcoin company, you believe in Bitcoin, but you got to make payroll, and you need to make your rent. And so you have working capital. You know, conventional wisdom is keep 1 year of working capital into the currency that your liabilities are denominated in. That's your treasury. You're not going to put that in Bitcoin. You're going to put that in, right now you're going to put it in a money market. And in the US, it'll give you about 3% after tax. But in Japan, it's going to give you 25 basis points after tax. In Switzerland, it's going to give you minus 50 basis points. The entire yield curve in Switzerland is negative out to 4 years. In Europe, it's going to be 200 basis points, maybe. So you've got how much? 30, 40, 50 trillion dollars tied up in treasury instruments and money markets and the like between Japan, Europe, Switzerland, Canada, the US. 30 trillion in the US alone. They can't stand the vol. They want you to strip the vol. They want you to strip the interest or the yield duration off the instrument. Just give them pure spread. So what is the closest thing to kerosene that we can produce in this industry? It's basically pure yield. Something like we created with Stretch, it's like if you can just strip away the current, you know, I live in Japan and I like the 400 basis point treasury, but I can't stand the US dollar risk. I can't stand the currency risk. Strip away the currency risk, strip away the duration risk, strip away the volatility, strip away the credit risk, give me liquidity, right? Serve it up to me in some sort of credit instrument. And, you know, what? Take Metaplanet. They're sitting on billions of dollars of Bitcoin. If they can open up the credit side of that trade and they can sell Meta yield at 5 or 6% in JPY, they'll be arbitraging 50% US dollar ARR versus 5% in the yen, and they capture the 45% spread, right? Which is, to say they're getting 90% of the economic gain is an understatement. They're getting 100% of the economic gain up front. They're getting 90% in the first increment, compounding exponentially. So when you set up that instrument, you're getting like 95% of the economics, right? And so when you think about what is the opportunity here, everywhere in the world, you need treasury companies. Why? Because you're creating the high-quality credit. And what credit? Well, you can create that pure yield product, and you can sell it direct retail, go to the retail, like sort of we're doing. You could also create that product and partner with the largest bank in Switzerland, and you could power their treasury. You know, well, B of A is running treasury for $1 trillion or something. So what if you actually power the treasury of another bank and you become a B2B player? So a company could pursue a strategy where they create the yield and they create the return or the credit instrument, but they sell it through a bank. Well, how many banks are there? 25,000 banks. There's 25,000 people to sell it to. Well, what else? Insurance companies and annuity companies. There's companies that have, you know, hundreds of billions of dollars, and they're on the hook for annuities. Open up a pipe to the annuity company or the pension fund, and you just sell the yield directly through. You could do that as well. Also, the insurance business, right? And so when I look at this, people go, well, you know, how much room is there for Bitcoin treasury companies? That's like, you know, some dude says, why would you want to buy a hamburger on the Upper East Side for $40 when I'll sell you a hamburger for $3 in Kansas? Well, because I don't live in Kansas. That's not, okay, well, so I guess there's room for one restaurant in New York. Well, what about the people downtown? What about the people who live in Tokyo that want to eat, right? The truth is there's a lot of room for restaurants. There's a lot of room for, how many banks? 5,000 banks in the US. There are 25,000 banks in the US 80 years ago or 100 years ago. So 100 years after they're obsolete, there's still 5,000 of them, right? There will be thousands and thousands of treasury companies. Just like there's thousands of insurance companies, thousands of funds, thousands of banks. And why will they exist? They will exist because the risk-free fiat credit rate is 50 basis points in Japan and minus 50 basis points in Switzerland and 200 basis points in Europe and 400 basis points in the US, going to 300 basis points soon. And the world wants 10%. Right? And who wants 10%? Everybody. Okay, so the real issue is, how are you going to wrap it? How are you going to construct it? I want it to run on my rails. You know, you can buy Stretch on NASDAQ brokerage, but you can't buy Stretch on Robinhood. Okay? How do you get the security to go down the rail? It's kind of like, yeah, I got a hamburger, it's $3, but how do I buy it in London when the hamburger is getting served up in San Francisco? The distribution matters, the container matters, the compliance matters. The marketing matters, right? I mean, do they like you? Do they trust you? So, you know, when I think about Bitcoin treasury companies, I'm like, well, do you have the management team? Do you have a strategy? There's 1,000 strategies, 1,000 ways to do this. Do you have a focus? Do you have a capital market, right? Orange BTC is coming public in Brazil. They'll be the first company that's where the capital structure has been designed to be elastic to support ATMs and the like in that capital market. So constructing the company with the strategy in the right capital market is important. But you know, it goes without saying there's going to be a monster treasury company in every capital market. It won't be us in Japan. It'll be Metaplanet, most likely. Right? There'll be a monster in every capital market, but that doesn't mean there isn't room for 100 other very successful companies in every major capital market. You ask the question, how much capital is there? How much financial repression is there? Right? And yeah, I'm not going to go and issue credit instruments in Turkey because the rate's like 46% or something. I'm not going to go there first. I'm going to go and issue credit instruments, you know, where a 10% seems like a screaming home run, and 10% against a 30% ARR over 20 years, it works out to about 90% of the economics go to the issuer. And then it just comes down to a question of how you're going to construct the credit. And there's stupid credit, and there's difficult credit, and I guess I'd say there's a simple rule of thumb here. If some guy with $1 billion is sitting across the table at you, offering to give you the money, it's probably in their interest, not yours. You know, if I wanted to sell a $1 billion note that had the warrants of equity, that had the credit protections of a bond, and do it with a single counterparty, I would have 25 companies staying up all night to do that deal, and it would be done tomorrow morning or the next day. It would be awful for my equity investors. It would be bad for my capital structure, but there's a certain amount of money that'll come to you that's easy to get, that's just not necessarily good for you. And then there's the money that you have to work at, like I'm going to build a retail channel to 10 million retail customers and sell them a preferred instrument without the credit risk, which has got huge amplification for the equity. That's harder. It's hard to do the things that are they're going to create massive shareholder value for your company. It's easy to get big and do things that basically transfer your equity and your credit collateral to a investor. So I would just say the business is going to explode. There's going to be 1,000 ways to win. We're in year one. Don't listen to the critics and the whiners. Think about the critics of the petroleum industry in 1866 and put yourself in the place of the entrepreneurs and ask yourself, would you get dejected when the price of crude oil traded down 35% and people told you it's a crap business? Because that's exactly what happened to Rockefeller, and what distinguished him is he just always believed that it was going to work, and when everybody else was selling, he was buying, and when they were buying, he was buying. And when everybody was whining, he was building. And when everybody said, you know, in 1909 or whatever, when the entire industry was mature, right, that's when the automobile got invented, and it got 10 times bigger. So this thing is going to be big. There's no reason that credit, digital credit, the credit on gold became bigger than the gold supply. The digital credit may be bigger than the Bitcoin network. If Bitcoin goes to 100 trillion or 200 trillion, there could be 200 trillion of credit on top of it. You may not want to issue it. That's up to you. Someone will want to buy it. And that is the future that the market will determine. And the market is 100 industries, 100 capital markets. And your job as a Bitcoin treasury company, solve the problem, solve the compliance problem, solve the tax problem, solve the issuance problem, solve the credit problem, do the marketing, do the product design, solve the distribution problem, evangelize the future of digital capital and digital credit, and roll with the punches. Right? Don't get liquidated on volatility. Build the most robust structure you can. But otherwise, we are all, if the Bitcoin miners are the first line of electric defense or computational defense of the Bitcoin network, Bitcoin treasury companies are the first line of economic defense. They're the ones that are going to spread the entire ideology of digital capital, of perfect money. The guys that say, fix the money, fix the world, that's all well and good. But the truth of the matter is you didn't have to envisage that everything else disappears except perfect money. It's not going to happen. So a better thing to be thinking is, if I'm going to fix the money and fix the world, I need to fix the equity, fix the funds, fix the banks, fix the money markets. I need to fix the credit instruments. I need to fix the currencies. I need to fix the policies, fix the politics, fix the ideologies, fix the attitudes, fix the distribution, fix the technology. That's not happening just via tweeting. That's going to be a company in Japan, in Switzerland, in the UK, in the US, in Nigeria, in Brazil. They're the ones that are going to fix all that stuff. And as you create all of these digital, wonderful, beautiful instruments of the 21st century, you're going to win fans and supporters and believers in the political system, in the media, in the economic system, in traditional banking, in traditional finance. They will be brought over to the orange movement, and then they'll start to believe in Bitcoin. But at the end of the day, just don't fall into the trap of thinking that all the world needs is Bitcoin. It doesn't just need Bitcoin. It needs equities and credit, and it needs currencies, and it needs governments, and it needs companies, and it needs funds, and it needs services, and it needs products. And it's companies that are going to create these, and it's hopefully the people in this room today. So thank you for coming, and thank you for being part of this movement. And I look forward to hearing each and every one of your stories.
Check, check. Hey, don't go too far. We're coming right back here. We just got to put the chairs on stage. This thing is going to flow.
how it stands, right?
Okay. It's bizarre. All right.
All right.
Well, thank you, Michael Saylor, for being our opening act. We greatly appreciate the warm-up. The greatest hype man in crypto, folks.
Yeah, that was great. Well, my name is Moish Peltz. This is my law partner, Kyle Lawrence. We are co-chairs of the digital assets practice at the law firm of Falcon, Rappaport, and Berkman. And Michael was talking a bit about how he was opportunistic and then strategic about becoming a Bitcoin treasury company. And so I wanted to tell a story of how we accidentally became a Bitcoin treasury law firm, or at least a mini version of that. And if you roll back the clock to, let's call it 2021, we had a client that came to us and said, hey, I don't have a lot of cash, but I have a ton of Bitcoin. Can I pay you to do legal work for me? And we thought about it and we said, yeah, that makes good business sense. Let's figure out how to do that. So we put a lot of time and effort into making sure that we had a way to, in a compliant, ethical way, accept crypto for payments for our legal services. Figured it out, been doing that ever since. And then fast forward a little bit to 2022. And if you remember, Bitcoin had gone up to $44,000 and then dropped down to $19,000. And another client said, okay, I'm gonna pay a decent sized invoice, Bitcoin at $19,000. And then our merchant services provider said, oops, we messed up, there's too much volatility. We have your client's Bitcoin, what do you want us to do with it? And we said, so I went to my law partners and said, hey, we have $19,000 Bitcoin, I think we have to figure out how to keep this. And so starting then, that's what we did. Thankfully, my law partners accepted the idea. And yeah, so we've been, since then, really, our crypto client payments, we're trying to keep, we accept Bitcoin and other payments, but then roll them over into Bitcoin. And so the reason I bring up this story is because I think it gives a good example of how our practice group, our firm thinks about this, right? We're in it for the right reasons. We're invested in making sure we do it the right way for ourselves, and then we bring that same mindset to all of our client engagements.
Kind of fascinating to think back that you had to actually go to other people to ask if this was okay. I mean, just straw poll around here. You guys would just do that. You wouldn't ask permission, so. But thank you, Moish. Moish is a great steward of the firm, and we coach our digital assets practice group. We also co-host a podcast called Block and Order, which focuses on all the legal issues that face the world that we all live in every day. Emerging technologies, cryptocurrency, blockchain-based businesses, AI as well. And we use AI as part of our daily practice. We feel we're, I don't know about the forefront, but it's implemented into all of our document management system, all of our email. We embrace new technology. We're very entrepreneurial.
I couldn't believe that Michael was saying he's going to these mega law firms and they're saying, oh, no, we don't touch AI, sorry. But we hear that all the time.
All the time. Not only that, we also accept cryptocurrency as payment for legal services, and I don't understand thank you. Thank you, one guy.
And we keep it we keep it in Bitcoin, which is like, all right,
that's astonishing.
Yeah.
Here, if you want to pay me in Bitcoin, I will gladly accept it. I'm just throwing that out there. So what do we do on a day-to-day basis? Well, for Bitcoin treasury companies, it's kind of a three-pronged initial approach, and every situation is obviously unique, and we have a bespoke set of services for it. But you need to form an entity and structure it. Where do you do that? Delaware, Wyoming, Marshall Islands. I mean, how often do you hear those places named in the same sentence together? The world is literally your oyster, and it's important to understand what the regulatory environment is from jurisdiction to jurisdiction, how best to structure it, who are your partners, what are you doing with it, all these kinds of things that people just gloss over, and it's important to understand the differences. Number two, hey, you want to raise money to fund your Bitcoin treasury company? Would you like to raise money and keep it? I bet you would. I'm a securities attorney by trade. That's how I parlayed that into this industry that I'm in now. If you want to raise money, guess what? There's no friends and family exemption in the federal securities laws, folks. I don't know how to break it to you. Whoever told you that, they were lying to you. So raise the money and keep it, and then deploy that capital. And step three, success. You made it. You're all here. We're all rich. We can all retire, but it's not that easy. You want to cash out, you need to do some legacy planning, you need to have those funds safe and secure. We can help you set up custodial arrangements. We can help you plan for the future for your kids so they can have the benefit of these great investment decisions that you've made and everything that goes in between. So please feel free to talk to us. We're going to be roaming around the halls. We're also doing a webinar in a couple weeks where we get into real granular detail about these services that we provide. So please, we'll have the QR code somewhere that you can scan if you want to sign up.
Yeah, you can come up to us and we'll give it to you. But yeah, I was just speaking with someone right before our talk about the idea that if you, like Michael, believe Bitcoin's going to be $30 million, and then you have all this Bitcoin, that's a huge estate tax problem, but nobody's thinking about it. So we're doing having that conversation, working with people on that. Anyways, Moish, Kyle, we'll see you around all day. Feel free to come to us and ask questions, and thanks for having us.
Thanks, everyone. See you around.
I just want to remind everyone that there's also restrooms here in the back as well as one out in the lobby, just so you know. All right, Bitcoin Treasury Companies is not only the fastest growing area of value creation within Bitcoin, it also is within traditional finance. This is the most profitable business and industry in the world, in my opinion, period. So if you're here now or if you're watching from home, give yourself a round of applause, please. Bitcoin, in my opinion, not only is the best asset we've ever seen as mankind, it's also unique in a bunch of different ways. One of them is, if you are in an oppressive regime, you can leave that with $100 million just in your memory. Now, that's not the ideal way to only have your Bitcoin. There's many different ways you can do it. And next up, for that reason, we're here to learn about custody and counterparty risk. So please introduce to the stage Joe Consorti. Jackson Mikhalic, and Joe Burnett.
Let's go. All right. All right. Good morning, everyone. Thanks for coming. So, as Anders mentioned, my name is Joe Consorti. I'm the head of growth at Horizon and Thea. Horizon is a home equity into Bitcoin business, and Thea is a self-custody business for businesses.
Hey everyone, Jackson Mikhalic here. I'm at OnRamp. I lead our private client and institutional sales. We focus on multi-institution custody for Bitcoin and financial services built around that custody solution.
Awesome. Hey everyone, I'm Joe Burnett. I'm Director of Bitcoin Strategy at Saylor Scientific, and happy to be here.
All right, phenomenal. So I'll kick things off. Today we're talking about custody models. So obviously Bitcoin custody is extremely important, and it's more important for Bitcoin treasury companies. Obviously the MO of public companies who are buying Bitcoin is to buy a lot of it. And so with that comes a great deal of decision making when it comes to how you're going to custody your Bitcoin. Totally disparate custody models out there. Basically, everybody is choosing to go with an institutional custodian of some kind. Many of them are choosing multi-sig. Today, we're going to talk about those different models and the trade-offs between them. The one I want to really start off with is multi-institutional custody, essentially what OnRamp specializes in, what Thea also offers to businesses of all kinds. Really, the benefit of multi-institutional custody is you're distributing ownership of your keys. Meaning no single party has access to your funds. And that's extremely important because over time we've all seen what can happen when you leave the funds up to one party. You open yourself up to a whole host of risks, obviously counterparty risk, but also rehypothecation risks. Folks that will take collateral and then post it as collateral elsewhere and do that several times over. And then when folks come looking for their funds, the Bitcoin is nowhere to be found. This is an even more acute risk for institutions, as I mentioned, who are holding a lot of Bitcoin. Joe Saylor Scientific now has over 5,000 BTC. That's a lot of capital right there. And so it brings about these questions that we're going to discuss today about what is the best way to do these things. And when you're talking about that amount of Bitcoin, eliminating single points of failure is extremely important. And that's what multi-institutional custody, but also just multi-sig generally allows you to do. Is by instead of making it so that you can access your funds with just one key, having 3 keys or even 5 keys in your setup can completely eliminate those single points of failure and make it so that if one of those keys gets compromised, your funds don't get compromised. And ultimately, that's a story you don't want to have to explain to investors about how you lost all of the Bitcoin that you purchased on their behalf, right? Your MO is to increase Bitcoin per share. What you don't want is to lose that Bitcoin or have a security model that has holes in it, that has the potential for you to lose your Bitcoin. So ultimately, that's really what multisig is all about. I want to talk about briefly proof of reserves as well. Proof of reserves, extremely important when it comes to investor relations. One of the main things that gets talked about today, one of the main talking points against Bitcoin treasury companies is this idea of paper Bitcoin. A lot of detractors will look at Bitcoin treasury companies and they'll say, well, there's no way to prove this entity holds their BTC. Many institutions have said for various security reasons they don't want to publish addresses or make it readily known to the public. A way to work around this is through multi-institution custody or multisig. What Theia offers, what OnRamp offers, what Unchained offers, and what you can do in-house as well. And so there are many things we can discuss today, whether it's assembling a team to do this or hiring one of these companies to do this for you. But really, it's a very important topic. I talked about paper Bitcoin. Investor relations are very important. Building trust is what matters more than anything else, right? Obviously, when it comes to building a Bitcoin treasury company, you want great operators, you want a sound methodology to increase Bitcoin per share, but importantly, you also want to build investor trust and maintain that investor trust. And one of the easiest ways to do that is by being transparent in your Bitcoin holdings and having proof of reserves. And by holding your funds in multisig, you can offer that transparency to your investors about where the Bitcoin is, how much of it is held, without opening yourself up to the security risks that many have cited as the reason for why they don't have proof of reserves. So that's where I'll leave it. Wanted to keep it pretty high level before I pass it off to Jackson. So Jackson, you can take it away.
Thanks, Joe. Nicely said. So I want to see some hands. Who thinks we're still early to Bitcoin in this crowd? Okay, so the reason I ask that is because I agree with that statement, and also because if you believe that we're early to Bitcoin, what I think is underappreciated often is that that means solutions that have existed thus far have been for early adopters, and we haven't yet seen kind of the final form of financial services, infrastructure, and custody. It's always evolving. And so why are we talking about custody today? In my opinion, Bitcoin custody is the thing. It really is the most important thing that investors, whether it's a corporate balance sheet, it's an institutional investor, it's an individual investor, this is the most important thing that you need to get right, because as we all know with Bitcoin, there's only 21 million and there are no bailouts with Bitcoin. And if you mismanage the asset, then you may be sitting on permanent losses, right? I think a lot of people in this room would think of Bitcoin as a generational asset and potential generational wealth in the future, and for corporate treasuries that applies in a similar way. But you could have a generational loss if this asset is not managed properly. And so this is why custody is so critical to the conversation. And I would say that if you look at Bitcoin as a $2 trillion asset class today, the fact that there's been hundreds of billions of dollars that have been lost due to poor custody in this space is evidence that we actually have not figured out custody, again, in its final form. And so what options exist for custody? I think it's always important to talk about what options do investors have, and we can focus specifically on corporate balance sheets today. There's really two main buckets that investors can choose from. There is self-custody and there's third-party custody. And in self-custody, that implies that the end user, whether it's an individual or it's a company, is managing the keys for that asset. And so this comes in different flavors. You have single sig hardware wallets, you have multi-sig, you have collaborative custody. And I think of all these solutions as some flavor of self-custody. Ultimately, it's the responsibility of that end user, in this case, the corporation, to be managing the asset themselves. It's a great thing from a sovereignty perspective, from a control of the asset, but let's be honest, it can be incredibly daunting if you're managing millions, tens, hundreds of millions, billions of dollars of capital. There's a lot of risk there, just from turnover, from having expertise within your department or within your firm to actually manage this on an ongoing basis, insider collusion, physical threats, you name it. The flip side is that you have third-party custody, and so third-party custody, typically you're handing over control of your Bitcoin to a third-party custodian. They're managing all the keys on your behalf. Again, there are a lot of benefits to this. It's convenient. You're outsourcing the responsibility to a firm that should be experts at it. But at the same time, you're taking on a lot of counterparty risk. Since that firm controls all of the keys, that opens up the door for a hack, opens up the door for mismanagement, firms just outright losing keys. We saw this in 2022. It opens up the door for your Bitcoin to not actually be sitting in cold storage as you think it was, to Joe's point on proof of reserves. And so ultimately, my conviction is that the reason why we've seen so many losses in this space historically is because both of these solutions, self-custody and traditional third-party custody, where you hand over control of the asset to a single institution, they both have a lot of trade-offs. But I think we've done the best job as we can of an industry. And going forward, what I see is a lot of what Joe described, a multi-institution custody being the standard. Before I get there, what I see a lot of times now with companies is they already recognize the inherent risk of trusting all their Bitcoin to a single custodian. Mm-hmm. And what they do, this applies to public and private companies, is they are diversifying custodial risk. They're parking Bitcoin at various exchanges or various custodians, so they don't have all of their eggs sitting in one basket, and they don't potentially have a 100% loss they could be looking at. Maybe it's 25%, maybe it's 33%, maybe it's nothing, of course, right? And so there's already a recognition that there is a lot of custodial risk, and so ultimately what this leads to are other solutions, leveraging battle-tested technology like multi-signature, and namely multi-institution custody, in my opinion, will become the standard for Bitcoin custody because, for the reasons I just mentioned, you don't want to have all of your Bitcoin sitting internally. Also, you don't want to have a single point of failure. You don't want to wake up one day and the Bitcoin you thought you had on your balance sheet is no longer there. So with multi-institution custody, I think Joe hit a lot of the high notes, did a great job. Instead of one firm managing all the keys internally, you have 3 or more independent institutions. They all manage a minority of the key set, so none of them actually control. In this case, there's 3 independent institutions. They all manage one key. You need 2 of 3 signatures to actually effect control to send a transaction of that Bitcoin. So what you're actually solving for, and then I'll wrap up, is there is no single point of failure. If something happens to one of these institutions in multi-institution custody, you don't have a loss because you only need 2 of 3, or maybe it's 3 of 5. And so we're effectively solving for the biggest, the most important thing in my opinion, because at the end of the day, growing Bitcoin per share is important, generating alpha is important, but if you don't have a rock solid foundation of custody, then it could be all for nothing. So,
awesome. Thanks, guys. Yeah, I think this panel is particularly interesting to me because now I work at Saylor Scientific as Director of Bitcoin Strategy, but before that I worked at Unchained, which is another collaborative custody provider. But first, before I get into some of the details, I want to talk about why do I think custody even matters, right? When you think about traditional finance, whether that's equities or bonds, these assets inherently come with counterparty risk. So custody of those assets isn't really part of the conversation. Equities, if you're investing in a company, you have to trust that the management team will execute on their strategy and has actually a great strategy. And then bonds, obviously you're lending someone money, hoping that they will pay you back at some point in the future. Bitcoin is a very unique asset because it's an asset that can be held without counterparty risk. You have the optionality to hold it without counterparty risk. And on top of that, it has no dilution risk. As we all know, there's only 21 million Bitcoin. And so if you run a Bitcoin full node and you hold your Bitcoin private keys, then you have this unique asset that has really never existed before in the sense that it has no counterparty risk and no dilution risk. Now, for Bitcoin treasury companies in particular, I'm going to give 2 maybe bad examples on extreme ends of how not to do custody. One example would be, say you're Michael Saylor, you have 600,000 Bitcoin belonging to MSTR shareholders. Holding that Bitcoin on a single signature ledger hardware wallet in Michael's desk would be a very bad idea for a number of reasons. The opposite end of the spectrum is blindlessly trusting a third party. We've seen that the history of Bitcoin is Mt. Gox, FTX, BlockFi, Celsius, whether it's negligence, fraud, or just bad decisions. People have lost serious amounts of Bitcoin over time. And I think Bitcoin treasury companies obviously need to find something in the middle of that. They need something that is trusted and secure. They also need something that has a lot of risk and controls to make sure that there isn't a sovereign single point of failure like holding 600,000 Bitcoin on a single signature hardware wallet. So I think it's really interesting to think about this concept. I agree with what you guys said in the sense that it's still very early. We are still in the very early stages of global Bitcoin adoption. One of my core theses is Bitcoin as digital gold. Bitcoin gold parity would be about $1 million per Bitcoin or a little bit more. And in my mind, I think you have Alexander Graham Bell's original telephone, you have the iPhone today. Obviously, the iPhone is worth significantly more than Alexander Graham Bell's original telephone. And I think Bitcoin could be just like the iPhone of gold. It could be worth multiples or magnitudes more than physical gold. And so I think the primary, one of the primary objectives for Bitcoin treasury companies is to not lose the Bitcoin. So doing the due diligence, making sure that you're going to, if you have trusted third parties in your setup, making sure that they're regulated and understand private key management, because it is a difficult full-time job when you're securing hundreds of millions or billions of dollars. So excited about the future of Bitcoin and excited about the long-term future of Bitcoin treasury companies.
All right, wonderful. Thank you, guys.
Check. Yeah, okay, so let's give this a shot. Tim, you got the other side of the room? Where'd Tim go? Tim disappeared. Okay, I'll get this side of the room. So we're gonna do like 15 minutes Q&A. Raise your hand, stand up. Anybody, Q&A on custody? Or comment? Yeah, go ahead. 45 seconds.
Question. Hi guys, good to see you both. Good to see all of you. When do you think the time locks are going to become standard for multi-sigs, and if not time locks on chain, what are other kinds of spending protocols or delays that you think will be introduced to this?
Yeah, I mean, I could speak to that first. So MiniScript exists that allows for time locks, as an example of spending conditions to be native to Bitcoin. But in my opinion, even before getting to that, these, let's say these controls already exist from a legal and governance perspective. So I don't even think that they necessarily need to be on chain, at least not right now. In my opinion, when you're managing Bitcoin, Bitcoin is money. You don't want to really be in anything that is, let's say you don't want to be in any, you don't want to be like on the frontier. You want to be in stuff that is battle tested, and that's why we've built a solution around multi-signature, which has been used for over a decade now. And in my opinion, you can just have those controls, whether it's spending conditions, let's say velocity controls, how much Bitcoin can move out of the vault in a given month out of that cold storage, or maybe you have a freeze that requires authorization from a number of individuals within the organization to unfreeze that account. These things can be achieved from a legal and governance perspective.
Yeah, I'll just add on my thoughts. I'm by no means a MiniScript expert, but I'm optimistic about what it could do. Being able to do like decaying multi-sigs, or requiring that one key gets signed in a quorum of multiple keys. I think those are interesting, but I still think like we talked about, Bitcoin itself is so early. The solutions that we have out there on Bitcoin custody are still relatively early. So it might take some time before we see that, in broad adoption for, lots of thousands or millions of Bitcoin.
Very well said. And one thing I'll add here to kind of just tie it in with a bow is that ultimately the best way to custody any Bitcoin, whether you have one Bitcoin or less than a Bitcoin as a company or an individual, or thousands of Bitcoin if you're a mainstay Bitcoin treasury company, is to make it so that you're preventing as much of a loss, you're preventing the entire loss completely. Jackson, you mentioned using battle-tested custody solutions. Multi-sig makes it so that if you lose one of your keys, there are built-in recovery options. You can recover the rest of your funds. Whereas if you're doing this strategy of using multiple institutions and spreading out your funds, if one of those institutions goes under, you lose that portion of funds entirely. And so it's a difference of loss prevention versus loss mitigation. And these time-tested utilities like multi-sig allow you to do that. I too am optimistic about MiniScript, but I do believe that using the tools that have been in the space for the longest amount of time, that have the longest track record, are the most important when we're talking about Bitcoin custody solutions for businesses.
Yeah, one of the most interesting comments at the Bitcoin for Corporations conference that we put on at Strategy in Orlando, one of the big four custody companies, the guy got up there and he says, like, even I don't know where the Bitcoin is. And I was like, half the room said, yeah, that's good, you shouldn't know. And half the room was like, what do you mean you don't know? It was a kind of a good comment. Anybody else? I'll get you here. 45 seconds.
I'll be quick. So in 2021, there was the initial hypothecation was okay, but then when it got rehypothecated, then that became a problem for who had the claims on the Bitcoin that happened with various companies that went under. So my question is, how do you tell the difference between a wallet management and actually changing the hypothecation of those coins? Because it changes wallets, but really it changed who has the claim on the coins. The person that has the coin can just say, well, we're just doing wallet management, but yet it's been rehypothecated.
Yeah, I mean, I can't speak to that in super detail. I mean, I know like FTX was like, a huge problem back in the day, BlockFi, Celsius, right? Like they were taking people's Bitcoin, lending it out and doing bad things with it. And so I think it's important that if you hold lots of Bitcoin, you need to make sure that you actually have legal claim over the Bitcoin, and ideally your custodian is not going to be rehypothecating that Bitcoin.
I can speak to this a little bit. So we've seen this with a lot of on-chain explorers, a lot of on-chain sleuths who will identify this type of stuff. Arkham, right, is a great example, who is kind of known for pointing these things out, and then kind of everyone on X makes a buzz about it. One thing I'll say is that the main thing that all of us discussed was multi-sig. And so you kind of mitigate around that entirely when you're simply buying your Bitcoin and sitting on it in a collaborative multi-sig, whether it's multi-institutional, whether it's fully in-house, whether you're using a third party, et cetera. And so ultimately, and we've seen that this is what the market prefers as well. So entities like Coinbase, for example, who have a lot of eyes on them when it comes to these on-chain sleuth platforms, any movement of funds that they will tell you is just moving in between wallets, there's no way for anybody to verify that. But by establishing a multi-sig setup and proof of reserves, anybody at any time can look on any block explorer and see that the Bitcoin is staying exactly where it is. And so ultimately, the question from an investor relations perspective is mitigating that entirely, making it so that it isn't even a question that ever comes up. And I believe collaborative multi-sig and proof of reserves that's enabled by that is the way that you do that. I think those practices are going away, in my mind, because we've seen from the investing public that they don't like that whatsoever. They don't like when they see movement of funds. What they like Bitcoin treasury companies to do is to buy Bitcoin and hold it and know that it's there. And that third component is kind of what we discussed here. That's what needs to come next, and that's what I think will come next.
I'll just add to that quickly, because at our company, the way we have our wallets structured is every client has their own dedicated wallet. So you have kind of proof of reserves of your holdings specifically, right? So one of the value propositions, and this doesn't need to be exclusive to our company, it could be for any multi-institution provider that does this, but you're actually able to verify your assets on platform or off platform, on a node or block explorer, et cetera, because you're actually able to look at your public addresses that are only for your Bitcoin. So it's almost like a little bit more granular version of proof of reserves, in my opinion. Mm-hmm. And then to your original question on movement of funds or versus rehypothecation, I think that ultimately comes down to communication. So public or private companies, as an example, and then we'll talk about public. Private companies, at least again how we have it set up, is you can have certain individuals with view-only access versus ownership access on the account. You can have different approval quorums on the account, and so people on the leadership team pretty much have to go through a process of verification and would know if assets are moving out of the vault. Again, because you can audit only your Bitcoin holdings. Then at public companies, that same applies, but then it would be maybe a matter of communicating that out to the public after the assets have moved, that was a routine wallet management. But a little bit different, but ultimately the same infrastructure and foundation.
Okay, we'll get one more question. Tim, you got anyone over there? Tim, back there? Where's Tim? Tim disappeared? Is he running? Good job on the color coordination. Your wives must have all talked last night of how to dress you guys.
So I have a question on insurance. I think that there's a lack of or dramatic deficiency in insurance among the custodians on a whole, and it's usually single incident insurance. So you have insurance for the overall custodian, and then it's diluted by the by the assets held by that custodian. Just wonder what your thoughts are and how that's going to evolve.
Mm-hmm. Yeah. Oh, go ahead.
Yeah, I have a lot of thoughts on it, but if anyone wants to hear more, find me afterwards. The short of it is, I think that insurance is not the place to start with Bitcoin custody, because ultimately, if you are relying on the insurance and you end up having a claim, you're going to be working through a long process. And at least to my knowledge, most insurance policies are dollar denominated. So if there is future appreciation of the asset, you may not be getting paid out on that appreciation. So insurance, it's great depending on what it covers, but I think key management is absolutely critical and most important for mitigating failures and those risks in the first place. Again, I can speak to what we do at our company. We have an insurance policy that's narrow scope, focused on collusion risk, because naturally a question could be, well, what if two independent key holding institutions collude? Again, anyone who has that question, find me afterward, we can talk about it. But we have an insurance policy, and the way we have our solution architected is, since every client has their own wallet on chain, our insurance is per incident, and definitionally an incident can only happen at a given wallet at a given time. So this was underwritten by Lloyd's of London, and so it, again, is narrow scope because we believe as a company that the key management should really mitigate out as many risks as possible, and then the insurance is really just the cherry on top versus the main thing to anchor to.
Perfect. That's exactly what I was going to say in a different way. So you're exactly right. Ultimately, the way to think about these things is first and foremost key management, right? That is your insurance policy per se. And you can really take a layered security approach with this, right? It becomes as important as when you buy your first Bitcoin as when you buy your 1,000th or 10,000th, right? And so key management, number one, there are plenty of materials out there by Unchained, by Thea, by OnRamp to educate yourself on this. Build an in-house team if you'd like to. Distributing keys between your CEO, your CTO, your CFO, people who are at a high level in your organization who you trust. That's your first layer. That's your first insurance policy, right? You're eliminating single points of failure in that way. And then the same, to your point, Jackson, layering on top of that dollar-denominated insurance, right? So in the event that anything does happen, you have an additional fallback plan. And then I suppose on top of that, because you're doing this, communicating this to investors as well, that the Bitcoin that you're buying on their behalf is protected. This is your security protocol. And I think our talk, as much as it boils down to security, it boils down to transparency, right? Telling your investors exactly what you're doing and how you're doing it, getting them more comfortable with your approach. In the same way that you're educating them and telling them and explaining to them through your directors of Bitcoin strategy how you're buying Bitcoin on their behalf with access to capital markets, you should put as much attention into educating your investors as to how that Bitcoin is being custodied, and put that same effort into it in-house.
Yeah, I mean, I think the future of insurance and the future of custody and the future of Bitcoin, kind of like we're talking about, it's still so early. Whether there's technical solutions like Miniscript that are going to make insurance products better and easier to use, or just legal solutions, or just as the price of Bitcoin goes up, there's more natural market demand to create better custody solutions and create better Bitcoin insurance projects. And so I think just a symptom of it being so early in global Bitcoin adoption, it's still early in global Bitcoin insurance adoption.
Well said.
Fantastic. Thank you very much, guys. We're going to try to get a couple of minutes back here. So thank you very much.
All right. Thank you, everyone.
Stay in the room. We're going to flow right into the next one here.
Hey everyone. Great to be here. My name is King Oei. I'm the founder of Treasury. We announced our deal about 2 weeks ago. We're Amsterdam based, and our goal is to become the largest European Bitcoin Treasury company. So we're all here thanks to Michael Saylor, who really kind of invented the securitization of Bitcoin, really bring Bitcoin to the capital markets. Now, this is something that's very close to my heart and experience. I started my career at Goldman Sachs many years ago, and have since been on both the buy side and the issuing side across the capital structure. At Fortress, I built a securitization platform and I ran my own hedge fund. So I'm going to tell you a bit more about Treasury and how we aim to achieve our goals. We just closed our first raise, $150 million. Some of the investors in our raise are in this room. We're very grateful. It was founder-led, so I didn't use any investment bank. I raised through my own network, and this is our first of hopefully many raises. We already accumulated 1,000 Bitcoin, and we are backed by real pioneers in the industry, Cameron Tyler Winklevoss, and David Bay Nakamoto, who are also on our advisory board. And lastly, we acquired the Bitcoin Amsterdam conference. For us, it's critical to be a key ecosystem player, build a community, bring people together, and educate. And the conference will be next month in Amsterdam, and you're all very welcome to come. So what is interesting about Europe? Let's see. In Amsterdam, it was actually the foundation of the joint stock company and also the first stock exchange many years ago. That led to the golden age. Now we're ready here to re-enter the digital golden age. From Amsterdam, Euronext Amsterdam will be listed through a reverse takeover by next month. We have access to all the European capital markets and all the tools that made MicroStrategy so successful. ATMs, converts, pref securities. This is actually a very interesting element of the European market. The credit markets in Europe are, funnily enough, larger than the US credit markets. Why is that? The US has a big equity culture, which is fantastic, and Europe has a more of a fixed income culture. So the pref securities market is actually double the size of the US pref securities market. The convertible market is almost double the size, and instantly enough, the supply of converts is actually minuscule compared to the demand. In other words, it's a massive opportunity for a Bitcoin treasury company to bring Bitcoin to the capital markets. This is the credit side, which about 60% of European institutional capital is in fixed income. The equity side is different. The equity markets are boring in Europe, to be very fair. And you can see this most in volatility. So the top 10 stocks, the volatility of the top 10 stocks is only 57% for the European index. The top 10 S&P stocks, 75%. So it tells you the difference, and Nasdaq 71. The most volatile stock in Europe is only 62% vol, and obviously MicroStrategy is 91. In other words, a high vol stock is a real asset for the European market. That translates into an attractive asset to be trading for European portfolio managers. I've been one. It's very hard to find exciting stocks in Europe. Clearly, for portfolio managers looking to get exposure to Bitcoin, and clearly also for retail investors. So it's a big untapped opportunity that we're seeing in Europe. We are therefore positioning ourselves to really bring Bitcoin to the European capital markets and really explore this untapped opportunity. Didn't talk about options yet. The options market, MicroStrategy's option volume is double the size of the top 3 largest European contracts combined. Imagine, again, shows you there's very little vol in Europe, a very attractive, very little product there, which is what we'll be offering. I mentioned the convertible debt, which is a big opportunity. And then lastly, growth initiatives. Obviously, there are some players which over the cycle will find it tough to survive. And we think consolidation, with my special sits hat on, is an attractive feature for our shareholders, for shareholders of the target, but also for the market. Because when a Bitcoin treasury company trades below NAV, the theory is you just sell Bitcoin, buy back shares. That's actually not that great for the industry. So we think with M&A opportunities for companies that trade below NAV, that actually helps all stakeholders in the space. Lastly, very important to have a strong team. We hired top people from Flow Traders. Laura is here, come see us afterwards. And we're very excited to make this grow together. Thank you very much.
Good morning, everybody. My name is Eleanor Terrett. I am the co-host of the Crypto in America podcast and newsletter. Happy to be here with you guys today. I'm introducing the next panel. It's on new market expansion, opportunities, and risk, with 3 gentlemen who are going to give you some insight into their companies. So we have Paul Lee, the co-CEO of Korea's first institutional treasury company, BitPlanet. Andrew Webley, CEO and founder of the Smarter Web company. And Boyd Cohen, Chief Strategy Officer of Arcadia, Mexico's first Bitcoin treasury company. Give it up for these 3 gentlemen, please.
Hi guys, can you hear me? Okay, great. All right, my name is Paul Lee. I'm the co-CEO of Korea's first institutional Bitcoin treasury company in Korea called BitPlanet. We're pretty new. We fully closed our deal literally 7 days ago, so last Wednesday, and we announced our deal about 3 months ago. So I'm here to talk about Korea. Korea, I think, is probably one of the most exciting countries to launch a Bitcoin treasury business right now. There is a lot of investor demand. In the short time we have launched, our stock is the highest performing stock across all exchanges in Korea year to date. So there's obviously a lot of demand, which comes with opportunity. What are the long-term opportunities that are specific to Korea? I can talk about a lot of things. I think there are several. There are tax arbitrage or favorable tax structure for Bitcoin treasury companies. That's very similar to MetaPlanet, which has not enacted yet, but it will be there in about 15 months. I can talk about the maturity and size of the capital market in Korea, and Korea being one of the rule of law country in Korea, which in Asia, which is pretty rare actually in Asia. And Korean capital market and institutional investors are definitely ready to take in a lot of credit instruments that Michael Saylor kind of outlined this morning. I can talk about the new president, the new administration, new administration's favorable stance towards crypto, which is sort of a 180-degree change since the last president and last administration. But one thing I am most excited about is actually the macro reality of Korea and the lack of, or the fact that the Bitcoin narrative, the healthy Bitcoin story, has not yet taken root in Korea. So let's talk about macro in Korea. So first is population. You probably heard Korean birth rate is the lowest in the world, like by a big margin. It's actually in the 0.6s. In about 60 years, Korean population is going to cut in half of what it is today. The growth rate of GDP in Korea has dipped below 2%, I think for the first time in many decades. And what that means is that the national pension fund, the size of national pension fund, projection of national pension fund size is like this, which means in about 10 to 15 years, national pension fund is going to decrease in size. In about 30 to 40 years, it's going to be zero. And it's a big fund. I think Korea's pension fund is probably the third largest pension fund in the world. And a lot of people depend on it. If you're a 40-year-old working person like me in Korea, if you want to retire in 25 years, that means there will be a really little social safety net available for you. And let's talk about real estate, right? Seoul real estate is insane. It's comparable to that of Manhattan. The difference between the US and Korea is that a lot of economic infrastructure, business infrastructure is focused in Seoul. So if you're priced out of Seoul, you're basically cut out from a lot of economic opportunities. If you're a 30-year-old Korean person making 60, 70K in a year in Korea, which is upper middle class income in Korea, you probably need to, win a lottery or, inherit some money from your parents or, trade meme coin to make 100x, to get married, have kids, and buy an apartment, etc. So on the other hand, the retirement fund, 401k, they're all focused on very safe 4 to 5% yielding, principal guaranteed, like CD-like products. So that's sort of an illustration of how polarized Korea is in terms of macroeconomic structure. There's a lot of disconnect across different investor groups, different generations, working class and non-working class. And what I truly believe is that Bitcoin is actually one of the best powerful tools or best assets to actually bridge that gap. By catering to people across all investor groups, by being a high growth asset that is maturing to be one of the most important macro assets in the world. Also by being a safe and durable asset that is one of the most liquid assets in the world. And that sort of aligning Bitcoin with the sort of a macro reality of Korea, I think that's really the biggest unlock and the biggest opportunity there is in Korea, and that's what I'm most excited about. And I said a lot of bad things about Korea, but what Koreans work hard. I love Korea, and when they find the collective vision in Korea, they go at it. They form community very quickly, and I envision that collective vision to be vision of Bitcoin, Michael Saylor's vision, Satoshi's vision, and that is why I'm most excited about what I do, and that I think is probably the biggest opportunity Korea has. So that's it from me.
Good morning, everyone. Just had to check the time then, because obviously I've just come over from the UK, so different time zone. So my name is Andrew, and I'm the founder and the CEO of the Smarter Web company, and I just wanted to tell you a very brief bit about our story, and then I've picked out 3 things that I think are worth talking about briefly. So I set up my business in 1999. I started my career in 1999. I worked at a small company that became one of the biggest companies in the UK, one of the largest retail brokers in the UK. And then I left there after 10 years because I got bored. So I set up my own small technology company 15 years ago, the Smarter Web company. And then I found Bitcoin almost 10 years ago. For me, it wasn't until Michael Saylor, who is obviously incredible, put public companies and Bitcoin together, that I really thought that this is the answer to everything as far as I'm concerned. And then in the UK, we didn't have a Bitcoin Treasury company. I started looking about 3 years ago for one, because I wanted to make an investment in one, and there wasn't one. So eventually we got to last year, and I decided that I'd list my business, which is what I did and why I'm speaking to you today. We listed the business in April 2025, so that's 5 months ago. And I'm credited with pioneering the strategy in the UK, which I'm very grateful for. I'm more proud of the fact that everyone told me that I couldn't do it. They said it wouldn't work. I pointed out strategy. I pointed out MetaPlanet. They still told me that it wouldn't work. But we have become the best performing IPO in the UK ever. Obviously, there's volatility in the market at the moment, but I'm really proud of that fact, and I believe that the best is yet to come. So our focus is delivering Bitcoin yield. We do have a small operating business, which is an important aspect of what we do. It's something that I'm very proud about because I'm a programmer myself. But everyone asks me what makes us different. And I think the second thing that I'm going to talk about is the way that we communicate. So right from the start, we've tried to do everything openly and transparently as much as possible as you can do with a public company. And I think that has worked so far. It's given us the 3rd largest investor community on X, only behind Strategy and MetaPlanet. Almost 4,500 individuals in that community, and I'm pretty proud of that. So I wanted to briefly talk about these 3 things. So firstly, capital. So I loved hearing Saylor talk earlier and his wise words, and he says everything much better than I will. But the thing that I would like to say about capital is that bearing in mind everyone said that I couldn't do this, in 5 months we've raised over £200 million of pretty much pure equity. We've got a tiny amount of convertible Bitcoin-denominated debt, but we've managed to raise 200 million, and we could have raised an awful lot more. So the advice that I'd give to anyone thinking about doing this strategy is there is no rush here. You've got to move fast, and they all joke that we're the fastest horse, but get the right capital. The wrong capital will cost you dearly, and it may even be worse than that. It might end the game. So yeah, get the right capital. My favorite subject is the second thing, communication. So obviously, you know, I view my job as a Bitcoin Treasury CEO as, you know, the best job in the world, and I'm incredibly grateful to everyone that allows me to do this. But communication isn't a secondary thing to the job. It is the job. It's not something that you should view as a chore or anything like that. I write an update to our shareholders. I actually write it on a Friday, but I put it out on a Saturday morning. Jesse, who works alongside me, we counted in July. We did 70 YouTube appearances in one calendar month, you know, together. You know, communication is the best bit about the job, but it's also what your investors want. Maybe when we get much, much bigger, there'll be more one-on-one communication with much, much larger institutions, but we'll still always communicate with the retail shareholders, and they are the people that have got us to, you know, where we are today. So yeah, I would do everything honestly and with transparency there. And then finally, the third point, which, you know, you probably don't want to hear too much about, is the regulation point. So we're lucky in the UK that it's a very relatively open environment. Some of my friends that run these companies in other parts of the world, you know, it's harder for them. But anyone involved in the space, I view our jobs as helping the regulators understand things better, just like we try and make everyone understand Bitcoin better. You know, it's our jobs to convince the doubters on the regulation side that they're wrong. And then finally, the thing that I'd like to stress, and I touched on it earlier, is that, you know, being a Bitcoin Treasury company isn't a shortcut to performance. You know, take your time. Obviously, focus on Bitcoin yield, but take your time and get it right. If we all do this together and we do it in the right way, you know, I believe there will be thousands and thousands and thousands of these companies. I believe almost every company, private and public, will have some degree of Bitcoin on the balance sheet, but that's what I'd say. I'd say, you know, go as fast as you can, but, you know, please get it right. And if anyone ever needs any help, then, you know, just ping me an email or something, and, you know, I'll do my best to help if that's asked of me.
First of all, I'm upset with Ed and Tim for not giving us the memo that all speakers had to wear a suit with an orange tie. We didn't do that, but at least all three of us didn't do that. It's an honor to be on this particular panel. I've been following what Andrew's been doing with Smarter Web for a while. As Eleanor mentioned, I'm the CSO of Arcadia Bitcoin. We're a new treasury company in Mexico. Ed Julien recently joined our team. All of you know who Ed is. I'll give you a bit of a background on Mexico and a bit on what we've been doing. Similar to some of Paul's background context, obviously most of you in here are Americans, some Europeans, but and beyond. But obviously we all have some familiarity with Mexico, usually on the beaches. Mexico's 15th largest GDP country in the world. 130 million people in Mexico. Mexico is the gateway not just to the US, but to Spanish-speaking Latin America. 450 million people live in Latin America and speak Spanish, so outside of Brazil. There is $350 billion tied up in pension funds in Mexico that have a lot of restrictions around investing in foreign capital markets, but limited opportunity in domestic markets. They're currently returning around 6% per year. M2 growth is 10% a year in Mexico. The $700 billion in domestically owned treasury instruments, $100 billion more in money markets. So that's, if you're doing the math, over $1 trillion of trapped capital, primarily institutions. There's a grassroots Bitcoin community in Mexico that's really interesting, emerging in a lot of the different communities. I live in Monterrey, which is the second largest city in Mexico outside of the Ciudad de Mexico. Ed and I are both bilingual in Spanish, if you didn't know that. So we're the two gringos on the team, but we speak Spanish and we eat Mexican food all the time. Our company, Arcadia, was previously known as Capital X, has an 8-year track record, but unlike most every other treasury company in the market, we're actually a Bitcoin company. The other day I heard Jack Mullers asked about 21, and they said, tell us about the treasury company. He said, we're not a treasury company, we're a Bitcoin company with a proactive LBE Bitcoin treasury strategy. And that's how we define ourselves. So I joined only months ago. The company was formed by two cypherpunks back in 2017, have been servicing Bitcoin brokerage, Bitcoin-backed lending. We have a debit card. We have a DCA coming very soon now. We have some support for institutions, OTC and otherwise. Our underlying business model generates Bitcoin organically. We are a native Bitcoin company pursuing an aggressive Bitcoin treasury strategy. We are private, we're early, so been following Andrew and some of the other earlier treasury companies that are gaining traction to learn from all of them, so it's amazing again to be on the stage with them. We have our own custody in-house. Within 30 days, we'll be publishing our proof of reserves. We offer custody for our institutional customers and our retail customers pretty soon. Our debit card will soon have a BTC cashback, so kind of like Fold. We have a growing lending business that's kind of like Ledin. So we are aimed to be the place to go for institutions and retail investors in the Bitcoin community, whether you want to be on the Bitcoin self-custody or you want to be in the investment or both. And we see a lot of synergy with both. We aim to tokenize our securities and allow pathways for our investors to migrate their securities into our app to then leverage for Bitcoin-backed lending, et cetera. So you can envision all kinds of pathways for synergy amongst them. And with that, we're opening to questions. Thank you.
Thank you very much. With a focus on the challenges in new markets, any questions, comments, anyone I can throw the mic to here? Anybody? Anybody? Got one back there.
Hey guys, so first and foremost, thanks so much for that intro. You guys mentioned that part of this challenge is kind of educating these new populations that maybe haven't had access, and not just that, but allowing equity investors in these markets access to Bitcoin through the Bitcoin Treasury company or through the Bitcoin company as opposed to just holding spot Bitcoin. Can you guys just speak to that specifically?
I'll start. One thing that's fascinating, so we're a Bitcoin company, and so we struggle with this too when we think about the treasury side and like, are we discouraging people, retail investors, from holding spot Bitcoin and self-custody, which is something our underlying business has been doing for 8 years, supporting that. There's a couple things. First of all, in Mexico, I didn't mention, it's really interesting. There's a tax arbitrage for retail, so retail investors can pay up to 35% capital gain on the sale of spot Bitcoin, but they're capped at 10% on the sale of equities and public instruments. So what we see is that it's very easy for all of us sort of core Bitcoiners to like put everyone in a pigeonhole and say everyone needs to buy all of their Bitcoin and hold it in self-custody, but what is that? 5% of the current Bitcoin held in the world is held that way? We have to meet people where they are to help them on their Bitcoin journey. And our vision is, all right, you can, if you're not totally orange-pilled but you want to get exposure to Bitcoin, well, we can enable that through our public instruments. As you get orange-pilled, we have a vehicle to tokenize those instruments, and you can bring those into our app and start learning to actually engage with Bitcoin in a more personal way. And my core takeaway from this is we have to meet people where they are, whether they're institutions, whether they're small business, or whether retail. And if we only have one view of the only way to own and engage with Bitcoin is holding in self-custody, we're not going to orange pill the world the way we want to. The way to do it is give them a range of options, optionality, let them enter where they're ready and comfortable, and over time they will orange pill and also engage in spot Bitcoin and maybe still hold our equities.
I can add to that as well that, in the UK, we've got a similar situation, slightly different, but broadly the same. I hold almost 100% of everything that I've got in the world in Bitcoin or Bitcoin Treasury companies. And for me, as controversial as it is, and hopefully none of you will sort of come and hit me afterwards, Bitcoin Treasury companies, when well run, offer something that's better than Bitcoin. If we all agree that Bitcoin is the best asset in the world, then, how do you get better than that? Well, the answer is very simple. It's compound Bitcoin, and that's what we offer, through Bitcoin Yield. And if you think about it in terms of the securitization of Bitcoin, which is ultimately what we're all doing here, in different degrees, creating different products for different needs. For my personal need, what do I need? Well, I want the performance of Bitcoin, but I'd like more. So a Bitcoin Treasury company is an alternative to people that see the value of Bitcoin, but want something maybe more volatile, for example. But Bitcoin in itself doesn't offer compound returns,
Yeah. I have a question for Andrew. As a new IPO in UK market.
Can you speak up a little?
As a new IPO in UK market, looking at growth opportunities, how easy or difficult it can be for UK company to acquire a new operating profitable business and or acquire a new struggling treasury company in UK?
Yeah, okay, so there's a couple of questions in that really. So if the question is, how easy is it to an IPO a business in the UK? It's pretty easy, actually. You can see that there's 25 that sort of pivoted or IPO'd after us. It's not that hard if you know what you're doing, and there's lots of people that can help with that. And then what you need to do is you need to get the structure right. So one of the things that I was very keen on was making sure that the structure was compliance within the regulations. Clearly that's important. So I IPO'd my business, which is a small business with a Bitcoin Treasury policy, and it's as simple as that, really. Then once you're listed, the final part of the question in terms of acquiring other companies, we can acquire whatever we want. So I'm building a balance sheet on the best asset in the world for the future, and then probably not in the next week, but in the next 3 months, 6 months, 12 months, etc., we will roll out that policy that's been clearly stated since the outset, the acquisition strategy, using the strength of our balance sheet to acquire the right opportunities. What's the right opportunity? Very simple. Basically anything that will deliver value for our shareholders. So I don't see right now, today, us acquiring another Bitcoin Treasury company today, but I wouldn't be surprised if in the next 3 months, 6 months, not necessarily in the UK, then that might be good, and that would be a good thing for those other companies. It would aggregate companies together, and continue our mission. So yeah, hope that answers the question.
If I may answer that gentleman's question as it applies to Korea, because I think it's important. I 100% echo what Andrew and Boyd said. I think the important role of a treasury company in each capital market is to basically amplify access to Bitcoin and Bitcoin-backed products. In Korea, there are only 5 crypto exchanges. One of them is Upbit that has a 70% market share. And what Korean government did is basically pair each one of the 5 with a bank in Korea. So in order to open an account with these crypto exchanges, you have to open an account with these banks first. So if you haven't used that bank before, it doesn't matter. You have to go to the bank and open that account. Some of them are just pure internet banks that don't have any offline branches. You have to go online and open an account, which is very hard for example, my 7-year-old dad, right? He trades stock all the time. That's basically his hobby. And he's interested in crypto. He's interested in Bitcoin, Ethereum. I've been trying to orange pill him for a while. I know he is never going to actually go to a bank by himself, a bank that he never used to open an account to buy Bitcoin. But it is going to be very easy for him to basically buy equity, Bitcoin Treasury equities, my company, BitPlanet, or Microstrategy in the US. So I think in that sense, we're definitely opening up the market by, by a big margin to retail investors, institutional investors, to this new product called Bitcoin, and also Bitcoin-backed securities and credit products.
Go to you, Tim.
Hola, César de Football Tech. Boyd, pregunta en español. ¿Cómo ves el papel de Bitcoin?
Ándale. Nadie habla español aquí, güey.
Como herramienta.
No, inglés.
Bueno, Boyd, ¿cómo ves? How do you see Bitcoin as a tool for financial inclusion throughout Latin America?
Yeah, thank you, Cesar, for the question. I could answer that in Spanish, but Ed would get mad at me. So there's over 50%, just over 50% of the Mexican population is unbanked, which is hard to believe. It's a pretty developed country. You might have a view of Mexico outside of beaches. It's a lot of poverty, but I live in what is actually the highest GDP per capita municipality in all of Latin America, in Monterrey, Mexico. It's beautiful. Yet we have a lot of inequality like we see around the world, and we certainly have it around Mexico and around Latin America. Argentina, Venezuela, my wife is Venezuelan. Bolivia, a lot of you probably heard what happened very recently with Bolivia around US dollars. It looked a lot like what US did with gold decades ago. So this is the interesting thing about Bitcoin in Latin America and Mexico, is that there is significant demand at a grassroots level. You see a lot of these Bitcoin circular economies in Mexico, in Argentina, in El Salvador, in many communities where they're starting to use Bitcoin with or without government involvement whatsoever. So in Mexico, what we have is significant recognition that money is broken and a desire to have something better in communities where people are unbanked or underbanked. That includes small business. They're onboarding to Bitcoin. We actually have a service for them too, for SMEs that actually want to receive payment in Bitcoin. So there's growing pent-up demand at the lower levels. What we see is a real gap at the institutional level. The central bank doesn't get it yet. The large existing publicly traded companies don't get it at all. I spoke to a guy who used to be governor of the board of Mexico. He said he's on 5 major boards and he hasn't heard Bitcoin referenced once on any meeting with a bank board, with a major construction company board, and many others. So it's not on their radar yet. You know, problem and opportunity. We see it as a great opportunity as we're the first in the market, Bitcoin native and Bitcoin Treasury in Mexico. Opportunities are big.
Thank you, gentlemen. We're going to...
I think that's...
Yeah, thank you very much. We're going to go on to the next session now.
All right, are we good again?
All right, my name is Justin Esty. I am the Vice President of Sora Ventures. I'm going to talk to you guys a little bit about a company called Moon Inc. Moon Inc. is a major sponsor for the event. You can see our logo right there behind us. It's the one with the circle. So Moon Inc. is a telecommunications company based out of Hong Kong that has been turned into a Bitcoin treasury play. It is the first and only company in Hong Kong to issue convertible bonds in order to buy Bitcoin. It is backed by UTXO. The board includes David Bailey, and the CEO is John Riggins, who is the founding partner of UTXO management. Our current goal is to get listed on the Hong Kong connection in order to gain exposure for the mainland China market. The ticker is 1723. I encourage everybody to check it out, and I'll give it over to Jason here.
So my name is Jason. I'm the founder of Sora Ventures. For those who don't know about Sora Ventures, we've been a Bitcoin-focused fund for the last 2 years, invested heavily into Bitcoin the last 2 years with UTXO. We're also one of the largest LPs for UTXO. So we have about 30 plus portfolio companies in the Bitcoin space. About a year ago, we worked with Simon and founded, basically seeded MetaPlanet, brought UTXO into the deal. I sat on the board of MetaPlanet for 4 months, and then 4 months in, I left MetaPlanet board to start more MetaPlanets around Asia. To date, we have 4 other public companies in the Asia market that is building a Bitcoin treasury company. So Justin mentioned about Moon Inc. 1723 in the Hong Kong main board. The goal is to access Chinese capital market. We were the best performing stock in Hong Kong Q1 this year. And then in addition to that, we have DV8, which is Thailand. We were the best performing stock in Thailand this year, about 15x return. Met with the ex-Prime Minister of Thailand, Thaksin himself, got blessing, and the idea is really to launch Bitcoin and really push Bitcoin into Southeast Asia. We'll be announcing the Bitcoin Southeast Asia conference at the same time of Tomorrowland, Thailand. And recently, BitPlanet, which Paul was on stage here, we also led that round, and that is Korea's first play. My understanding is also the best performing stock in Korea right now. The goal for what we're doing here is, why we're here, why we're in this conference is really, Sora Venture is looking to fuel a lot more of these Bitcoin companies around Asia. The goal is to have 9 public companies in Asia by the end of this year, and we'll have Taiwan next month announced. So people who don't know about Taiwan, is one of the largest public markets in Asia, 10x volume more market than Thailand. We'll have Vietnam, we'll have Indonesia, and then we'll have Malaysia. And really the idea is we'll be, whereas a lot of you guys here are pushing the Bitcoin narrative, the Bitcoin movement in the US, there are some in Europe. Really, we're the ones who are doing this in Asia. And so the idea is, yes, we are sponsoring the conference, but more importantly, we're looking for talents. We're looking for people who want to join us on this journey. If you guys probably know very well, Dylan is now full-time at MetaPlanet, but he started off as part-time. The idea is, through this conference, we want to get people who are interested in kind of like working with us and building kind of the Bitcoin movement in Asia. So thanks a lot.
Thanks, guys.
Thank you very much, Sora Ventures. We got one more session before lunch, and it's going to be a doozy. So we're going to run a couple of our sponsor ads here. In about 90 seconds, we are going to go with one of the hottest panels of the day. Stand by.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, perfect Bitcoin position in every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
BTC.
Hello, everyone. Good morning. My name is Halston Valencia, and as a part of Gen Z, I am entering the Bitcoin space with a perspective shaped by a financial crisis, a global lockdown, record inflation, student loans just skyrocketing, and Bitcoin as a lifeline of trust, really. And so I'm honored to introduce this next panel that will focus on one of the most debated topics in the space, proof of reserves, necessity or distraction, where they're going to break down proof of reserves and what they mean for the future of Bitcoin treasuries. So please join me in welcoming Adrian Morris, Pierre Richard, and Alex Thorne.
All right. Thank you, Tim and Ed, for organizing what has been just an excellent unconference. Great content, and it's been great to see lots of familiar faces and new faces. My name is Pierre Richard. I've been in the Bitcoin ecosystem for a little while now. I co-founded the Nakamoto Institute in 2014. Most recently, this week, we announced that I joined the board of directors for Strive as an independent director and chairman of the audit committee. But of course, I'm speaking in my own personal capacity today on proof of reserves. I think that proof of reserves, everyone's got a different definition for it. I know that there's, Alex and I share experience on the technical definition of it, using cryptography between a custodian and its clients. And typically what we've seen is it's exchanges, right? Exchanges prove that they have crypto assets, Bitcoin, let's only use Bitcoin today, right? And they prove it cryptographically to their clients. Some do this, some don't. In Texas, so first comment I want to have is that there's a bit of a misnomer when people talk about just publishing an address and claiming that it's yours, and that people will claim that that's proof of reserves. That doesn't meet the cryptographic technical definition of proof of reserves. It seems like it's something else entirely in terms of disclosure. But it gets to the point that was raised earlier today about developing trust between two parties. And it's kind of odd because in Bitcoin we're all about cutting out trusted third parties. I'll leave it there. I'll let these gentlemen introduce themselves. Those are some initial thoughts.
Can everyone hear me? Good? Awesome.
My name is Adrian Morris. I'm a long-time Bitcoin investor since about 2012. I'm a strategy investor since about 2022. I'm also a bit of an AI super user and a nerd. So whenever Saylor talks about AI, my ears always perk up because I think it's a powerful tool to use. And one of the things that I like to, when I'm thinking through proof of reserves, I think through my position as an investor and as a Bitcoiner. And I'm going to differentiate those two. I think it's very important that we understand the relationships that we have with any third party when it comes to Bitcoin. So, of course, when you're custodying your own Bitcoin, you have no third-party relationship outside of the wallet that you choose. If you are buying Bitcoin on Coinbase and you're holding it on Coinbase, which you shouldn't do, by the way, or any other custodian, you are having a relationship with that company, with that custodian. And then when you buy a share of Strategy, for instance, you have a relationship with that equity. And I think that is a very important distinction to create because whether everyone here is aware of it or not, when you buy a Bitcoin treasury company, you have a relationship with the equity. You do not have a relationship with the underlying Bitcoin. When you buy IBIT, you have a direct relationship with the underlying Bitcoin. And when you custody your Bitcoin, you have a direct relationship with the underlying Bitcoin. And why I think that is important is because I don't think the requirement should be on the equity to provide proof of reserves. I think the requirement should be on their custodian to provide the proof of reserves. Furthermore, I think that as Bitcoiners, which many of us are here, when we buy Bitcoin securities, in many ways, we are not understanding or perhaps paying enough attention to the fact that these represent the securitization of Bitcoin. They don't represent the Bitcoinization of a security. So you're not going to have the same level of transparency that you have with Bitcoin as you would with a Bitcoin treasury company. You're not going to have that same level of control. You are placing a directional bet on Bitcoin when you buy a Bitcoin equity. When you buy IBIT, you are entitled to directional exposure, and you do, I believe, and I think Alex can speak to this, have a direct claim on the underlying Bitcoin. And of course, when you own your own Bitcoin, you have a direct claim as well. So I think we should also be mindful of that. We should also be mindful of the fact of what is Bitcoin's ethos. In my opinion, Strategy, Saylor Scientific, Metaplanet, they're all peers in the network. They're not custodying the Bitcoin on our behalf. They have Bitcoin, they're buying Bitcoin, and it's being custodied for them. So as such, I think it is anti-Bitcoin in a way to mandate that peers in the network dox their addresses or be mandated to provide addresses. However, I do think the nuance that could be drawn there is, as I mentioned, putting the onus on their custodians to provide proof of reserves. And considering that Strategy is already audited as part of their overall requirements, we should also be mindful to not create new requirements that create a lot of friction with existing reporting requirements. And I think that we should just look towards the fact that we are all early adopters here, and this is going to build out, this is going to scale, and more considerations are perhaps going to come into play than we are even aware of now. But with that said, I think proof of reserves is important, but we need to define what proof of reserves really is and be very, very mindful of the requirements that we want to place upon either peers in the network or the custodians in the network.
I agree with a lot of what both Pierre and Adrian have said. I'm Alex. I'm head of research at Galaxy Digital. We're a big service provider to many Bitcoin treasury companies. And I used to run blockchain research and Bitcoin and crypto VC at Fidelity for a long time, including when they launched Fidelity Digital Assets, which is their Bitcoin custodian. I think when it comes to proof of reserves, I think providing cryptographic proof of ownership is something that is unique. Bitcoin's the first asset in the history of the world that you can do that with, and that makes it a very powerful part of the Bitcoin use case. You can't prove that you own, mathematically prove that you own a stock, and in fact, if you've looked into the way stock ownership exists, you don't even actually, what you have is a security entitlement. Actually, the DTC owns the stock, and your brokerage firm, typically, if it's an NMS security, just sort of updates, it sits in a bucket for the brokerage firm at the DTC, and then they maintain their own ledger. All of those parts of the stack in stock equity ownership are highly regulated to ensure that it works correctly, and it does work correctly. But Bitcoin, you could prove, and as Adrian pointed out, if you have it in your own wallet, well, then there it is. You can prove it to yourself. You can sign a message to yourself and validate with your Bitcoin core that it is valid, and okay. You can also see it there. if you use a third-party custodian as a business or an individual, you maybe should request that the service provider to you prove that they actually have it. I think Elon Musk famously sold some Bitcoin out of his Tesla stack in 2021 and said he was testing the market's liquidity. He may have also been testing the fact that they would actually sell it for him. So I do think that it is a powerful attribute of Bitcoin that you can prove you own it. And I think when it comes to a treasury company, it could be a differentiator for you to do that. I'm only aware of one significant one that does it on a regular basis, which is MetaPlanet. So shout out to MetaPlanet. I don't know that, I agree, I don't think they have to do it. I think really they should be going to their custodians and asking them, they're the client. The treasury company is the client. The client should be asking the service provider for that proof. And I think Adrian makes a great point about the equity ownership. You have a share in a company that does something. Theoretically, you should be asking Fidelity to prove that you actually own your MSTR share, right? You don't have, you don't own Bitcoin when you own MetaPlanet or MSTR or Semler or Strive and shout out to all the others I'm not going to name. There are many. So it is something that I advocate for. At Galaxy, we are also ourselves a client of custodians and exchanges with whom we trade or have to keep a balance on for one reason or another, and we absolutely monitor the state of the various exchanges' proof of reserves, and some of them are good and ongoing, and sometimes we have questions if they don't publish on time or if there appears to be a discrepancy, and we ask them, right? We have a whole risk team, and one of the things they do is monitor our counterparty risk, and that includes 2 service providers that either custody assets for us or hold our assets in flight. So I think it's extremely reasonable to ask. I do think, and I will point out, there are risks to doing ongoing proof of reserves. Mostly to do it in a remotely practical manner, you really should be reusing addresses. Otherwise, imagine you have a giant balance and you're doing the correct forensic ownership, you don't want to ever reuse an address. But imagine now you have 10,000 addresses for which you have to sign a cryptographic proof. So most of those that I know that do proof of reserve actually reuse their address, which makes it easier to do proof of reserves, but maybe worse from a cybersecurity cleanliness standpoint. You also, of course, have to sign a message. And you can imagine why a deep cold storage provider prefers not to go in on a regular basis, access the private keys in order to sign such a message. So there are trade-offs. I think it's reasonable for a client to ask their service provider to do it. And I don't know, I wanted to ask Pierre too about the policy of requiring it. And again, I haven't ever heard any policymaker at the state or federal level in the United States suggest it should be required for a treasury company. But there have been many suggestions that it should be required for a service provider like a custodian.
That's correct. So in Texas, after the FTX debacle, the legislature wanted to do something. And the something that they decided to do was to require any exchange or custodian operating in Texas to provide a proof of reserves mechanism for their clients. And so that way, we're lowering the risk of another FTX type situation where the management team is misappropriating client funds. And I testified in favor of that bill because really, from my point of view, there are very real risks that Alex pointed out. And when I worked at Kraken, we also did a proof of reserves, and so this is something that we thought a lot about from a product and engineering perspective. So I think the benefit from a policy perspective is that it avoids worse policy. And it, to put it uncharitably, it's a talking point that allows you to win over the moderates. So in any legislature, we're going to have the very pro-Bitcoin legislators who they're trading on their personal account. They might even have some mining investments. They might be investing in Bitcoin treasury companies. And so they're not interested in over-regulating the space. And then you have the Elizabeth Warrens, right? They just want to ban Bitcoin. And then most people are in between. And they want to hear reasonable arguments from both sides. And one way that we can win over the in-between is by having case studies that show that using the unique properties of this technology, we're actually able to hold ourselves to a higher standard than everybody else in the financial system, right? So when an auditor is confirming a bank balance, it wasn't so long ago they actually sent a physical letter to the bank, and then the bank would reply to their letter and say, yes, this was the balance on December 31st. And recently they've moved to PDFs and emails. So proof of reserves is taking that process and making it cryptographic, which I think has it is taking it to a level that's greater than the current standards from an auditor perspective. And so when we look at the traditional financial system, the banks, they don't have any reserves to prove, right? The Federal Reserve, if we look at Fort Knox, they promised an audit. We haven't gotten an audit, so we don't have proof of reserves on the gold. And so I think that from a policy perspective, establishing the fact that our industry is holding itself to a higher standard than other industries out there is going to be really important, because over the past years, we've heard lots of complaints about Bitcoin mining consuming too much electricity. I think this industry is going to be so successful that people will be complaining that we're taking up too much capital. This industry is too capital intensive. We're competing with these other financial products, and we'll see lots of grandstanding from Elizabeth Warren saying, oh, well, people are lending to Bitcoin treasury companies instead of lending to private equity or to mortgages or these other low-yielding, sometimes far higher risk opportunities. And she'll be using that as a stick to as she did with energy for undermining Bitcoin's success. And when we have those conversations, we want to win over the moderates, and we want to show, hey, this industry is responsible. We are good stewards of capital, and we have really excellent tools to be able to develop trust with the investment universe.
Yeah, and I also think that along the lines of responsibility, a middle ground that we can probably find without requiring the strategies and Semlers and Metaplants of the world to be required to put forth their addresses in perpetuity, either cryptographically or otherwise. And Pierre, you and I talked about this. It's somewhat like an attestation model. Strategy is already audited. Most people aren't aware of this, but their holdings are already audited, and Semler and other companies as well. A part of a process that we can perhaps look into the industry thinking through is an attestation model where that attestation for whomever is auditing them is made public. And it says that this company audited our holdings on this date. We have X amount of holdings and X number of wallets, and for X number of dollars as of this date, and we can attest to the fact that they are in fact real and they are in fact there. And if people would then say that, well, how do we trust only one auditor? You can have a dual attestation model where you create an adversarial dynamic that incentivizes one auditor to find fault with another. Therefore, you now have two independent parties that are auditing the model, that are auditing the holdings in a model that says, this company has X number of Bitcoin, both auditors have attested to it. As of this date, the holdings are worth X amount of dollars, and we can say that they do have them. I think that's a middle ground that companies are perhaps would be more likely to want to adopt, because as we've discussed, a cryptographic true proof of reserves model would be very, very difficult to do at scale, and it would take quite a long time to scale up, and it'll create quite a lot of overhead to maintain. A process that doesn't create friction with the existing reporting requirements, I think, is a good middle ground. And to Alex, you and I talked about this, and you talked about it up here. It could be a differentiator. Some companies would do cryptographic proof of reserves. Others would do an attestation model. It is up to the investor, in the cases of an equity, to make a decision whether or not that is a differentiating factor for them. In the case of like a Coinbase or a Kraken or a Fidelity or a BlackRock, that's an actual custodian, proof of reserves remains paramount in my view. But I think that we don't have to take an either-or model. Bitcoin is not either-or. Bitcoin is a freedom network as much as it is a peer-to-peer network. So I think we should allow room for that as well.
Before we take questions, real quick, one point, and we are going to take questions, and I totally agree. I think that's a really fair way of looking at this, right? And there are that it shouldn't be required, and it isn't under GAAP accounting and I doubt that it will be. And you as an investor in a treasury company are free to choose This can be on your matrix of things you want. How good are they raising capital? How good's the management team, like Michael Saylor was talking about? One could be how transparent are they about their holdings? I think that's totally reasonable. And recall, too, the other part of cryptographic proof of assets is proof of liabilities, because if your custodian says they have all this Bitcoin, but you're unaware that they also are in debt to the tune of $10 billion to some third party for some other reason, now you're wondering where in the possible liquidation stack do you sit? Some entities that do a great job with this, Kraken does a great proof of assets. River, great Bitcoin exchange, does both proof of reserves and proof of liabilities. Like I said, Metaplanet Bitwise has done a form of this. The only US ETF that has released their addresses. I don't know that they sign. Is it actually cryptographic if they just tell you their addresses? There's a variety I encourage people to look at. And if you do yourself or a business use a third party, I think it's for custody, I think it's very reasonable to demand that they offer this. Ed, should we take questions?
Check 2, 3. Michael, could we get your comments on proof of reserve, or putting you on the spot?
Evolving situation, and we're studying it very carefully and enthusiastically.
He gets applause for 5 words.
And I think the 3 gentlemen on stage have been quite articulate, and they've laid out all of the nuances quite well in the time that was allotted to them, and I agree with it all.
Okay, thank you. Go over here and then come on.
Hey there, Nate Sharp, BTC Treasury Group. Question about the attestation. Adrian, I like your idea about the 2 competing firms. Are there established processes for that attestation process, or is that just up to each firm?
Not that I'm aware of. I don't know if there's any dual attestation model in this kind of a structure, but I think it'll be up to the firms whether or not to implement it. I do think it's the reason why I like it conceptually. I'm not saying that's a perfect solution, but conceptually, with TradFi, there are a lot of existing reporting requirements, and companies are often reluctant to adopt a new model or a new framework that creates a lot of friction with the existing reporting requirements. This is a requirement that exists within that framework that typically exists. They already are attesting to their holdings on a quarterly basis, so this would just be an additional step in a pre-existing process that would not require them restructuring something from scratch. So those are just my thoughts on it.
I also so I started my career out in public accounting as an auditor at Deloitte. So I do also feel some obligation to, after dragging them down, to also point out the value of the tradition and of the existing legal frameworks and the regulatory environment. So for those old enough to remember, Enron was a huge scandal. There were other accounting scandals that occurred in the early 2000s. And in response to that, they passed the Sarbanes-Oxley Act. And so when you are looking at an audit opinion from an auditor, you're also, when you're looking at management's signing off on the financials, they have criminal and civil liability. So you have to keep in mind that in many ways, it's also already, in Adrian's words, a very adversarial environment where they want to make sure that what they're putting on the paper is correct. And there's very severe consequences if it is incorrect. And so I think that we also have to keep in mind, like, what is, and to your point, Alex, about when an investor is doing their due diligence on a Bitcoin treasury company, what's their risk assessment? If they really don't trust the management team, furthermore, they don't trust the auditors, furthermore, they don't trust the SEC, the regulators, they don't trust the legal system, the rule of law in the United States, what are they doing investing in a public company? They should just go buy Bitcoin and put it in cold storage and run their own node and verify it themselves. So there is kind of a paradox there.
Yeah. One note on the Enron thing. Arthur Andersen was never found of any wrongdoing, to my understanding, right? They were...
all the paper was shred, so...
Well, they were never found of any wrongdoing, but it was more that they approved all the loopholes. And it was a game of loopholes. And so that's kind of where I think about this is like, okay, we don't have to do proof of reserves. We're getting audited, but where do we find a loophole in the whole system that ends up being unproof of reserves? Any other questions or comments? Go ahead.
Hey there, my name is Joseph Ettinger. I'm a student at the University of Maryland, and I'm giving a helping hand to Arcadia B, so a special thank you to Ed and Boyd Cohen. Speaking from the perspective of a student, and Adrian, this question is particularly for you because I look up to the way you educate people so fluently online. You know, if I were to have the ambition of infusing Bitcoin-based education and Treasury-based education into the standard academia system, colleges, universities, how would you go about doing that? And I'd love to hear all of your suggestions, but particularly would love to hear from Adrian. Thank you.
Oh, wow. So I'm going to try to answer this in a way that doesn't seem like I'm going to burn colleges altogether. So I would say that AI is a very, very useful framework that we can leverage in the sense of Bitcoin is not something like traditional finance that you can teach per se. I think to appreciate Bitcoin, you have to come into it with a certain framework of knowledge in the sense that you either have been watching your savings erode, you've been in TradFi and you think that there's a better way of doing things, or you're just someone like me that got fortunate enough to be introduced to it and had someone that taught you about Bitcoin from everything from Bitcoin mining all the way through to monetary theory. I don't know if that works in a collegiate setting anymore. I think that colleges have become, they're still a breeding ground of ideas, but I think, and I'm going to be very careful how I say this, they become a breeding ground for ideologies. Both sides of that coin, right?
I agree.
And I think that a college should be an impartial and dispassionate environment. So if I were to teach Bitcoin, I would teach it in a way that I teach it in kind of in parallel with finance, in parallel with sociology, in parallel with economics. It shouldn't be an additional thing. It should be part of the curriculum as another way of looking at economics altogether. I think if I had to pick one way of doing it, that's the way I would do it.
I would also offer that a student-led process through clubs has been very effective. Evan Solomon at the University of Michigan's done a lot. Ella Huff with the Cornell Bitcoin Club also done a lot. And so, I think there will need to be more in curriculums. I can't wait until we see how that actually manifests. But most colleges are very supportive of robust student-led organizations. And I think there's also a lot of people who will donate money to those to help you get them off the ground, to build your own curriculum.
Yeah, that's a great question. Personally, I love debating. So very recently, I debated Jim Chanos about Bitcoin Treasury companies. So if anybody's interested in that topic, go find it on Preston Pish's podcast. So I think having students debate the big questions in Bitcoin, and even Bitcoin versus altcoins, that forces them to go and do the research to come up with the arguments, and that's how I've learned about Bitcoin, is by arguing about it on the internet.
Thank you, guys.
One more back there behind you, Tim, and then that'll be the last one.
Thank you for the very insightful panel. I'm from the United Kingdom, and we've got a real challenge at the moment. One of the main challenges is custody. We are a regulated firm, and we want to custody, but we're finding objection to that, and a lot of it's to do with cross-border custody and ownership and jurisdictional obligations. Do we see a time when we'll have an equivalence regime where all the major organizations and governments come together and allow equivalence? Because obviously everybody wants Bitcoin on the balance sheet.
I think the FCA has done a decent job on some of this, and I don't have a great answer as to the current state of where the FCA, which is the Financial Conduct Authority in the UK. One of the best things the UK has is one single market regulator. I think we're one of the only major countries in the world that has a bifurcated commodities versus securities regulatory structure, which I'm personally not a fan of. But I would say that the SEC and the FCA have been working very closely to try to do some sandboxing and harmonizing. So knowing, Chairman Atkins and Commissioner Peirce and Uyeda at the SEC and their thoughts on their progressive views on Bitcoin, I think it's possible that they may be convincing them. That's all I could offer, though.
Yeah, I don't have anything to add specifically on the question of that, but you brought up jurisdiction, which I think is a really interesting question. One of Bitcoin's unique properties being cryptographic. Earlier today, we talked about multi-sig and multi-institution. There's also multi-jurisdiction. So you can have private keys in different legal environments so that if a government wants to seize those Bitcoin, they have to get cooperation through international law with other governments, which you couldn't do with gold, right? Gold is always physically in one place or the other. And I think that is a really important property that's under discussed and will become more discussed as people think about how to have seizure resistance in an environment. For example, you might have a very successful Bitcoin treasury company that is listed on a stock exchange in a country that has kind of a shaky property rights. Well, if they have multi-jurisdiction, multi-sig, maybe that means that they're actually in a much better position than a company that has mining equipment in that jurisdiction or oil and gas.
Yeah, everything that's being highlighted here, I think, is going to be indicative of where we're going to go. I can envision a future where we have agreed upon standards globally for custody and for cryptographic solutions. Just because you have the jurisdictional aspect, you also have the fact of, do they want to do an attestation model, or do they want to do something purely cryptographic? And then you have crisis of scale. So what I mean by that is, in a future of strategy, and I'm sure Michael will love hearing this, where it's worth multi-trillions of dollars, and you have Coinbase that's still custodying Bitcoin and they have trillions of dollars and Kraken in trillions of dollars, the world is going to perk up their ears and really start to focus on these different institutions, and they're going to want some kind of a standard. I don't think that globally we're going to be able to say that, oh, I'll do it this way, you do it this way, and you do it this way. I think the network that is Bitcoin, the holders collectively and all the corporate and institutional players are going to have to collaborate on finding one kind of a global standard that everyone agrees upon.
Fantastic. Thank you, gentlemen. Okay, so just a reminder, Tim and I had this hope and dream that everyone was just going to stay in the room and listen, but the networkers network and there's nothing we can do about it. If you are going out there, and I'm talking to the wrong people because you're in here and they're out there, but yeah, try to use your inside voice. We're going to work on it. We're keeping the doors closed. It's gotten a little better. We've turned it up. We're going to break for lunch. 1:20. We're back with Michael Saylor, Matt Cole, Jeff Walton, three biggest stars of the show. In the meantime, box lunches are in the lobby. Feel free to bring them in here, but please, 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 in the morning there was trash everywhere. You know how to put it in the trash can. Do us a favor. So bring your lunch back in here, take it out into the street, go sit down by the river. We'll see you back at 1:20. We start sharp. Michael doesn't wait. Thank you very much. Hope you're all enjoying it.
How are the glasses? Do they look totally smudged?
No. Tell me about your creative process.
The creative process involves responding to emails and text messages and then editing those text messages so that they don't look ridiculous. That's basically every day.
Do you ever get rejected?
No. Chris, are you available for an interview this week? No? Are you available to come into the studio for an interview this week? No?
So every time you ask somebody to be on the show, though?
I don't ask people. I just reply to inbound. Elliot, Tim, how are you? Like 5-minute interview? No? No. No. Let me know when you're back. Check back next year. You don't like my face.
So people come to you?
Yeah, but they get rejected. One person I would love to have on the show would be the Backstreet Boys, Jim Chanos, Roseanne O'Donnell, Ozzy Osbourne, Ninja Turtles, Michelangelo, Donatello, Raphael. Putting on the orange tie It's got to be something like what Superman feels when it's just Clark Kent jumping into a phone booth. And then he has laser beams and he's flying around, but like more. So you just feel that you don't need to answer to anyone? I want to hear the truth. You don't think you're responsible to anyone, but you're responsible to the shareholders. I mean, maybe you've heard of them. I demand answers. The shareholders deserve answers, and the viewers want answers. So if you could just answer, no, don't get out of the chair. Nope, the interview's not over. Don't get out of the chair. Can you please answer the question? From the time I step in the office, it's literally nonstop, go, go, go. It's emails, phone calls, it's moving, it's grooving, it's grinding, it's shake and bake. We're wheeling, we're dealing, we're doing deals. We're texting deals, we're DMing deals, we're docu-signing deals, we're calendar hustlers. We're hustling calendars. It's just WIN all the time.
This video may be amazing, but it is not financial advice. BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Football Tech, where soccer and technology meet the power of Bitcoin to transform the future of vulnerable communities. This is what Bitcoin philanthropy looks like. Soccer, technology, and Bitcoin. Join the mission. Help change the game at footballtech.org/Bitcoin.
We're Giga, a Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin, and the future is what we're building. Discover what we're building next.
There's a huge opportunity in digital assets today. We're now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current mega trend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated, up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy $1 worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims, so that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital.
Debt is exploding. Bond yields are rising. Trust is eroding. But this isn't only about risk. A rare strategic opportunity is opening. Bitcoin is changing the game. And for the first time in decades, financial strategy is exciting again. Microstrategy blazed the first trail, but each company's pathway is unique. While traditional consultants ignore Bitcoin's potential, Orange Wheel helps forward-thinking leaders see the opportunity and act on it. Orange Wheel, strategic guidance through the monetary transition.
Your competitors just pulled ahead? While you held cash, more than 140 companies moved $104 billion into Bitcoin. Strategy made 257%. Tesla gained billions. Your cash? Lost 3% to inflation. The Satoshi Institute trains Fortune 500s to build Bitcoin treasuries safely. Master risk compliance and execution with expert-led simulations. Don't fall behind. Visit satoshiinstitute.com. Lead, don't chase.
Activating Bitcoin yield can feel like facing a mountain of risks and decisions. At Zonaris, we cut through them with precision and expertise. Capital needs guidance, clarity, control, direction. We unify strategies into one institutional interface, built for exactness. Idle Bitcoin becomes activated, merged into a network of opportunity. Zonaris delivers security and self-custody as foundational infrastructure for institutional-grade integrity. In a landscape of uncertainty, the future belongs to those prepared, ready to act, ready to scale. Zonaris, for institutions who demand yield without compromise.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Football Tech, where soccer and technology meet the power of Bitcoin to transform the future of vulnerable communities. This is what Bitcoin philanthropy looks like. Soccer, technology, and Bitcoin. Join the mission. Help change the game at footballtech.org/Bitcoin.
We're Giga, a Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin, and the future is what we're building. Discover what we're building next.
There's a huge opportunity in digital assets today. We're now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current mega trend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated, up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy a dollar's worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims, so that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital.
Debt is exploding. Bond yields are rising. Trust is eroding. But this isn't only about risk. A rare strategic opportunity is opening. Bitcoin is changing the game. And for the first time in decades, financial strategy is exciting again. Microstrategy blazed the first trail, but each company's pathway is unique. While traditional consultants ignore Bitcoin's potential, Orange Wheel helps forward-thinking leaders see the opportunity and act on it. Orange Wheel, strategic guidance through the monetary transition.
Your competitors just pulled ahead? While you held cash, more than 140 companies moved $104 billion into Bitcoin. Strategy made 257%. Tesla gained billions. Your cash? Lost 3% to inflation. The Satoshi Institute trains Fortune 500s to build Bitcoin treasuries safely. Master risk compliance and execution with expert-led simulations. Don't fall behind. Visit satoshiinstitute.com. Lead, don't chase.
Activating Bitcoin yield can feel like facing a mountain of risks and decisions. At Zonaris, we cut through them with precision and expertise. Capital needs guidance, clarity, control, direction. We unify strategies into one institutional interface, built for exactness. Idle Bitcoin becomes activated, merged into a network of opportunity. Zonaris delivers security and self-custody as foundational infrastructure for institutional-grade integrity. In a landscape of uncertainty, the future belongs to those prepared, ready to act, ready to scale. Zonaris, for institutions who demand yield without compromise.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Football Tech, where soccer and technology meet the power of Bitcoin to transform the future of vulnerable communities. This is what Bitcoin philanthropy looks like. Soccer, technology, and Bitcoin. Join the mission. Help change the game at footballtech.org/Bitcoin.
We're Giga, a Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin. And the future is what we're building. Discover what we're building next.
There's a huge opportunity in digital assets today. We are now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current mega trend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy $1's worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims, so that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital.
Debt is exploding. Bond yields are rising. Trust is eroding. But this isn't only about risk. A rare strategic opportunity is opening. Bitcoin is changing the game. And for the first time in decades, financial strategy is exciting again. Microstrategy blazed the first trail, but each company's pathway is unique. While traditional consultants ignore Bitcoin's potential, Orange Wheel helps forward-thinking leaders see the opportunity and act on it. Orange Wheel, strategic guidance through the monetary transition.
Your competitors just pulled ahead? While you held cash, more than 140 companies moved $104 billion into Bitcoin. Strategy made 257%. Tesla gained billions. Your cash? Lost 3% to inflation. The Satoshi Institute trains Fortune 500s to build Bitcoin treasuries safely. Master risk compliance and execution with expert-led simulations. Don't fall behind? Visit satoshiinstitute.com. Lead, don't chase.
Activating Bitcoin yield can feel like facing a mountain of risks and decisions. At Zonaris, we cut through them with precision and expertise. Capital needs guidance, clarity, control, direction. We unify strategies into one institutional interface, built for exactness. Idle Bitcoin becomes activated, merged into a network of opportunity. Zonaris delivers security and self-custody as foundational infrastructure for institutional-grade integrity. In a landscape of uncertainty, the future belongs to those prepared, ready to act, ready to scale. Zonaris, for institutions who demand yield without compromise.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Football Tech, where soccer and technology meet the power of Bitcoin to transform the future of vulnerable communities. This is what Bitcoin philanthropy looks like. Soccer, technology, and Bitcoin. Join the mission. Help change the game at footballtech.org/Bitcoin.
We're Giga, a Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin. And the future is what we're building. Discover what we're building next.
There's a huge opportunity in digital assets today. We are now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current mega trend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy $1 worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims, so that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital.
Debt is exploding. Bond yields are rising. Trust is eroding. But this isn't only about risk. A rare strategic opportunity is opening. Bitcoin is changing the game. And for the first time in decades, financial strategy is exciting again. Microstrategy blazed the first trail, but each company's pathway is unique. While traditional consultants ignore Bitcoin's potential, Orange Wheel helps forward-thinking leaders see the opportunity and act on it. Orange Wheel, strategic guidance through the monetary transition.
Your competitors just pulled ahead? While you held cash, more than 140 companies moved $104 billion into Bitcoin. Strategy made 257%. Tesla gained billions. Your cash? Lost 3% to inflation. The Satoshi Institute trains Fortune 500s to build Bitcoin treasuries safely. Master risk compliance and execution with expert-led simulations. Don't fall behind. Visit satoshiinstitute.com. Lead, don't chase.
Activating Bitcoin yield can feel like facing a mountain of risks and decisions. At Zonaris, we cut through them with precision and expertise. Capital needs guidance, clarity, control, direction. We unify strategies into one institutional interface, built for exactness. Idle Bitcoin becomes activated, merged into a network of opportunity. Zonaris delivers security and self-custody as foundational infrastructure for institutional-grade integrity. In a landscape of uncertainty, the future belongs to those prepared, ready to act, ready to scale. Zonaris, for institutions who demand yield without compromise.
Max Kaiser. Oh, okay. Cool. We've been looking for you.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
So in a couple of minutes, I'm going to point to you guys. You'll have your microphones. You'll go on stage. You'll do your introductions. As soon as I hear you say their names, they're going to come join. You guys will just walk out. Hey, I should go out first. Okay, you like it? Yeah. So if you guys can just wait right by the wall here. Yeah. And I'll point to you when we're ready to set you up. Sorry, was somebody asking for me? Was somebody asking for Bo and Channel 1?
Yeah, here we go. Yeah. Woo, 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 woo. Where's the microphone? All right, thank you, thank you. Welcome back to the program. My name is Max Kaiser. First of all, I'd like to individually and personally thank every single one of you out there for making me stinking rich. Thank you. Thank you so much. Keep doing what you're doing. Bitcoin is really cheap. You need to buy more. Keep buying. Stacy Herbert, come on up. Woo!
It's nice to be here, and you know, it's a fun time to be back in New York. And what a wonderful few years since Michael Saylor entered the Bitcoin space. He's made his mark on Bitcoin. Max and I were obviously, we attended the first Bitcoin conference in 2011. I was the first person to ever mention Bitcoin on international television in 2010 at 23 cents. And I didn't know that until recently, thanks to Pete Rizzo. He's the one that posted it. So I was like, wow, I made a mark. But of course, this is kind of the Saylor error. He's taken it to the next level. And this is something actually that Max and I had talked about on our podcast a long time ago, which is Bitcoin capital markets. The ability of Bitcoin to transform companies, economies, countries, corporations. We said that like a decade ago, right? Just like Renaissance Florence on the florin, that the world could be transformed on a Bitcoin standard.
That's right, Stacy. Here at Strategy, our basic philosophy is to buy every fucking Bitcoin we possibly can. We would rob Girl Scouts and monetize their cookies if we could to buy more Bitcoin. We're simply not going to stop buying Bitcoin.
Well, Michael gave this a great explanation a few times in interviews recently, but on the keynote this morning, and about deploying AI to invent totally amazing and unique credit instruments. And that has certainly transformed not just Bitcoin and the Bitcoin ecosystem, but legacy financial markets. I mean, these are things, as he said, that haven't been seen for hundreds of years. And I think this is just the beginning. So in El Salvador, you know, we recently passed a Bitcoin bank law. And so I'm looking forward to this session as well, because I want to see what Michael and what Jeff Cole and what Matt Cole, and Jeff Walton have to say about Bitcoin-backed credit markets.
Yep, let's bring them on. Let's bring them on and get this next session started.
First, I'm going to bring up Jeff Walton and Matt Cole from Strive. They're making big waves in the Bitcoin ecosystem. And of course, Max, who's up next? And this is Michael Saylor.
Oh, there he is. Oh, hi, Michael. Good to see you again. All righty.
Okay.
All right,
and
guys.
we'll leave it with them.
Woohoo!
We made it.
Okay. Matt and Jeff, I've had my experiences with credit, but why don't we just start by, why don't you start and tell us about your background in credit and your experiences, and give us your, the most interesting question I have for you and for you is, given your view of the credit markets, thinking about all of the credit markets in all of the world, which credit markets do you think are most either vulnerable to disruption with Bitcoin-backed credit, or which are the best fits for Bitcoin treasury companies, and how do you see it? You start.
Yeah, so first on my background with regards to credit. So I actually was at CalPERS for 16 years. I managed a $70 billion bond portfolio of structured credit on one hand, and then also U.S. Treasuries. And so I was one of the largest buyers of U.S. Treasuries. That's part of my Bitcoin story. On the credit risk, it's more about the structured credit and when I used to do corporate credit. And where I think there's the max room for disruption is actually thinking about what Bitcoin is as an asset. It doesn't produce income. In my view, it's the longest duration asset that exists. And so I think from the credit side, you should be pairing that with the longest duration credit that you can, and that's a perpetual preferred equity instrument where you never have to repay the principal. That is a matching of the asset side with the liability side. Just like when we're at a pension, we're thinking in terms of decades, hundreds of years. How do you meet your liabilities? I think that's the best instrument, which is why when we launched our strategy, we did not do a convertible note. We kept ourselves debt-free, and we've announced ambitions to really watch what Strategy's been doing with perpetual preferred equity that I think is super innovative, and they've done it in a couple different ways. But I think that's the room for disruption. But the disruption is not to say that the perpetual preferred equity market is small. And so I think it's telling that story, going out and educating, and we'll talk about from the fixed income side, Jeff from the insurance side, how to think about risk in this market. I mean, the TLDR is, I think, strategy right now on the pref side is AAA debt, and we can get into the framework of actually how I think that. That's a multi-decade or long-term framework that I think for the market to accept, but in the interim, while they don't accept it, that's where alpha is made for people that can underwrite Bitcoin-backed risk and do it well.
Yeah, so I'm Jeff Walton, and now Chief Risk Officer at Strive. My background is in risk. I was a reinsurance broker for 11 years, so I sold insurance to insurance companies to protect volatility of insurance company balance sheets. And insurance companies, my background in credit, so most insurance companies have to hold fixed income products that they leverage against in order to take on risk. So a majority of the insurance market is holding 80% bonds or fixed income-like instruments, and the other 20% is equity-like instruments. So, Michael, to your question, obviously the biggest opportunity in Bitcoin is infinite duration credit markets, and to the extent that those can be built and expanded to access the fixed income market. But I do think that the insurance and reinsurance industry, the balance sheet side, not necessarily the risk and the underwriting side, but the balance sheet volatility side is ripe for innovation. And there's an industry level lid on the industry itself that is preventing the insurance industry from adding Bitcoin to their balance sheet or even the perpetual preferred equities to the balance sheet. So I think there's avenues to tackle that with AI and Bitcoin-backed products.
Okay. Let's do an audience poll. How many people in the audience have a bank account with cash in it? Raise your hand. How many people have their money in a bank account in some kind of money market that yields more than 3%? 4%? 5%? You have a bank that yields 5%? 6%? Where do you keep your money? I just want to know. We appreciate it. Okay, just a quick second question. How many of you would like it if your bank gave you 10%? Okay. How many people actually own an ETF that's a fixed income ETF like PFF or any kind of corporate credit ETF that generates yield? Raise your hand. Interesting.
Very few.
Yeah, very much fewer. How many people own any corporate bonds directly? Ooh. Yeah. How many people own? By the way, how many people own equity, like any kind of common equity, like a 4-letter ticker equity? Okay. So it seems like. By the way, the magic thing is to take the bank account idea, crank up the yield, and put it in the equity, right?
Yeah, and maybe just one note on the actual yield. When you say 10%, that's greater than the rate of fiat currency debasement, which is in the 8% range. And so you've flipped the notion of fixed income from something that is being debased. So if you're in a Treasury at 4.5% or something like that, or a corporate credit at 5.5% or 6%, you're being debased relative to the pace of fiat currency debasement. 10%, you're actually accreting cash versus the debasement. I think that's where you can start to become interested as someone that might need or want income depending on where you are in your life.
Anybody from Switzerland or Germany in the audience? Or what do your bank accounts pay in terms of interest? Zero? The zero travels far across the room. Yeah, so I think credit is the most fascinating thing, and it's something that I in my life never really paid much attention into until I got into the Bitcoin world. But I mean, I borrowed money. Obviously, I know consumer credit. I know credit cards. I've done leasing. I've done bank loans. I've done senior financing. Not quite a junk bond, and I've done convertible bonds, and you know, I've done a quasi-margin loan from a bank. Lived to tell about it. I've never done like a 40x levered loan from Binance or Hyperliquid or whatever, where you crank it up and, you know, to 20x or 30x or 40x. I advise against that. Sam Bankman-Fried actually called me once and he pitched me on that. He was like, you know, you should put your Bitcoin at FTX and we can give you margin credit. I actually got pitched by the Three Arrows guys too. I also got pitched by Genesis. I also got pitched by Celsius. I also got pitched by BlockFi. I think I got pitched by just about everyone that went bankrupt during the crypto winter.
Well, you saw it. You didn't do it, so.
Yeah, so I normally say yes enthusiastically in public, but in private I say no a bunch. But coming back to credit, you know, the interesting thing to me is I think theoretically the best kind of digital credit, if we're just inventing the world anew from a blank sheet of paper, is a liquid, publicly traded preferred stock. And a preferred stock can look like a bond, and it can look like an equity. Like if you take one extreme, like STRD, it's a non-cumulative preferred, and that means that, you know, you're paying a dividend. Right now, the dividend we pay is like 12.7% or something. You're paying a dividend, but it's non-cumulative, which means that you never pay the principal back. So it's like 1,000 a year. It's forever. You never pay the principal back. You pay 12% dividend yield, and you pay that forever to someone that buys it. But if you ever were in a credit crisis or a credit crunch, you can suspend the dividend without prejudice, without penalty. Now, the company would have the option to not suspend it, or the company could suspend it and say, well, we're going to pay you back anyway. If we put out a press release saying we're suspending it this quarter, but we intend to make up for it next year, the preferred stock would fall. And if we put out a press release saying we're suspending the dividend, we'll probably never pay you back, it would fall a lot, right? And then if we didn't actually reinstate the dividend for 2 or 3 years, it would be tanked, you know, start to look like total distressed third world debt. But what you've really got there is equity. Like you're like, why would I buy that? You're really buying like an equity that pays 12.7% dividend. And if you ever think about buying equity, you know, you buy the equity in the company that pays the dividend, and the company can suspend the dividend, and they don't have an obligation. And a lot of people buy, you know, Verizon and AT&T, and you know, there's a lot of dividend-bearing equities in the world. So you can do that, but the difference is, of course, you're giving someone some precision about what it is. And when I think about that, I think, I just created an equity that's a perpetual swap where I'm giving you the first 12.7% of the Bitcoin return forever, and then I'm taking back the rest for my common stock shareholders, and I'm giving you a liquidation preference, and I'm giving you some more certainty, and I'm giving you a commitment of the company that we're going to do it. So that's one extreme credit instrument. The other extreme, you know, would be you have a preferred, and you basically say it pays this much, it's cumulative, there are penalties, and you have a put right, There's a call, there's a put in 3 years or whatever, you can put it back to the company, and that starts to look like debt. And if you, in the extreme, you can make it look like perfect, like super senior debt. And I think the beauty of that preferred instrument is it's a programmable container, and you can program that container with any amount of delta. You can put 60 delta, 80 delta, 10 delta. You can put any conversion rate. You can put any duration. You can put any credit duration. You can put any yield duration. You can put any representation. You can put any penalties and rates you want. You can stack them all up, and you can put it in any currency basis you want. You could even plug in all sorts of floaters and indexes. You can index it to SOFR and index it to the Japanese bank rate. So you can do pretty much anything, and that's the beauty of those instruments. If you're a public treasury company, for the most part, you can craft a perfect piece of credit, and then you could sell it 144A, or you could take it public. But my view with credit is the real innovations are you create a credit instrument that you can sell to the public as easily as they can buy an ETF. And then the next innovation is, can you get it on the NASDAQ? And then can you get it on other foreign exchanges? How many exchanges can you get it on? And then the next innovation is, can you put a shelf registration on it? And after you've done all that, then the question is, what's the collateral backing it, and how do you want to run the rest of the company? And I think you can lay out the perfect ideal strategy, but coming back to the impediments, and I'm going to ask you guys about these, right? The impediments to doing that are, if you do it unrated, you've got to go market that instrument to public investors and retail investors that will buy an unrated instrument. So you have a marketing lift. If you want to sell that to the insurance industry, I think there's organizations like Mercer and the like that are creating model portfolios, and they're gatekeepers. And then you have the credit rating agencies like Moody's and Fitch and S&P, and they're also gatekeepers. And so what you find is the conundrum is the stuff that's easy to sell, you don't want to sell. And the stuff that you want to sell is not easy to sell. And we're at this crossroads right now where the question is, do we create the perfect instrument that could scale up to tens of billions? Like Stride for STRD, you could sell 100 billion of it risk-free. You could sell 1 trillion of it risk-free, right? So there's some things that you definitely want to sell that are new, and then there are other things that the market wants to buy, like they want to buy a 3-year bond with liens on all the company's assets, senior in the capital structure, and that of course creates massive amounts of risk. So I guess I start with you and say, how do you think that the existing credit establishment will evolve, and can we actually bring over the Mercers and the S&P and the Moody's and the Fitch credit rating agencies and sell these things to the traditional institutional investors, the pension funds or the whatever? Or do we have to actually completely build a new market of new investors, new credit rating ideas, and sell it to a new product to a new set of investors?
Yeah, I think the answer is both, and I'll give you an analogy to why I think that's the case. After the great financial crisis, in structured credit around mortgages, there evolved new rating agencies that started to rate debt because they took advantage of an opportunity that the market's confidence in the traditional rating agencies plummeted after the great financial crisis. And so you started to see new rating agencies rating commercial mortgages and stuff like that, and CalPERS used them because their models were really innovative and they were strong. So I think there's an opportunity for startups to, in a thoughtful institutional way, think about a credit framework for Bitcoin-backed credit. On the other hand, I think that also creates competition for the incumbent rating agencies. And so just like when Strive was founded and we were competition against the BlackRocks and the Vanguards of the world, we were a check on the system that if you don't actually start to consider to rate these, this startup's going to take your business. And so I think it's both there. And then on how do you evolve it into the market, when you start issuing securities that aren't rated, for most actively managed income funds, they usually have a bucket where they can either rate themselves or buy unrated securities. So you start to see people like the capital groups of the world start to buy it from an institutional perspective, which then on that end puts pressure on the rating agencies to rate them because the asset managers are buying them. And so I think having more issuers, more Bitcoin treasury companies issue preferred equity, innovation, that has more issues in the market, which makes the rating agencies care, competition on the rating agencies, and then asset management adoption. So I think it eventually happens, but I think it's building out that ecosystem.
Jeff, what do you think about the gatekeepers and the traditional credit investors, and how will the market evolve, and how would you approach it?
Yeah, I think you got two sides of the coin here. You've got the risk story, and then you've got the regulatory hurdle. And the risk story is actually incredibly compelling because thinking about the risk framework here of these different instruments, you can calculate it 24/7, 365. This is unlike anything that's ever existed before, like a traditional fixed income instrument that's a function of future cash flows. You may not know what those future cash flow, the sustainability of those future cash flows may look like until each quarter. You get the quarterly earnings results, or I guess every 6 months, as Donald Trump has let us know now. So you've got two pieces of this. You've got this risk story, which I think the right message needs to be explained, that you can calculate the mathematics of the risk of each of these individual instruments 24/7, 365. You can run Monte Carlo simulations and have an understanding of the probabilistic distribution.
Because they're digital.
Because they're digital. Yeah, it's the same infrastructure. And then on the rating agency side, in the insurance market, there are, similar to the banking industry, there are multiple different rating agencies that provide capital adequacy framework for the market. The old guard is AM Best, but there are these new rating agencies that are a little bit smaller that the entire industry doesn't adopt, where they're a little bit more flexible with capital requirements, so that to the extent the insurance industry shifts away from the old guard into these different rating agencies.
So we need to orange pill them.
You need to orange pill the newer rating agencies.
So, I think we want to take some questions from the audience. If anybody has questions, this might be an interesting group. So while you're working that out, I guess the observation I make is there's a lot of mortgage-backed credit. We securitized real estate. Think about how big that got. There's a lot of corporate credit. We're securitizing cash flows of corporations. There's a lot of fiat credit. We're securitizing the ability of a company to print more currency and to win their wars, right? And now this, I see, is the industry that creates the digital credit. And everybody in the room is at the beginning, year one of the creation of digital credit. And you can go out there and brag, the most successful corporate bonds in the last 5 years are digital bonds. The most successful convertible bonds are digital bonds. The most successful preferred instruments are digital. Right? When you put Bitcoin, when you put a collateral asset appreciating at 50% a year and even 30%, even if it's 20%, the truth is, if Bitcoin only appreciated at the rate of the S&P, every single credit instrument built on top of it would outperform every other credit instrument, because every other credit instrument I just named underperforms the collateral underperforms the S&P. So we're on the verge of the creation of a digital credit market that right now it looks like 20, 30 billion a year. By the way, I'm going to throw that, that's a throwaway. It's 30 billion a year and no one's noticed it exists yet. It's 30 billion a year. And the Wall Street Journal and the New York Times and Forbes, they haven't noticed it exists yet. But we're about to go to 50 billion and 100 billion and 200 billion. And so think about $1 trillion of credit, and when it's $1 trillion of credit, it's not 1% of the credit in the world, and people still don't notice it exists. And so the real opportunity for all these companies is to issue billions, then tens of billions, then hundreds of billions of digital credit. And the reason that your equity is going to go to the moon is because the equity is going to be valued based upon the spread between the credit you're selling right? And the underlying asset you're buying, and you'll be able to capture that with massive amount of leverage. The more credit you issue, the faster the credit you issue, and the better the credit terms, the more valuable the equity is going to get. So, question?
Yeah, hi.
Yeah.
I have a question. So I've been following MSTR since you guys decided to make the pivot into the Bitcoin strategy, and trying to follow with my own company as a small private software company. And I thought, Michael, what you said earlier today when you said you really didn't know, in a humble way you say, you don't know about the company that you became. You couldn't predict that back in 2020 or 2022 until you found this. How do you view that towards the future, and how to value MSTR or a company like this issuing all kinds of securities? How much, I guess what I'm trying to say is, how much of that do you think is predictable versus if you're buying MSTR equity, you're buying a call option on future products that we don't know yet? So
How do you value Microsoft or Google in the first year after they went public? How did you value Amazon the first year after it went public? How did you value, Facebook the first year after they went public, the stock crashed. It actually, it traded at 40% of the IPO price or something. So I think we're so early in the first year. It's very, very difficult. You got to look at all these companies, and at the end of the day, the management teams, they have the world to create. And if Metaplanet can go from a $5 million hotel company to a $5 billion entity in 12 months, and they have yet to issue their first serious credit instrument, it's like, yeah, I think Metaplanet will be the most valuable hotel company in the world. I think they'll also be the most valuable company in Japan. And every day I get up and I'm like, crap, I have to go to work because the Metaplanet people are going to outrun me if I don't. Because I'm sure Simon and Dylan are cooking up something. And I'm like, oh, jeez. Okay. So, but that story could be told in 100 markets. And within one market, when you just go to U.S., you're like, okay, well, who's going to own insurance? Who's going to actually partner up with the first bank to offer the 8% bank treasury account? There's so many. At the end of the day, everybody's got limited bandwidth, and there's so many things to be done. We're talking about rebuilding a $300 trillion market, and if we wanted to swap out 10% of it, that's $30 trillion of stuff that has to be done. That's room for $30 trillion companies, right?
Yeah, and even to go one layer deeper on that, you think about insurance company or a bank company, but also how much leverage. There's different buyers that care about different leverage profiles, the different types of innovation in the pref market. Those are going to be real differentiators of both risk and return across the ecosystem to be built out, and one company cannot be every single one of those things to everyone. And obviously there's going to be the largest company with Bitcoin holdings ever in strategy, and then there's going to be companies that take more risk or smaller, the growth companies. There's just so many different ways to differentiate.
So the future is bright, but it's very bright. Next question.
Hi, Michael. Do you think that at some point in the future, indices such as the S&P will have to outperform Bitcoin? Because from an investor's point of view, why would someone take on the operational risk of investing in an equity when they can get a superior return in an asset that you can self-custody? And if we do reach this hypothetical future, will it still be a profitable business model to borrow against the Bitcoin as collateral to purchase more Bitcoin?
I kind of expect that Bitcoin will outperform the S&P forever, because the S&P is always going to be loaded down with real-world assets and entropic conditions. The companies are going to be currency derivatives, and they're going to have real-world assets that depreciate, and there are going to be political issues, and there's going to be chaos and war and expropriation and tariff and taxes and all of those things. But in theory, if the majority of the index was made up of, if the S&P 500 was made up of 500 Bitcoin treasury companies, and they were all well run, and if the politicians didn't expropriate the assets of the companies, then in theory the S&P is a very interesting index. But I don't think we're getting there anytime in the next 30 years. I think what will happen is Bitcoin companies will creep into the index, And as they creep into the index, they will improve the performance of the S&P, and the S&P will start to creep up. Our client will be improved while Bitcoin will grow, mature, and it'll decelerate based upon the fact that it gets integrated into all other aspects of the economy. And that's what I think. We can speculate hyper-Bitcoinization world where everybody's a Bitcoin treasury company. What does that mean? But that's not in the next decade. And so I don't think it's all that constructive to speculate, because the difference between you being 10,000x more than what you are right now is what you do between now and the next decade, right? And if you tell me what the perfect thing to do is hypothetically 25 years out, well, like, you know, in the long run, we're all dead. Sorry, that's Keynesian joke. Go ahead.
Yeah, I had an additional question I just want to add on this. I'm curious to think about how you view the liquidity profile of the preferred instruments and how that conversation and communication goes with the fixed income investors, because as Matt and I have been contemplating a lot, these are far more liquid instruments than anything that's ever existed in the market from a fixed income perspective. And does the market conceptualize that? And does that mean anything? Is that important?
Yeah, well, I think the liquidity is important, right? And I think that the traditional status quo is most well-run companies aren't in the business of issuing securities strategically. They're in the business of buying securities. If you look at the net capital flow, I would guess that most great companies, they're buying, 95% of the capital flow is them buying, not selling. So they're buying their equity, and the only companies that are selling credit are either doing it as a tax arbitrage or they're doing it apologetically and they wish you didn't notice. And so no one is strategically issuing credit, which means that all the credit instruments that issued are a regulatory arbitrage or a requirement. They're all, and to be blunt, they're all garbage. So most preferred stocks issued are garbage, therefore they're not good investment instruments, therefore they don't have a lot of liquidity, and no one in the traditional market ever wanted to make them good instruments. JP Morgan could sell $50 billion of a preferred with $1 billion or $2 billion of liquidity a day with a bid-ask spread of a penny, but that's a 21st century idea, and the 20th century idea is most of these things are sold in discrete chunks, 500 million to $1 billion at a time, and they trade over the counter, which, in my opinion, is an antiquated approach. So the market's antiquated, and it's not really commercialized. And what we're doing right now is we're building a non-crippled instrument. It is 10 to 100 times better, but the market's been conditioned based on antiquated garbage. How many people in the room own a preferred stock? Other than one of mine. Other than one of mine. Okay, now contrast that to the number of people with a bank account. Okay, the preferred stocks pay more than the bank account, but you can see it's like 100 to 1 in favor of certain. So the market's conditioned to buy equity and to use banks. It is not conditioned to buy these other things. And we have to grow the industry, and partly it's a chicken and the egg. Like, well, they didn't buy it because it was a garbage product. Okay, now we have a good product, and people go, yeah, but nobody buys those kind of products. Well, the other products, our plane has got a nuclear reactor in it, and it flies, forever. It's like a hover car, and the other cars are like donkey carts, And you have to convince the world you've got a better one. Then you can get liquidity. And how long that's going to take is anybody's guess, right?
Yeah. But one thing that's interesting, just in the insurance world, one of the reasons the entire reinsurance industry exists is because the insurance company can't sustain a catastrophic event, right? So they buy reinsurance to protect against catastrophic events so they don't have to liquidate their illiquid assets and take a huge hit on them because the reinsurance market is providing coverage. So this concept really like flips the entire insurance industry upside down because that liquidity profile may reduce the need for reinsurance for these insurance companies in the future if they were to adopt these more liquid, higher performing assets.
So we're over time. I'm going to kick these guys out, or should we keep going? What do you think? Little ply? Yeah? We'll keep this one going.
We should stay on schedule.
I think we found a format that Michael likes, so we're going to keep going with this one. We'll do a couple more questions here.
Hey, Michael. This is Nick at BitGo. Nice to meet you. So I had a question that is, your last answer to the previous question is a good segue, which is how do the operators of these treasury companies effectively operate the companies that it lasts 10, 100 years? Is it having an underlying business with liquidity? Is it long-dated debt? Maybe the obvious answer is yes to both, but curious of your nuanced response to how operators can effectively launch a treasury company from scratch and make it succeed.
I think it's simple. You raise as much equity capital as possible. You buy an appreciating asset, Bitcoin, and then if you enter into any kind of credit transaction, you obsess over the credit risk. Like how do I bankrupt the company? Let me reverse it. I raise $1 billion, I borrow $1 billion, I buy a bunch of Bitcoin mining rigs that depreciate 50% a year, and I borrow the money for 12 months and I pay 15% interest and I have to pay it back in 18 months. So if you borrow short term and buy depreciating assets, you'll be bankrupt in 36 months. If you borrow long term and buy appreciating assets, you'll be around forever. The challenge is just what I said earlier in my presentation. The people that want to give these companies money are going to want to give you the money and take short-dated senior credit instruments. And here's the hierarchy. A pipe, that's the worst way to get money, okay? And what I mean by that is if one credit investor approaches a company and offers to invest, and then they craft all the covenants, they make themselves senior, they give themselves liens on everything, right? There's no negotiation, there's no liquid market, right? That person basically has a chokehold on the capital structure. That's why you don't really want to negotiate with one company on a credit transaction. The next best is 144A. You're selling a bond, a junk bond or a convertible bond to up to 60 investors, one market maker. It trades over the counter, which means it doesn't trade. Over the counter means it doesn't trade. It's very liquid. The next best is you take something public and you sell it to 100 million people. That's good, right? That's hard, right? And so I think that you just want to be very careful about what kind of money, what kind of credit you sell, who you sell it to. And it's one of those things where the easiest credit to sell is the most constrictive to the capital structure. And the hardest credit to sell is probably the most profitable thing you'll ever do.
Michael here.
You can cut us off when you want, Ed, but you just decide how long you want to go.
So we're all talking about a dollar yield. Basically, all of these instruments pay yield for people who want interest in dollars and so on. I'm wondering, what do you think about all of these kind of products, but for a future in Bitcoin? So me as a Bitcoiner, I would like to get Bitcoin yield, which is very hard to get. You need to, let's say, exposed to risk and so on. But I believe that the real future is when we start getting all of these products, but for Bitcoiners, where we can actually get Bitcoin interest. I believe from the buy side that you are one of the only few companies that could do something like this. Maybe by raising Bitcoin and lending to the ETFs and whatever.
Thank you for the question. Let me be blunt. That is a ticket to bankruptcy. I don't think you should do that. Bitcoin is going up 30% a year. So if you agree to pay a Bitcoin dividend, you are borrowing money at a 40% interest rate. And so my view is you ought to borrow money at 10% or less, and you ought to invest it at 30% or more. When you talk about Bitcoin yield, you're inverting it. You're basically saying, I'm going to give you 60% interest, and I'm going to go find a way to outperform that. And the whole premise of the industry is there's no way to outperform Bitcoin. Okay, so I'm not a fan. I don't think you should do it. I don't believe in Bitcoin dividends. I think that what you ought to do is fund in the weak currency, the yen, the Swiss franc, the euro, the dollar. You'll pay anywhere from a base rate of 0% to 4%, tack on 400 basis points, give that to credit investors. If you want a Bitcoin yield, my answer is buy the equity, right? The way that we give you Bitcoin dividends is you buy the equity and we generate BTC yield. You can do it safely in the equity, but the point is we don't promise you 30% BTC yield for the next decade because that's impossible to promise. So I leave the yield for the equity and then fund with the credit. If you get that inverted, of course all the Bitcoiners would love to get the Bitcoin dividend. Of course they do. But the point is you've just found a way to borrow money at 60% a year. And now you've got to go invest it at 80% a year return to capture 20. I just think that is like a bomb in the balance sheet. I think it blows you up. That's my opinion, and I have very much, discouraged people from agreeing to pay the Bitcoin return for their debt.
Thank you for the question. I'm curious. In my mind, the credit instruments issued by Bitcoin Treasury companies compete head-on with sovereign debt instruments. If you agree with this, I guess is the first question, and if so, how do you expect sovereigns to respond?
Yeah, I don't agree with it because, as a practical matter, nobody that buys sovereign debt will even talk to us. Like there is zero chance that someone that's using sovereign debt is going to swap out, their sovereign debt for a Bitcoin-backed credit instrument, right? We can't get rated. We can't get an investment rating. If you did get a AAA investment rating, if you were Apple with a AAA investment rating, you still wouldn't be viewed as competitive to sovereign debt. So if we climb up the ladder and we get AAA investment grade rated, we will be competing against Microsoft and Apple debt. And right now we're competing against private credit and junk bonds, and and ETFs preferred. So really, that's the market. Junk bonds. By the way, our debt trades at the same level as distressed debt. Basically, bankrupt companies going bankrupt, that's what it trades at. So it's not a problem, right? Sometimes the Bitcoin maxi thing is, well, oh no, you're going to topple the government and collapse the currency, and blah. What happens when the politicians figure out that you're going to collapse the dollar? It's like, not a risk, not this decade, not in the next decade. What we're trying to do is eat the junk bond market, and then we want to eat the corporate credit market, and the CFO of Microsoft may get some pressure from us in a decade. But right now, if you were to talk to Apple and Microsoft, they don't think they're competing against Bitcoin-backed bonds. And certainly the Treasury Department and the Bank of Japan doesn't think that either. And so I don't think it's a helpful narrative. I think it's a distraction. And what you ought to do is focus upon why this digital credit is better than junk bonds and private credit and a bunch of other things that people buy.
Hi, Valentina from Patagon Markets here. Firstly, thank you so much for being here. And I just wanted to ask about, not now, but in a future where these digital asset treasuries might want to start putting their capital to work. What do you guys think about the admittedly very risky possibility of lending Bitcoin, but against private market secondaries, which tend to offer similar returns to Bitcoin at around 30 to 50% a year as a means of de-risking, as opposed to lending it against private stock?
I think that there's a host of ways to put it to work. For example, when we sell credit, we're putting our capital to work. So when I sell Stride at 12.5% and you give me $1 billion, I generate $1 billion of Bitcoin yield up front, and I get about 80% to 90% of the back-end economics. And so the company makes $10 billion over 10 years. When we sell Stride, that's a way to make it, put it to work. By the way, what's the problem with it? I have to sell it. Like, would I sell $1 trillion of it? Yes. Can I? No. So there's a lot of ways like that. Stride, any credit instrument. I could sell a lot more convertible bonds. They have a 3-year duration, and they have a much wider credit spread, and they have a lot of credit risk. I could try to sell junk bonds. Now, what I said was, I could go write reinsurance, right? That'd be a new kind of risk. I could go borrow money by pledging my Bitcoin, and now I take counterparty risk to the borrower. There's a lot of, I got a chance to put my money with FTX, Genesis, BlockFi, 3 Arrows, and Celsius. They all came and sold. The salespeople will knock on your door and give you the offer. All of them have different risks. So I'm not going to say what a Bitcoin treasury company should do. They're going to have a stack of capital, and their choice is, do I want to do a deal with a bank? Do I want to do a deal with a crypto exchange? Do I want to do I trust the DeFi protocol? I could, do I want to put my, Bitcoin out on do I want to put on the ETH network, the Solana network, the whatever network? Do I want to post it to Hyperliquid or Binance? They're all counterparties. And there's no right answer, right? Except in theory, the right answer is I keep my Bitcoin and I use it as collateral and I borrow money and someone else gives me the money. That's right way risk. When I do that, the only risk we have is the custodial risk. Don't lose the Bitcoin. In theory, that is the risk-free way to generate yield. It's a good gig if you can get it, right? You just have to be, what do you mean? You have to go sell the credit instrument. So selling prefs to the public market is the hardest. Selling prefs in 144A transactions is easier. Selling bonds in 144A transactions is easier. There are other Bitcoin companies, they post their Bitcoin on exchanges, they borrow against it. The issue is, who's the counterparty? Do you trust them? Is it a good deal? Maybe. I can't endorse it unequivocally, right? Because that was the brilliant, idea of Genesis, and they went bankrupt. At some point, someone will mismanage a credit control. Here's what I say about this in general. Every company, public or private, is free to use their collateral the way they like, and there's going to be 100 different things you can do. But it used to be everybody got in the reinsurance business after the last hurricane, and that because every company got wiped out, and so they all launched the new reinsurance companies. They're like, this is great, we're getting 12% cash on cash yield. Then they all got wiped out by the next hurricane. So sometimes it looks good and it's too good to be true, and then it doesn't, but they're all just different businesses. Private companies can move into any of them. They can. Here's what I say about a public company, and I'll shut up. The thing about a public company is the reason the equity has value is because the equity investor understands your business model and wants to own it, wants to own a piece of it. So for example, if you gave me a choice, would I rather make $1 billion a year selling preferreds, or would I rather make $5 billion a year selling some preferreds and doing some hedge trade and selling derivatives and borrowing some money and writing some reinsurance? As a private company, if you have a large ego, the answer is the latter. As a public company, if you've lived through 30 years of pain and agony, and if you've been humbled having done a bunch of things, and you've seen what works, you would choose the former. I would rather make $1 billion in a simple way that's transparent than make 5x that much in an opaque, heterogeneous way. And the reason why is because the people on the other side of the trade, the investors, they need to be able to understand your business, and they need to understand it in a split second. And as soon as you take on each additional counterparty, you create new attack surfaces for the short sellers, new attack surfaces for the complexity, new risks, new sources of entropic lapse. And so this manifests itself in the Wall Street business where it's like you're a hedge fund and you have PhDs at Goldman Sachs and you make billions of dollars doing complicated crap. You trade it like 5 times, 6 times earnings. You sell sugar water like Coca-Cola and you trade at 40 times earnings. And one business is dirt simple. Apple selling the iPhone, their P/E tripled. Apple doing something we don't understand and a lot of different things that are cool that are hard to do. It's, if I don't understand it, the P/E's collapse. So I think if you decide to do it, I would say the company, the Treasury company should just do that thing. And they should focus on it because you want your equity investors to believe in the same thing. Whatever counterparty risk you're taking and whatever kind of credit risk you're taking and whatever execution challenges you're taking, you want everybody on the equity side to understand because the final boss, the people that let me do what I do, are the equity investors. And every week I put out a press release. It's like, okay, well, that was the Bitcoin yield. And the equity investors want Bitcoin. And so Bitcoin yield going up, good. Bitcoin yield going down, not good. That creates the trust. And at that point, you'll bring hundreds of billions of dollars of capital to you because people understand it. When you get heterogeneous, complicated things, then you lose the connection to the equity investor, and now your multiples collapse, your premiums collapse, your liquidity collapses. Yeah, you want to be so transparent that the haters, I want people, like, do you know we're the most shorted stock and the most shorted security in the entire crypto ecosystem? Like 3 times as shorted as IBIT. That's a badge of honor for us. What that means is everybody trusts us to be long Bitcoin, and they want to short the thing that's double long Bitcoin if they want a short position. So every time you come up with another idea, you dilute that, you distract, you make more complicated, and things that make total sense for a private company or a private hedge fund guys don't always make sense for a public company because of the reflexivity throughout all the layers of your other creditors and investors.
Thank you, Matt Cole, Jeff Walton, and the other guy over there. And
thank you.
Michael will be coming back at 5:30. We have 4:30 is going to be, in my opinion, the best panel of the day. We've got a bunch more going through the afternoon here. They all just lost 5 minutes. Fine, that's what you guys wanted. So we're going to bring up our next guy. Thank you very much. If you are going back out to the lobby, use your inside voice. Find it. No yelling out there. Thank you.
Yeah, never thought I'd be following Michael Saylor, but here we are. My name's James Van Straten. I advise Coincilium Group on their Bitcoin Treasury strategy. Coincilium IPO'd in London on the Aquis Exchange back in 2015. It was the first ever IPO of a blockchain venture company. Coincilium has a portfolio of investments via equity and token within the digital asset sector, and they're dual listed in the US on OTCQB. And to pursue our Bitcoin Treasury strategy, as we're in the UK, we created Forza, which is a 100% owned Gibraltar-registered subsidiary. Gibraltar was one of the first jurisdictions to introduce a dedicated regulatory framework for crypto, and it's now home to a growing number of regulated crypto exchanges and funds. So for Coincilium to grow shareholder value, we aim to grow the treasury within Forza, and we aim to use our investments in equity and digital assets as a potential source of these gains. These gains can be directed into Forza, strengthening our treasury, but the most important part is from a non-dilutive growth perspective. So the outcome of this would be a stronger treasury that underpins our financial position. So since May, Coincilium have raised around £17 million. It's roughly $23 million in equity via placings and retail wrap offerings. Forza currently holds around 182 Bitcoin, which ranks Coincilium among the largest in the UK and around 85th globally. Most impressively, the company has come through 3 bear market cycles, 2015, 2018, and 2022. This demonstrates our resilience and adaptability through all different types of market cycles. So it's clear that the demand for public Bitcoin exposure is accelerating, and in the UK, the market is evolving, but very slowly. especially compared to the US. So from October this year, in the next couple of weeks, UK retail investors will be able to trade Bitcoin ETNs, so exchange-traded notes, as the FCA, the UK financial regulator, lifts its 2020 ban on crypto ETPs, exchange-traded products, though ETFs remain unavailable. So for myself as a UK investor, I can't buy US ETFs like IBIT, and there's also no structured options market. So how do we see everything moving forward? We see the digital asset space as complementary and not competitive with one another. We're going to see new products and innovations in digital assets that help expand the market and adoption, and we view this as a positive, not a threat. So with experience across different market cycles, we're confident in our ability to differentiate and navigate the maturing digital asset sector. Thank you very much.
BTC Agenda is pioneering Germany's first publicly listed Bitcoin treasury company and building the region's first dedicated community. Bitcoin Agenda empowers companies to adopt strategic Bitcoin treasury positions with shared knowledge and community. Learn more on X at BTC Agenda.
Good afternoon, everyone. This next panel, titled Deploying Bitcoin, Yield Opportunities, and Long-Term Endgame, tackles the question every treasury faces. Once you hold Bitcoin, how do you put it to work? You know, for my generation, this isn't just about yield. It's about creating strategies that last. This panel will explore the opportunities, the risks, and the long-term game. So please join me in welcoming Gordon Grant, Tim Enneking, and Boris Allergant.
Hello, everyone. Does the mic work? Yay.
I got the Saylor seat, I guess. That's right, for good reason.
We don't have a moderator, so I'm going to volunteer. My name's Tim Enneking. I'm the founder and managing partner of Saylor, which is way in the bottom row and all the way over on the left on all of these charts here, silent P. And we want to run one of the largest non-retail Bitcoin yield farming, ETH yield farming, Solana yield farming, and USDC yield farming operations in the world. We're encroaching on $500 million right now in terms of AUM.
I'm happy to do an intro on myself too. I'm Boris Allergant. I'm at Babylon, and we build trustless use cases for Bitcoin to make it a more productive asset. Our first use case was Bitcoin staking. with about $6.5 billion locked in the protocol. We're also announcing a new use case of Bitcoin lending that's made available through trustless vaults. This is built all on Bitcoin, locked with Bitcoin technology, using UTXO transactions, scripting, and Schnorr signatures.
That's quite a place to start for some very technologically sophisticated innovators like these two. I'm Gordon Grant. I'm here with Bitwise. What I do for yield on Bitcoin is a lot simpler. I take vanilla options and generate what we think of as static return or incremental alpha through a series of proprietary trading strategies. And hopefully we'll have a chance to talk on this panel about risk and variance and yield and how we see that each through our own different lens and how those may be related. So,
actually, I want to ask you a question, because what we do with allocating to liquidity pools, we actually don't sell the underlying, and we allocate liquidity pools with the same asset on each side. So we've done 500,000 allocations, more than 500,000 allocations, and never had a loss. So the returns, for Bitcoin, it's like 5%. It's not through the roof. For USDT, it's like 12. But you're actually, if I understood correctly, doing a trading strategy. So our risk, we've got a Sharpe ratio of like 6 for this entire year. How do you mitigate the risk? Because you're sitting on your Bitcoin, you've got thousands, hundreds, nowadays people have hundreds of thousands, but you've got 100 Bitcoin, you've got 1,000 Bitcoin, serious money. You're going to give it to somebody to manage for. That's already a big psychological step. How do you address the risk concerns from someone who gives you assets?
yeah, that's a great way to frame the infrastructure of what goes into what I think of as the simple, honest promise of yield or return on Bitcoin. Boris has talked about vaults. We use something that is a prototype of a vault, which is a tri-party agreement with a custodian. So the asset manager, in my case, doesn't touch the Bitcoin. Bitcoin sits in a custodial wallet and a tri-party wallet administered by a custodian to allow it to serve as a collateral for the derivative transactions that we undertake. So that's the first level, which is security. As far as the strategy, it depends on what you could think of as a Bayesian framework, a conditional probabilistic framework for looking at what Bitcoin's expected return distribution could be, depending on its levels of implied volatility, and how good we are in interpreting where there may be discrepancies between how that materializes and how it's priced today.
Well, that's just a fancy way of saying how good your derivative trading strategy is. So how good is it?
Well, historically, for representative accounts that I've managed going back to 2021, it's not quite as good a Sharpe as yours, but it's about a 2.5 Sharpe.
That's an awesome Sharpe.
Yeah, thank you. Appreciate the kind words. The strategy is presupposed to target what we think of as a maximum monthly drawdown of about 1%. Now, how do you do that? Of course, you use options and other financial math to make a prognostication about loss tolerance thresholds for options that you're short. Now, if you hold Bitcoin, and you've held it for a long time, especially if you're a US taxpayer, losing your Bitcoin in a principal erosion event is a terrible thing. And so we have to think very carefully, not just about how we set the portfolio up, but how we both buy and sell call options that we trade to ensure that, to the greatest extent possible, we don't have an in-the-money condition for options that we sell.
So what's your average yield?
Well, another good conditional probabilistic question. So today, right, where's Bitcoin vol? Anybody know? Anybody have any ideas? Is it a 5 handle, 4 handle, 3 handle? 3, that's right. So Bitcoin volatility today is measured by the options market at the 1-month point. Going into the FOMC, it was a bit higher on the front end, is only about 35%. This is historically in the bottom quintile of all observations of implied volatility, even with Bitcoin sitting north of the 95th percentile of all-time prices. That makes my job very hard. Because with vol at this level, it is unlikely that you are going to be able to achieve the types of double-digit returns that my strategy would have had in the past. You have to fight very hard to find alpha that will even get you.
Yeah, but you're not answering the question. Over the last 6 months, what's your APY?
So year to date for, again, representative accounts, and I say representative because I manage SMAs, not a fund. Every account may have slight variations. But it's about 5% year to date. Now, this time last year, it would have been at least 250 basis points higher because vol was twice where it is today.
Right. Okay. Well, how about you, man? What sort of yields are you churning out?
Yeah, for Bitcoin staking, our first product with the 6.5 billion TVL, we're at the lower end. We're at about 50 bips. And we believe that the risk and reward are reflective of each other. staking, in our mind, is the least or the most risk-averse thing you can do right now in the crypto ecosystem. And therefore, the payout for that should be measurable and reflective of that.
And what's your Sharpe ratio?
We don't have a Sharpe ratio.
Should calculate one. It's easy to calculate.
There's no variance.
There's no variance.
The Sharpe is undefined. That's how good it is.
It depends if you lock it up for long term, because you can also get changing yields. We shouldn't apply a Sharpe ratio because our yields are so steady. Our Sharpe ratio for 2023 for our three main assets is between 9.6 and 10.3, which is insane because, like you don't apply it. But because you're in crypto, people want you to apply a Sharpe ratio, whether it makes sense or not. Anyway, to summarize, this is interesting because you have a really good spectrum here. You have 0.5% with something that is so stable, a Sharpe ratio in general terms doesn't even apply. You have what we're doing, which is like 4.5 annualized at the moment with a Sharpe ratio of 6. And then in the third corner, you've got a higher rate of return between 5 and 7.5% with a lower but still excellent Sharpe ratio of 2.5. So it's a really interesting spectrum. You can pick your poison in terms of what sort of yield you want. So now the $64 question really in this context is capacity. You don't have a lot of capacity constraints if you've got 6.5 TVL, because that's really good.
Yep.
I mean, it's huge. We don't have that. Do you have a capacity constraints?
Depends on the growing Bitcoin derivatives market liquidity, and that is a surprisingly salubrious picture. I think if you follow Bitcoin,
I like salubrious. That's
a good word.
That's
I had to get that in there. Somehow.
Yeah, I know you're doing 5-syllable words. I know.
Says the man in the paisley jacket. But in any case, yeah, I mean,
not exactly paisley.
Yeah, it's something like it. Bitcoin options market volumes per year have increased materially, both in dollar and Bitcoin terms, more or less as a secular trend. And this year, we are probably going to be at a multi-trillion-dollar annual volume across IBIT, the newer entrant, which has more or less, been a twofold increase to what Deribit was producing.
But that's a whole market. How about your strategy?
Yeah, well, that contributes to it, though. So I say that
of course, there's a context.
Way of meaning. I think that given where volumes traded are today, this type of strategy can accommodate in the single-digit billions of dollars equivalent, right? So tens of thousands of Bitcoin can be absorbed at current degrees of spreads and liquidity. And in fact, there are some large players out there that are running strategies like this on north of 10,000 Bitcoin.
Sure. Yeah, and for us, we have a capacity constraint. It's probably around $500 million before you start driving the return of the liquidity pools we allocate to. And as I said, same asset on either side, so we've never had an impermanent loss, but we don't have nearly the capacity that these gentlemen have. So what other good questions have investors asked you guys that we haven't discussed yet here? Liquidity, I can think of one. We have 6-hour liquidity. What's your guys' liquidity?
Again, depends by the managed account, but that's part of the beauty of the flexible arrangement. Liquidity could be as good as hours, right? If not minutes, within liquid, transparent, tradable vanilla
Does
options.
liquidity affect the rate of return?
Not really. I would say in some sense, better liquidity is consistent with decreasing volatility, which acts as a ceiling on returns. The achievable returns today are probably half of what they were a year ago based on levels of vol. But liquidity continues to improve. Vol seems to be finding a baseline. If you listen to Mr. Michael Saylor, which I think we should all do, his expectation is that Bitcoin volatility will be somewhere around 25 to 30% as a long-term horizon. Bitwise's long-term capital markets report on Bitcoin has foreseen similar things. I think that as long as there are large amounts of capital washing in and out of the market, it will keep it liquid, but it will probably also keep it sufficiently volatile to leave something for us poor portfolio
So you're still looking at perhaps up to into billions, single-digit billions for your specific strategy for the foreseeable future.
Yeah, and again, depending on what Bitcoin does, I like to think in Bitcoin terms. So let's say tens of thousands of units of Bitcoin. If Bitcoin is at $500,000, it's a lot more, obviously.
Yeah, got it. How about you, Boris?
Yeah, look, liquidity constraints on our end. I mean, well, when it's a little bit different with the staking protocol. I think the way you think about it is how quickly can you get your Bitcoin back once it's locked up? And the protocol is designed for T+2. It's actually 300 Bitcoin blocks. And that's a lot different than Ethereum because there's actually no entry or exit queues. This is a parameter that's set, T+2, 300 Bitcoin blocks. You click unstake, you will get your Bitcoin back. And that really works for a lot of ETF issuers and a lot of financial firms that need to have that T+2 settlement.
So you're really talking 48 hours?
48 hours.
Or 40-hour business hours, I suppose.
Exactly.
Interesting. Are you constrained over the weekend? Not a big deal. I'm just curious.
No, no constraints. This is all running on the Bitcoin network.
Yeah, okay.
So Bitcoin's 24/7, and so are we.
Right, all right. Interesting. Well, guys, we have to keep this short because somebody rudely intruded on our time before we got started. Any other last thoughts?
No, I think it's great that Boris brought up the withdrawal times on the Ethereum network, though, because the one thing that I would leave everyone with, especially coming on the heels of Michael Saylor's excellent pitch about infinite duration capital, duration is a measure of time. Time is proportional to variance. When you think about the type of yield that is achievable on your asset, especially if it's Bitcoin, you also have to think about how long it's committed for, what duration risks you are taking, and finding what we think of collectively here amongst us three as the maximum amount of return with, I would say, a reasonable bite size and duration. It can be both a friend and a foe.
Yep, I would say, look, Bitcoin is a $2 trillion asset class, and a lot of it's just sitting idle. It needs to be made more productive, right? Like any financial asset, efficiencies need to improve. And I think you have folks on this panel here today that are figuring out ways to make your Bitcoin more productive in order to generate some kind of income, some kind of returns. And that trend's only going to continue. Right now, Bitcoin is definitely in a bull market. And that appreciation is 50% per year, roughly, is what Mr. Saylor was saying. But at some point, like any economic cycle, there will be a flatline period or perhaps a down period where income generation and making those assets productive becomes very important to a lot of treasury companies as well. So that's something to keep in mind.
We've sort of made an assumption here that I'm not sure is worth a separate discussion or not, but that is someone's willing to surrender their Bitcoin, right? The three of us are really advocating something that's antithetical to my keys, my coins, because you may have multi-sig arrangements, you can do various arrangements depending on what the details of all three of our strategies are, but you have to cross the Rubicon, which has come up twice now today, to decide to not have physical, to the extent that applies, custody of your Bitcoin. And there are some people that are just not comfortable with that. I respect that. I know that. My response to most people is simply diversify. In fact, if you want to, don't use all three of these strategies and hold on to a good chunk of your BTC as well. Diversification is a key to almost any investment. But I agree with Boris. The idea of just sitting on Bitcoin, it's lovely during a bull market, which you've really experienced since November 15th, 2022, when FTX went down. We've been on an upward trajectory since then. But that's going to change. It's not always going to go up. And there are different assets as well besides Bitcoin that you can hold. It starts to make more and more sense to look for yield of some flavor. And you've got three really good examples, very different examples: derivative staking and yield farming, or allocation to liquidity pools, right here on the stage. It's worth thinking about, and if you want any more information, you guys can look on the agenda and get a hold of any of us.
I'll start with the first question. We've got about 10 minutes left here. One of the points I made to all three of you when we were briefing for this was, having worked at Mara with our sats per vbyte at 1, sometimes 2, the miners will say, well, taking all this Bitcoin off chain to go stake it somewhere or put it into some DeFi protocol is hurting the mining model. Now, since there's no way to get yield out of Bitcoin because Bitcoin doesn't have yield, having to take it off chain and park it, doesn't that hurt Bitcoin and help whatever protocol or Rubicon that you guys are working with?
I would say the exact opposite. I mean, we have clients who are Bitcoin miners, and they don't want to sell their BTC, and they'd rather earn yield on it, because that means ultimately when they do have to sell to fund operations, et cetera, they sell less. I don't know. What do you gentlemen think?
Yeah, look, we have a thesis that Bitcoin is the best asset class in the world, right? And people don't want to sell their Bitcoin. They want to accumulate more. And we also have a thesis that other crypto ecosystems might be around for the foreseeable future. So with Bitcoin staking, the Bitcoin's never leaving your wallet. It's never leaving the Bitcoin network. And you are earning yield in other assets or earning rewards in those other assets that you can then sell for more Bitcoin. So it's an accumulation strategy. So if anything, this increases the use of Bitcoin and the native use case of it and gives it more purchasing power.
Yeah, my comment there would be simply to say that when you do a derivatives trade and you take your Bitcoin and you move it from your own personal wallet, cold storage, custodial segregated wallet to what we think of as a tri-party wallet, a collateral vehicle, you're actually helping fulfill Bitcoin's promises, what Michael Saylor calls global digital capital. There are very few assets that you can very easily take and post as collateral in kind for a derivative transaction. Bitcoin is one of them. Even today, for large liquid precious metals, unless you are an extremely institutional actor, you can't take your bars of gold out of your safe and go hand them over to your bank with whom you trade an OTC gold options contract. Bitcoin is actually an exception to that rule, and allowing it to fulfill that purpose is a powerful component of its mission.
I'd also add something else in answer to it, which is it's peripheral, but I think it's a very important point, and that is particularly in the US, taxation. None of these strategies, notice this is staked, Bitcoin's not sold. You're using it as collateral, the Bitcoin's not sold. We're doing allocations of liquidity pools, the Bitcoin's not sold. One of the critical things is a lot of people, I'm sure sitting in this audience, have really low basis Bitcoin. Not only do you not want to sell it because you think it's going to appreciate, you don't want to sell it because you don't want to end up paying capital gains on all of that difference between the basis and the market price. None of these strategies, and yours in particular, is designed so you don't have to sell, because you could do your strategy a very different way, but it's far more tax efficient the way you're doing it. So just as an aside, that's an important consideration, and all three of the strategies, I can tell, very much take that into consideration.
Question for Tim and Boris, maybe a little bit more. What's the biggest barrier you're seeing to companies in the Bitcoin treasury space that may be hesitant about going on chain or putting capital in sort of a more blockchain-based setting than a traditional financial alternative?
Yeah, I think a lot of the companies we talk to that are more on the traditional side, right? They have they have a lot of hesitation in terms of deploying on chain. Part of it is regulatory, part of it is AML, KYC. Although lots of funds do get comfortable with us, and that's kind of how we did get to that $6.5 billion in TVL. But I would say it's mostly just understanding the technology, understanding where the risks may lie with it, especially if you're a traditional investor on the AML KYC side, and ultimately they all do get comfortable after conversation with us.
It's a really good question. If I were to put the statistics out about the investment, okay, 6-hour liquidity, no lockup, no fees going in, right? In Bitcoin, 4.5% a year, and no realized taxes with this Sharpe ratio. People would fall all over themselves giving us the Bitcoin. But then we had this, even the crypto native people, we had this one little 2-syllable word, and people start having second thoughts, and that is DeFi. And DeFi is interesting because the field of DeFi has become so incredibly broad. To me, it's not much of a limitation. It's almost a word without significant meaning because it is so broad. But there are a lot of people that are still concerned, and it's more of an abstract concern or an abstract fear about DeFi. Because if they get over that and look how we've structured everything, zero and permanent loss, and hundreds of thousands of transactions without a non-positive, or where every result was positive, some get comfortable with it, but some never get over the hump, oh, it's DeFi. I hope that answers the question.
Anybody else? Shout out to one of our sponsors, BitcoinYield.com, who just launched their website about a week ago. Jesus, are you in the room? Nope, probably out in the lobby, BitcoinYield.com. Boris, I can't wait until you and I can finally say to some of these kids, it's like, we've been in Bitcoin longer than you've been alive, right? It's coming. It's coming soon. Well, I think we can wrap this one up and get some time back here. Thank you three very much.
Thank you all very much.
Hello, I'm Theo Chapman. I'm from Babylon Labs, and today I'm doing a 3-minute lightning talk on Bitcoin as trust as collateral. So Bitcoin is sound, hard money, perfect money. And today 99% of Bitcoin sits idle. At Babylon, our mission is to enable that Bitcoin to be used as trustless and productive collateral without ever leaving the Bitcoin network, adding more color onto what Boris was just talking about on stage now. And over long time periods, idle assets tend to lose value relative to productive assets if it's the same asset. And today, if you want utility on your Bitcoin, you have to go through, well, if you're borrowing against your Bitcoin and you want utility on it, to borrow stable coins, for example, you have to go through centralized wrappers such as WBTC or Coinbase BTC. And that introduces counterparty risk, which goes against one of the core ethoses of Bitcoin, which is don't trust, verify. And so at Babylon, we are creating native use cases of Bitcoin. The current native use cases of Bitcoin to date have been either paying with it or holding with it. And the non-native use cases of Bitcoin are either lending it or bridging it. We've innovated 2 new native use cases on Bitcoin, which include staking it and borrowing against it. And this isn't just theory. There's clear demand in the market for productive use cases. Around $6.6 billion worth of Bitcoin has been locked in the Babylon Bitcoin staking protocol. So there's clear signal for the market for this, and we're going to continue to build these types of trustless products on top of Bitcoin. Many institutions are engaging with our protocols, ranging from ETF issuers, miners, custodians, funds, family offices, etc. And last month, we introduced Bitcoin trustless vaults and released a white paper. And over the coming months, we'll be working on this protocol and pushing this protocol to production. Now, this will enable many native new use cases on top of Bitcoin, such as Bitcoin-backed stablecoins, derivatives, and also borrowing against it, which I mentioned earlier. So we believe that Bitcoin deserves to be classified as good collateral, and we'll continue to work to this end. Thank you very much.
Belgravia Hartford is one of Canada's exclusive Bitcoin treasury companies with a 100% focus on owning only Bitcoin. Belgravia has built a very comprehensive and transparent website which outlines its stats, its Bitcoin position, and every aspect of the company and our future goals.
This fall at the Space in Denver, asset managers, VC firms, RIAs, and tax accountants will gather for the Bitcoin for Financial Services Summit. Learn why Bitcoin is different from every other digital asset. Hear from leading partners on custody for individuals and businesses, insurance, estate planning, and tax strategies. You'll have a chance to build direct relationships with speakers and sponsors. The event includes 2 days of programming, plus golf, wine, and bourbon tastings. Get your ticket today, and we'll see you in October.
Hello, everyone. I'm Megs. I advise DDC Enterprise. We've got an exciting session for you. So, corporate Bitcoin treasuries are accelerating in terms of the amount of Bitcoin they're consuming. There's been a paradigm shift in how companies view digital assets in terms of treasuries. But that is going to raise, I think, a provocative question. In the pursuit of setting up a strategic reserve, does a company's core operating business act as a powerful differentiator among all the treasury companies out there, or is it a distraction, diverting focus from the asymmetric gains that Bitcoin has? This panel is going to dive into that, and I'm excited to bring forward our panelists. We have Dean Callis, Jim Dora, and Norma Chu. Please welcome our speakers. Thank you.
Hi, everybody. I'm Norma Chu. I'm the founder and CEO of DDC. I'm an entrepreneur and operator. I've been building this business for about 13 years. I started the company as a content creator, building communities around cooking. And over the years, kind of expanded the business from cooking content to content commerce, and later on, going into consumer business. We're listed on the New York Stock Exchange in 2023. And we adopted the Bitcoin strategy earlier this year in May. And I just want to share with you my experience as an operator, and we communicate with the investor community all the time. What I see, how they value having an operating business or not. Earlier this year, when we first launched in go-to-market, I started meeting with a lot of investors. We did our fundraise around June, which was a fantastic time to raise. At that time, we were having a lot of conversation with investors. Nobody cared about whether we had an operating business or what we actually do, which is fair. There's always the right time for the right conversation. And then I think right now, in the past 3 months, the market has shifted, especially after August. We see some turns in terms of sentiment, with some MNAV compression. And now when I have conversation with investors and also retail analysts, a lot more attention goes into our underlying business. We're very fortunate. We are growing. We are profitable. We generate millions of net profits every year. And so I think analysts and investors now are looking into all these different treasury companies that they can select from, and really thinking about during different cycles, how do these companies differentiate ourselves and continue to operate, right? If we want to do this, we're definitely in this for the long term, and cycles come and go. We're definitely going to see fund flows coming in and out of this sector. I think when in the scenario where capital markets potentially shut off for a period of time for Bitcoin treasury companies to raise as easily as they did before, what we can do as an operating company is we continue to operate, continue to grow the business and generate profits. And we can also continue to stack Bitcoin with our free cash flow and also be around for a very long time. So when the market comes back, we can once again raise more money, raise more capital, and continue stacking. So I think, coming back to the main topic for today, in my opinion, I don't think having an operating business is a distraction. It's definitely not even a must, but I think it's a good foundation for a Bitcoin treasury company.
Sure. Hi, so I'm Dean Callis. I'm the CEO of American Holdco. Many of you in the audience may know me as one of the founders of Next Layer Capital as well. American Holdco is an institutional-grade Bitcoin-backed holding company that acquires Bitcoin and also selectively acquires cash-flowing, durable companies and takes those cash flows and puts it into the balance sheet in Bitcoin. I completely agree with you, Norma. The point of a Bitcoin treasury company is to always be accumulating Bitcoin, right? And capital markets environments, as a former capital markets banker, as a former tech M&A banker and hedge fund guy, capital markets environments shift from time to time. And you want to be able to continue to buy Bitcoin in that environment when that capital markets window is closed. So if you don't have a strong operating company,
with durable cash flows, you're not going to be able to do anything. You're going to be sitting there. And I would expect that for some Bitcoin treasury companies with no underlying operating company, we're going to see consolidation, right? Larger Bitcoin treasury companies that do maintain a premium are going to acquire Bitcoin treasury companies that trade, at a discount. And we're already starting to see some trade at a discount. So I think the operating company is not a distraction. It's an advantage, but not all operating companies are created equal, right? So it's important that you have a strong, durable, cash flowing company, high cash flow conversion with minimal leverage.
Thank you, Dean. I'm Jim Dora from Traxel, CEO. We are a French listed company, a fintech. I've been acting in the payment industry since 20 years. So my point is, of course, that we are not a distraction when we do business. I want to come back to a story of a company. Like they have been doing like 20 years of profit, sometime more than 100 million. And this decided on 2020 to go on Bitcoin, so meet MicroStrategy. So I think the foundation, what you say, is the word. You can build on foundation. It's a good point. If you already have operating business, then it's good to leverage on it. And actually, when you have foundations, you can thrive through any kind of cycle. That's the point. I mean, eventually, bear market will arrive, and they're going to be cycle. So at some point, you need to be able to continue accumulating. That will be the good time, actually, to accumulate. If you don't have operating business, at some point, you need to find money to continue operating. Or you're going to have to grind your Bitcoin, which is not good. So I think operating business and having profit can actually fuel during the bad times. I think there's also other points that may look out. So I'm going to talk about the not so fun topic, which is regulation. I have a question that remains open for me, and we are able to answer on our side because we are a financial institution, the first financial institution in Europe to being a BTC Treasury company. We're just starting, by the way. It's how do you differentiate a public company which is leverage money from investor, public, private, to invest in Bitcoin to an actual investment fund? That's a regulation question that is under scrutiny for many regulators. I know that jurisdiction is different. And so I'm going to finish this topic because it's a question which is open and a very hot topic in many places. And I think we have the solution because, I mean, we have been in the payment industry, so it just makes sense to buy Bitcoin. We have the network, we have the reserve. We're going to put everything on the reserve of Bitcoin. So it just seems like the bank of the future. I don't know if it's an insult or not, but that's how we see it. So to conclude, for me, I would say that the real distraction would be for probably operating business, not investing in Bitcoin, ignoring Bitcoins. But also, and it might be a bit controversial, BTC Treasury, chasing the bulls and not prepare for the bear market. That's something very important. I don't know if there's any questions.
Maybe I'll add a thought to that. Just be a devil's advocate. So I did say having an operating business is not a distraction. It doesn't have to be a must. It's a good foundation for a Bitcoin treasury company. But I think there are different types of operating companies out there, like as you mentioned, Dean. One thing is like we're an operator. I run the business for 13 years. You run it for 25 years. But there are other Bitcoin treasury companies out there where they have a group of investors taking over an existing company, like through an RTO, and then they launch a treasury company business. I think in those scenarios, I won't say it's a distraction, but I think it makes the integration much harder. I'm not sure if you've gone through M&As, Jim, but I've done a couple M&As in my in my career at DDC. I think it's a lot of ideas sounds really great on paper, and you crunch the numbers, you're like, this is going to be fantastic. But a lot of times with integration, especially with people, where you have crypto investors coming into an operating company, and that operating company can be in healthcare, software, any kind of sector. I think it's the integration of people and culture that's really going to test whether that RTO or their newly launched Bitcoin Treasury company is going to succeed in the long run.
Yeah, totally agree.
Yeah, I couldn't agree more. And I think we're going to start to see more of a focus on quality and credibility of management teams that are running Bitcoin Treasury companies, right? I think the ability and background to do complex M&A transactions, to be capital markets experts, right? To be experts in an underlying industry where you might make an acquisition, to have real operators. Those are the things that are going to differentiate a Bitcoin Treasury company and allow them to navigate markets when they become challenging, right? So I agree with you.
Dean, tell us a little bit more about American Holdco and your specific plans, because I know you're really thinking, well, no, maybe not specific, but that M&A side of it, I struggle with that. Because when you look at acquiring a company that their MNAV is over 1.5 or something, why wouldn't you just stay focused on your Bitcoin acquisition strategy and not take on that whole M&A headache?
It's a great question. I'm limited to what I can say publicly around what we're doing. But I think taking a step back and thinking about it philosophically, what you want to be able to do, okay, is you want to be able to acquire cash flow very accretively when, in addition to acquiring Bitcoin, and then you want to be able to, in that M&A transaction, preserve leverage capacity as much as you possibly can, so that you have a maximum amount of free cash flow coming into the company and coming into the treasury, okay? And then what you can do from there is you can obviously lever that free cash flow or utilize that free cash flow to support coupon payments on new credit instruments that I think obviously Mr. Saylor and Matt Cole talked very eloquently about. You can use the cash flow from the company to support the coupon payments on a fixed income instrument, use that fixed instrument proceeds to buy Bitcoin very aggressively. And depending on the underlying company that you're buying and the valuation and the structure of that deal, you're actually creating an ARB on an ARB in a way where you're going to be able to buy more Bitcoin through the M&A and then credit instrument than if you were to just hit an ATM and buy Bitcoin directly with the cash proceeds from the ATM.
Hi, John Tunison of Giga Inc. My question has to do with how you make capital allocation decisions. So when you have free cash flow, how do you make the decision whether to reinvest in your underlying operating business versus buying more Bitcoin?
So I guess the question is the balance of how you're going to invest with your own funds on Bitcoin? Yeah?
Yes, that's correct, with your own operating cash flows.
So the idea is like you want to stick to a strategy. So we have a kind of a smart DCA, and we're trying to look at various parameters, which will be like the cash flow of the company, the underlying business, and also the volatility of the Bitcoin, the opportunity. We mix all that, and that allows us to take some risk, but not inconsiderate risk based on this formula.
Yeah, maybe just to piggyback on that, I think it's actually a relatively simple answer, right? 9 times out of 10, you're going to take the free cash flows and buy Bitcoin or use leverage to buy Bitcoin, right? I think the only cash flow you would potentially allocate to the underlying business is, pure maintenance to make sure that that cash flow can be permanent, right? Or if there is some growth initiative that can beat the hurdle rate of Bitcoin. The reality is that's not going to be true for most businesses. And so the optimal choice from a capital allocation perspective is to allocate to more Bitcoin or leverage for more Bitcoin.
Something I've been asking myself a lot lately is also, when GameStop borrowed all that money and never bought any Bitcoin, but if they would have activated all the apes, what would that have done, for them coming into Bitcoin? What if Waste Management decided to become a Bitcoin treasury company? How many people get excited about trash pickup, right? Norma's clearly got a business with a loyal following. She's got that group already built. The MetaPlanet, it wasn't just the people that stayed at the hotel, right? They were able to activate this other thing. Tim and I get emails all the time, like, hey, we want to become a Bitcoin treasury. What's your underlying business? We do online cosmetics. We really hate it, but we want to get into Bitcoin treasury. And so I'm curious if there's a point at which some of these very popular companies, a Tesla, a GameStop, they have I guess it wouldn't be an unfair advantage, but they would have an advantage in that they have an already activated investor base. That part of the underlying business gives them a definite advantage in executing the treasury strategy.
I think that's fair, but I'll take the flip side of the argument. I'll take the Waste Management example. That's an awesome company, right? They are permanent. Trash pickup is going to happen every single day. For me, it's Mondays and it's Thursdays, right? That is a permanent cash flow stream that you can use as an annuity to buy Bitcoin, or again, to support coupon payments to buy more Bitcoin with leverage. So I think that's the perfect type of business that should really be Bitcoinized, right? And I think we'll continue to see, as time progresses and we see hyper-Bitcoinization, companies like that wind up adopting a Bitcoin treasury strategy or be acquired by a established, scaled Bitcoin treasury company, right? If you look at, let's say, the private equity industry, which is over 10 trillion of assets, right? 3.5 trillion of unrealized AUM on their balance sheets. These are a bunch of private cash flowing companies that were acquired at 0 interest rates, and they're stuck in these private equity portfolios, right? What are those private equity firms going to do with those portfolio companies? What they really should do to enhance the return profile is buy Bitcoin, right? Or sell them to a Bitcoin treasury company and take stock. So I think that boring old niche businesses that have reliable cash flows are a perfect vessel to basically create a Bitcoin mining machine. It's financial mining of Bitcoin.
Well, I think also, like Ed, the ultimate vision and North Star here is that every single listed company, private company, ultimately becomes a Bitcoin treasury company, and they will all have Bitcoin on their balance sheet. I think for us right now, there's still advantage because, like Michael said, we are in year 1. I think our advantage is that we are the first movers in the space, and we do welcome more companies to come into this sector, and so it becomes more mature, and we can develop and grow faster together.
Yeah, I guess how I see it, it's like there's those big companies. They already have a very big operational business, so they might be afraid to jump into bitcoins and have the stock moving with the bitcoins. So for smaller operating business, that's a real opportunity because we know that we can fuel with the operating business. We don't need money, and that money can be invested in that strategy. And we are the vehicle of the future. So I guess for big companies, they can compete, but it's not exactly the same strategy that they're going to apply. It's more corporate finance, I would guess.
We'll do one last question. I'll put you on the spot here. Shirish Jajodia of Strategy in his presentation at Bitcoin for Corporations, I think in Nashville, showed this framework for what kind of companies fit the model, right? And it was no debt, positive cash flow. I'm stumbling on it right now, but it was this criteria that said this is the kind of company, the growth that, and a company that has $150 billion in debt, there's just no point, right? And that's a zombie company. So here on this stage, September 17th, who's your Fortune 100 company? Who's going to be the Fortune 100 company that's going to pull the trigger? Come on, somebody's got to bite. Pick one. Danone? God, they're not even going to bite.
Yeah, what was your pick? I know what your pick was. You told me.
Yeah, Delta Airlines.
Yeah.
Just because I live in Atlanta and I'd love to
I don't
be
know.
able to fly free everywhere.
It's interesting. I mean, airlines are
They're
a
not
tough
gonna do
industry.
it, but-
Maybe Bitcoin saves them.
Michael, who is it? Who's the first Fortune 100 that's going to do it? Yep, that's what I thought you'd say.
I think maybe an interesting one, just maybe to speculate for the sake of it. I think an oil and gas company would be really interesting, right? We're going to continue to, need more oil, need more energy, data centers, AI, et cetera. They have commodity price volatility. If you think about an oil and gas company, they're great cash flowing companies, especially the large ones. So I would think a Fortune 100 oil and gas company might be really interesting. If you think about commodity prices peak, the revenues peak, their cash flows peak, what do they do in that quarter, right? The stock price peaks, what do they do in that quarter? They pay a special dividend of extra cash out, but then they usually also max out their stock buyback program. To me, that's like the stupidest capital allocation decision that you could ever make, because you're maxing out your stock buyback at the peak share price. They should take all of those stock buyback dollars and put them into Bitcoin. So that could be pretty interesting.
Anybody want to shout one out? Be on the record? Nope. But Tesla is. Is Tesla a Bitcoin treasury company? No? If Apple bought one Bitcoin, are they now a Bitcoin treasury company?
I thought they were on the table.
Thank you guys very much.
Oh, thank you.
Thank you. Okay, we're going to have a 15-minute break. 15-minute break. Please be back in 15 minutes, and then we'll finish up the day with 4 amazing sessions. Please be back in 15 minutes.
All right, well, we'll start again in 1 minute. If everyone can come in, who's interested? We have an amazing panel coming up. I don't think they can hear me in the lobby. But I can tell all of you it's going to be great. We love you too, Tim. All right, that's going to be a shout out to Tim during this intro right there. I was planning that anyway. All right, people are making their way in. Please grab a seat. And I think we're about ready to get started with the introduction of this amazing panel coming up. First of all, I want to say, and I'm sure all of you have experienced that, the level of brain power here at this event today, I think is mind-blowing. And also the capital represented amongst this relatively small group of people is also mind-blowing. So I want to give a shout out to Tim, Ed, and Adrian for putting this together. If we can just give them a hand, please. So what is really important in this space for these treasury companies is to have a multiple net asset value so they can run the ATM and arbitrage the price difference between the stock and the assets they have. It's very accretive, it's very helpful, and that's something they're all striving to achieve. It's an interesting point of time in the market for sure, but still there's a lot of Bitcoin being bought and companies are putting more and more Bitcoin on their balance sheet, even during times like this. Next up, to talk about this topic, an amazing panel, which we'll start with CJ from Strategy. Please make your way. Big hand, please. Adrian Morris from True North. And Ben Workman from Swan. Please give them a big round of applause. Thank you.
Hello. Awesome. Thank you so much for that introduction. Great to be here. Just thank you again to Tim, Ed, and Adrian for organizing this event. It's amazing. Honored to be up on stage with Ben and Adrian. Just as a side note, your initial appearances on Quant Pros was very influential in my journey of hustling my way into strategy. So thank you for that, and thank you to Jeff and Ryan as well. So MNAV and Bitcoin KPIs, I'll share a few quick comments, and then I guess we can go around. Perhaps I'll just start with what I think is the true measure of success for a Bitcoin treasury company. Then what is MNAV? When should MNAV trade above 1x? What could be the reasons? And third, how could you actually think of a valuation framework for MNAV and actually quantify and derive MNAV? So the measure of success for a Bitcoin treasury company, I think it's pretty obvious. It's outperformance relative to Bitcoin. But I think what's lost on few people is that it's outperformance over the long term. Many people look at the one-day price movement of Bitcoin or 1 week, 1 month, 6 months, and come to a conclusion that the Bitcoin treasury company is not generating 2x the performance of Bitcoin. But that's not what the stock is designed to do. A daily levered ETF would give you, 1.5x or 2x the performance of Bitcoin on a daily basis, but actually not track that over 1 year or 2 years or 3 years, because if the underlying Bitcoin is volatile, then there's some decay and they actually don't generate the 2x outperformance. It's the opposite with Bitcoin treasury companies, where you might not necessarily outperform in like a 1 week, 1 month, 6 month time frame, but over like a whole cycle, 3 years, 4 years, 5 years, you would see that 1.5x to 2x outperformance as long as the company and the management team execute correctly. So that's one comment. And then on MNAV, perhaps you all know MNAV is, at least at Strategy, we define it as the ratio of enterprise value to Bitcoin holdings. Enterprise value would be the sum of book value of debt, book value of preferred equity, and then the market value of common equity. And if this is above 1, then it's in the best interest of the company to issue additional equity and buy Bitcoin with it, capture that spread in the valuation, and increase the Bitcoin per share and generate what we call Bitcoin yield. And if you take an extreme scenario and you assume that a company has a 1x MNAV, so there's no premium, it's valued at its Bitcoin holdings, and there is no debt on the balance sheet, there's no fixed income, no leverage, it's 100% equity funded, then you could argue that it just gets stuck over there at 1x. And it may not, have the ability to do this common equity ATM, accretive dilution. But as soon as you introduce any leverage into that system, into the balance sheet, and the cost of that leverage is lower than the anticipated return in Bitcoin, then the Bitcoin assets will grow, the debt will accrete at a smaller rate than that, and then the equity would outperform the growth rate in Bitcoin. So the equity, the book value of equity would appreciate at a faster rate than the appreciation of Bitcoin assets. If you assume the cost of equity is Bitcoin, like Bitcoin is the hurdle rate, and it's appreciating faster than Bitcoin, then it should trade at a premium. And then if it does trade at a premium, you can go out, issue common equity, and kickstart that engine. But the basic premise for trading at a premium is having that intelligent leverage in the system and arbitraging that fiat cost with the Bitcoin sort of price potential. And then last, very quickly on just like how would you value a company, or how can you actually quantify MNAV or come up with some framework? In our Q2 earnings call for strategy, we came up with a new Bitcoin KPI called BTC factor, which is something we've defined as the ratio of Bitcoin per share at the end of a 10-year time period to the starting Bitcoin per share. So how much does Bitcoin per share actually increase over 10 years? And you can come up with your own assumptions over here. It would be subjective, depending upon your view of Bitcoin, the price appreciation, and then how much leverage would a company take, what would be the cost of the leverage. And when you model this out and you come up with an answer of, let's say, 30% Bitcoin price appreciation, 8 to 10% cost of leverage, and 30% leverage each year, the math would somewhat spit out 2.5x to 3x Bitcoin factor. And the increase in Bitcoin per share is basically 2.5x to 3x over 10 years. And the reason I'm describing all this is because this BTC factor could be thought of as some floor for MNAV today. Because if you say in the worst case scenario, if MNAV today is 3x and compresses down to 1x, which is the worst case, it would still have been offset by a 3x increase in Bitcoin per share. And the performance of the stock would have tracked Bitcoin. If it doesn't compress all the way down to 1x, it would have actually outperformed Bitcoin. So I think coming up with long-term views on how much Bitcoin per share can increase by having assumptions on Bitcoin price and leverage is what can sort of guide you towards what a fair MNAV for a company may be. So, happy to dig into this a bit more, but I'll pass it off to Adrian.
Sure. Everyone hearing me okay? Good? Better? Awesome. So, I think that MNAV is one of the most counterintuitive aspects of Bitcoin Treasury companies, and I say that for a few reasons. As CJ just laid out, you have the metrics. You have the metrics that can be essentially derived from MNAV. You have new metrics that you can create, trying to create a framework for understanding MNAV. But for me, the reason why I think it's counterintuitive is because I view MNAV as a measure of market sentiment. Any kind of net asset value or valuation above what I like to say a framework of 1 is essentially anything on top of that represents market sentiment. It is a forward-looking assessment on the market, whether that is in the case of a Bitcoin Treasury company, that can be forward-looking expectations about Bitcoin yield, forward expectations about Bitcoin per share, Bitcoin gain, what have you. That premium the market is paying, that volatility that the equity sees is representative of market sentiment. And I think that is something that people have a hard time assessing, because you could have a point-in-time view of what a floor for MNAV is based on current performance, but projecting it into the future becomes, in my view, very difficult because it is strongly driven, if not entirely driven, by market sentiment. That is why the market is paying that premium. They are assuming that the stock will outperform, and they're willing to pay for that performance today for our performance tomorrow. And a lot of the conversations that you see online, people are trying to treat MNAV as a lever that can be manipulated up and down, but I don't think that's the case. I think what really will push MNAV is corporate execution, the overall strategy, the amount of net asset value a company has. So in the case of strategy, they'll likely have the largest net asset value of any Bitcoin treasury company. All of those factors are what determines what premium the market is willing to pay today and what they will pay tomorrow. And however else strategy decides to leverage their balance sheet in the future. That can be through additional preferreds. That can be through additional offerings to the market that they haven't yet conceived of yet. I think that MNAV is going to represent the market's view around Bitcoin. It's going to represent the market's view around the equity, and it's going to represent the market's view around how that particular company can leverage their Bitcoin in the future. If I had to distill it down to 3 primary factors, those would be the 3. And what we're going to see, I think, in the coming months and years is MNAV is going to waver up and down. It's going to go up and down based upon that market assessment, that market sentiment, that forward-looking projection of what the market thinks these Bitcoin treasury companies can do. But I also think that people perhaps need to focus less on what the MNAV is today and understand that they're making, in my view, a directional bet on Bitcoin, and in some ways a directional bet on Bitcoin adoption and market psychology around these Bitcoin equities. If we are all correct that the number of Bitcoin equities are going to increase exponentially over the next however many years, it stands to reason that the multiples are going to expand as well when they become more accepted in the market. So as such, MNAV to me represents market sentiment, and MNAV to me represents just one of the aspects that I use to judge a company in the current day, but I don't use it to judge or make any investment decisions around it. I'm looking at execution, I'm looking at strategy, I'm looking at methodology, I'm looking at the framework that the particular Bitcoin treasury has. MNAV for me is important, but it's not the driving factor in my investment decisions.
I think that there's an acknowledgement that needs to be made that there's a separation that happens in metrics as a strategy starts to evolve. You've got the management metrics that you want the management team to focus on that's going to drive the value to the strategy. Those are things like Bitcoin yield, Bitcoin per share. You want them to take the actions that are going to build the foundation. When we start talking about things like MNAV, I don't actually dislike the conversation around MNAV. And the reason is I think it serves a purpose as an anchoring point. When you're trying to evaluate an entire new sector out there in the market, investors quickly have to try to adapt themselves to figure out, how do I find value within this sector? And I think that that's one of the natural ways when you've got a corporation who's got a strategy of accumulating Bitcoin over a long period of time, is that they want to look across that ecosystem and say, if I had a starting point I could anchor to, what does that look like? And where the market is settled is on the net asset value of the Bitcoin, effectively. From there, to your point, there's a lot of different factors that are going to play into whether you get MNAV expansion or contraction. And that's also a function of these corporations outperforming Bitcoin and underperforming Bitcoin during periods due to the leverage that these corporations are taking on. And I think that one of the things that's become very difficult out there in the market is we've evolved a little bit with the entire treasury phenomenon where Bitcoin investing has crossed over with equity investing. Bitcoin, the investors that were investing in Bitcoin always had long-term time horizons. But equity investors typically have much shorter time horizons. There's a lot of trading activity that's happening out there in the market, and there's a lot of people that either have time-bound positions or they're trying to time certain market events. And so there's a lot of different reasons for entry points into equities. So I think what you're seeing right now is the confluence of 2 different investing styles. Bitcoiners, we've preached forever, Bitcoin's going to outperform everything on a decades-long time frame. But what we're starting to do with all the new metrics that are entering the market is we're trying to find way to prescribe valuations on short time frames. Right? There's been a lot of talk about things like days to cover and all these, and I think those actually serve a lot of utility in this market because the benefit of what we have, as we now have 190 companies with Bitcoin on the balance sheet, not all of them are running the active treasury strategy, is you now have the ability for people to segment their investments. They get to view these companies in different categories. So if you looked at traditional equities and you think about value plays, clearly there's only maybe one, you could argue two, that people would probably consider value plays in the Bitcoin Treasury space. A lot of the other ones are just emerging, right? This year has been massive for Bitcoin Treasury companies coming out to the market, and because of that, it leaves investors grappling with who has the competitive advantage? What is the long-term strategy going to be here that's going to build that Bitcoin per share? And I think that one of the things I saw that went to the side was I stopped seeing any discussions about the leverage. There's been this race to accumulate Bitcoin, but because of that, it's happened using primarily equity raising tools to get out of the gate and achieve scale, which is understandable. But what that starts to skip is the benefit of putting leverage on that balance sheet. If Bitcoin starts to run away from you today and you have no leverage applied to your balance sheet on that Bitcoin, you likely shouldn't outperform Bitcoin in any meaningful way. However, if you go out and you apply an intelligent amount of leverage, right? I'm not saying you need to go get reckless, and I do think that ultimately we'll see companies try to compete heavily on volatility with really high leverage. But if you put on a 20% or a 30% leverage ratio, depending on what type of credit instruments you're putting on your balance sheet or whatever it is you're issuing to raise Bitcoin, that's what's going to create your outperformance ultimately. It's managing that. And that leverage, you really need to be focused on having these management teams hyper-focused on accumulating Bitcoin, building the NAV on the balance sheet, which creates the capacity to go and put on that leverage, whether it's through digital credit instruments or convertible bonds or whatever that company chooses to do. They need to build that NAV to continue to expand that ability to issue those instruments to keep leverage on the balance sheet. So I think MNAV is going to be a constantly evolving conversation. I'm not going to sit up here and say that I've cracked the code on MNAV. I don't think anybody has. I think we're all still in this period where we're adjusting to a new type of corporate strategy. And because of that, we're going to have to find ways that we're going to differentiate amongst these different companies. And some are going to get greater premiums than others, depending on how confident the market feels in their capability to go out and raise, to keep leverage on, and to build that Bitcoin balance where they can take advantage of that compound annual growth rate of Bitcoin relative to what they're issuing.
So I was just over there sitting with Mason, and he looked really confused, and he turned to me, and he just said, "When Lambo?"
I'm surprised Mason doesn't have 2 or 3 already, so you might have to ask him that question first.
Yeah. Does anybody have a question? Anybody in the room? Anybody at all want to talk about this? Do we have anybody? There's 1, 2, 3. Nothing? Wow, we silenced him.
Earlier this year, there was a situation where a company, I won't name them, they put out MNAV guidance, and then they seemed to walk it back a little bit or adjust it. What do you think about the way that companies should communicate about their own MNAV with the market?
Who's that one for? Is it for either of us?
Should I go first?
Go for it. No,
yeah.
go ahead.
So yeah, I also heard about this one company that put out some MNAV guidance. My understanding was that, internally at Strategy, we've always had thresholds based on which we decide whether it's accretive for us to be selling equity and buying Bitcoin. And we've always stuck by those thresholds. We've changed them and adjusted them based on how the market evolves. And after a lot of internal deliberation for multiple quarters, we came to a conclusion that we should perhaps communicate that to the market. And it's in the best interest to put that narrative out, to also give a bit of a jolt to the stock and bring some more upside volatility into it, bring in more leverage into the options market, get more options traders into the stock, because there was perhaps some demotivation happening with the volatility falling and just the narrative that was building up. So that was the initial thought process. And then what we saw as a reaction to it was a divergence in what the perhaps retail trading community felt, which is perhaps the more powerful dominant voice on Twitter and X, and the larger investors, where perhaps the retail community was a bit happier. They got some sort of benchmarks they could tie themselves to and come up with trading strategies. But the larger investors, the equity investors, thought that we were perhaps limiting ourselves and boxing ourselves out of a very accretive, powerful engine, while the preferreds are still maturing and are in their maybe adoption phase. And that it made more sense to just have the optionality and just keep that engine going. And so, that's why we decided in 2 weeks or 3 weeks that we would perhaps tweak it, adjust it, and retain the flexibility, retain the optionality, and most importantly, act with agility. Like we pride ourselves in being a company, having a management team that understands the market very well, listens to investors very well, and then reacts quickly. So that was like the broad reason why this happened. And on communicating MNAV thresholds, I don't know, I'll perhaps pass that over to Ben and Adrian as well to share their thoughts for other companies or strategy. Yeah.
So with regards to the MNAV guidance, my view on it is, I'm going to try to give it in a quick 1 minute here. So back to my point about MNAV being a representation of market sentiment, I think CJ just kind of hit on it. He saw a divergence. He saw the divergence in the market, right? You have the retail community that was happy. You have the larger holders that were unhappy. Those are the two very large players in the market, representing two very, very different views of what the MNAV guidance represented and what it should represent. I think that kind of also to Ben's point that we're going to be seeing these trades evolve, because I think there still is a broad disconnect in the market. If you take a look at before earnings last quarter, a lot of people were calling for negative EPS when, quite frankly, strategy was not negative EPS. That says to me that a large segment of the market is still, unfortunately, discounting the Bitcoin business. Now, that isn't a negative. That's just my perception of it. So with regards to MNAV being representative of market sentiment, from my view, I think it'll be very difficult for a company to issue set guidance on MNAV thresholds. I understand having them internally, but I think that doing it again will require perhaps a more flexible approach, and that allows them to adjust to the market just like strategy just had to. You cannot say, in my view, again, that the guidance is going to be here, but the market must take you above that in order to issue, and you can't, if you are below that for any particular period of time, you are kind of boxing yourself in somewhat. So I think that it's going to require a lot of adaptability and a lot of flexibility with regards to how companies handle MNAV guidance going forward.
Yeah, I think you have to be ready for the market cycle you don't predict. And if you start to take away the tools you have to operate in conditions you may not have had to operate in before, I think you're doing yourself and potentially even your shareholders a disservice if you get pinned by your own guidance. And while I understand the desire for that level of granular transparency, I also think that when you put that type of guidance out and you make it really concrete, you're giving potentially institutional investors a way to directly trade your stock. If they know exactly how you're going to act at a specific threshold, they've got the capability to take advantage of that and potentially manipulate it around there. And I don't know that you necessarily want that. I think you want some of that volatility to be out there because they don't know exactly what you're going to do at that point in time. You may issue guidance saying this is what we intend to do, but we want to remain flexible so that we don't give up some of our most powerful tools in the event we find ourselves in a position in the market where we absolutely need to pull that lever.
Last question, 2 minutes.
No, not a 2-minute question.
Gotcha. I appreciate your phrasing, application of responsible amount of leverage. My question is, instead of additional issuance and things along those lines, what role might you see for Bitcoin derivatives in terms of applying leverage, very easy to do, or risk mitigation, or income generation, easy to put on, easy to take off? Seems like a lighter lift and can be more dynamic and reactive based on changing conditions, sentiments, what the investor base wants, etc. Any comments there?
Are you speaking more around putting hedges on using derivatives as a corporation?
No, more so there's a multitude of strategies you can employ above and beyond sort of vanilla call writing to generate income, right? You can do spreads, replacement trades, sell your Bitcoin, buy forwards, maintain your delta to the market, and put that additional freed up cash to use in any number of ways, etc. Just seems like a lighter, faster move than, say, more M&A or instrument issuance.
I liked something that I heard Michael say at the Bitwise event not too long ago, which was, if I start operating in a way that the market isn't prepared for, I take an opportunity away from somebody else to participate in this ecosystem. I think when you're building one of these companies and you're building it out for scale, sometimes you do need to keep things very simple and understandable for the market. It's what allows people to build the ecosystem around you that ultimately drives a lot of that liquidity into your equity. So for instance, you go out and you look at all the ETFs that have launched, and you've got the MSTYs and the IMSTs and all these different funds that have launched. That brings huge benefits into any equity. And that's because they know how strategy is going to execute, right? They've told the market exactly what they're going to do, and they stick to that. I think if you start bringing in complexity, particularly trying to get the market to digest the usage of different derivatives and different derivative strategies, you're going to bring a significant amount of confusion out there, which might cause people to shy away from that. They want things they can understand, and if they're building towards a long-term thesis, they want to know that you have a singular focus that you're going to execute towards, and they're going to know exactly how you plan to do that. So I'm not saying someone won't do that. I think that there's going to be a huge amount of flavors of these treasury companies. Strategy's one, they were the leader. Our group, we've gotten the feedback before that we don't cover enough of the other companies, and part of that is because we're following the first mover. We're following the company that has innovated at the beginning, but that's not to say it's going to be the only way. I think there's a flavor of that strategy that a lot of investors would really like. And you're going to find that pocket of investors that may support you as you go down that path. If you're trying to reach the massive scale, I think you have to be really focused on what is actually going to build liquidity in your equity so that you can operate at a level that most other companies can't. Doesn't mean there won't be specialized companies that are going to do something different than them, though.
Thank you, gentlemen. And CJ, you need to get some of these shoes. I heard you can get them online.
Yeah, I'm going to paint them orange tomorrow,
Okay.
but they all ran out online.
Thank you, guys. Thank you very much.
Thank you.
I just told I have 3 minutes to make accounting sound exciting, so here we go. Thank you. So I'm a Bitcoiner. I'd like to consider myself a Bitcoiner, and I thought about this, that there are 3 ways that I've made it as a Bitcoiner. 1 is a picture with Michael Saylor. 2 is eating baklava from OG Mandrick. And 3 is being asked to be a presenter at a Bitcoin conference. So thank you very much. The real reason I'm here to talk about Cryptio. We're a digital back office for digital asset companies, and for this particular case, Bitcoin treasury firms. So we have over 450 customers, names you've all heard of: Metaplanet, Strive, BTC Inc., Reserve One. We work with some of the biggest institutions in the space: Circle, Laser Digital, Gemini, Uniswap, GSR, Bitcoin Depot. So what do? We simplify your treasury reporting with our software. So we manage GAAP, fair value impairment. We track cost basis computation. Bring in your revenue, connect to all your custodians, connect to your exchanges, things like that. We have a couple dashboards here that we kind of stole from some of the better Bitcoin treasury firms, transferring your Bitcoin into audit-ready, compliant accounting and reporting software. We can track across different vehicles, preferred equities, debts, common stock, the consolidated, all that stuff. We're SOC 1 and SOC 2 compliant. We have a bunch of built-in integrations with all the providers, like I mentioned. You name the chain, you name the custodian, you name the exchange, the OMS solution, we connect to them. Bring it all into our solution and the report against that solution. Again, broad-based coverage: Coinbase, Kraken, Deribit, you name the exchange. BitGo's here, Fireblocks, Anchorage Digital. We work with all of those providers. And really what we do is we help with the things that Adrian and Michael Saylor were talking about: proof of reserves, attestation, compliance, accounting, you name it, we can help you with those. We also work hand in hand with the Big Four. We actually have a strategic alliance with KPMG, work with all of the other major accounting providers as well, help with any kind of reporting, audit, tracking, things like that. Shameless plug, we have our own little event here in New York City, October 20th, the Crypto Finance Forum. And if you need to get a hold of me, here is my QR code for an email. So I am under the clock, and I made it. So thank you very much, everyone. Appreciate you.
All right. Hello, everyone. Let's get some slides up there. How you all doing? First, I will say I don't think we've heard enough gong today. I've got my pal Tristan over there. Get a little gong. Start us off. All right. Pete Rizzo, president of Bitcoin Treasuries.net. For people who know me, I've been a long-time member of the Bitcoin media space, CoinDesk, Bitcoin Magazine. And of course, here introducing, or hopefully reintroducing you to a site that you know and use every day, BitcoinTreasuries.net. So I'm going to give you a little bit of a peek behind the scenes, what we're up to and what we're building. So what is BitcoinTreasuries.net? Today, it's the homepage for Bitcoin Treasuries. It's where you go to see who's #1 on the leaderboard. It's the center of social dialogue. Here's a couple folks, boasting about flipping some other companies. So nice competition. You go to see a stock of who's performing and how they're performing. We also have the media tracks the treasury companies and the treasury movement. So we send out a 90-slide report to major media, Wall Street Journal, New York Times, CoinDesk, The Block, etc., explaining what's going on in the Bitcoin treasury sector with lots of graphs and slides. And we're the market leader in search right now. So when people are searching for Bitcoin treasury, they're finding us. We're the first page search result for about 94% of the companies in the ecosystem. We've got a lot of monthly visitors, people creating user accounts. We spun up spaces, emails, those kind of products. Here's a couple examples. Bitcoin treasury stocks by, you see BitcoinTreasuries.net. Best Bitcoin treasury company, you see BitcoinTreasuries.net. What are we building? Well, ultimately, we want to build a great tool for people to compare, retail investors, institutional investors, to compare what's going on amongst Bitcoin treasury companies, called Bloomberg for Bitcoin finance, if you will. We've launched a couple new things recently. We've got advanced data. So we've got new metrics and dashboards that you can populate. Really, the big task here is to enable the community of users who have helped us build and grow this website and maintain this database to start getting towards some of these more advanced metrics like forward MNAV, BTC yield, BTC per share. So here you see an example of a strategy page. You can see their shares outstanding, Bitcoin per share, all those metrics nicely filled in, and you can start comparing Bitcoin treasury company opportunities. Live today, we launched it. Go check it out, BitcoinTreasuries.net. You can now create portfolios, both your own and model portfolios from any of our 168 public companies. There's no limit on how many portfolios you can create. You can organize by region, sector, thesis if you want to see, hey, would I have outperformed Bitcoin if I invested in European Bitcoin miners over the last 6 months and I invested at $10 a day? You can find that out on the site right now. Again, check theoretical portfolios against your actual holdings. This is, again, a stepping stone to what we think is exciting here. Is another slide of the portfolios, which is that, I think our users want to know, they put $1 into the public markets today, are they going to get more Bitcoin later? And so we're building towards a product that lets you analyze that. Lastly, the team. We've got great founders and advisors. You might know NVK, founder, creator of CoinKite hardware wallets, sort of the spun up BitcoinTreasuries.net when it was a humble homepage of just tracking the MicroStrategy and Tesla Bitcoin holdings. Eric Weiss, an advisor, Preston Pish, an advisor, and helping us kind of push the limits and figuring out how should we evaluate these companies and how can we produce new tools and new metrics for people to see how well you are all doing out in the market against that hurdle rate of Bitcoin. My name is Pete Rizzo. Check out BitcoinTreasuries.net. I'm on Twitter at Pete_Rizzo. Feel free to give me a DM. Shoot me some questions. We're a community company and an audience company, and I think hopefully building a product that you all will be able to use and as you invest. So thank you.
All right, 3 more sessions. This is how it usually goes. Tim and I start doing something together, and then he goes off and starts drinking in the back, and then it's all on me. Thanks, bud. So 3 more sessions. They're going to be good ones. We've got supply shock. Why isn't the price going up? We've got an amazing one on media. The last one with Saylor again. Hang in there. Go get another coffee. Take it away, Megs.
All right. Bitcoin is the first truly scarce digital asset. But scarcity is not just about math. There are human forces shaping it and human behavior. So this panel is going to explore these forces, how they collide, how they generate supply shocks. Please raise your hands together for Matt Cole, Jeff Park, and Alexandra Lizette. Thank you.
All right. I guess I can kick it off since we don't have a moderator and we're here for a friendly banter on what everyone here is most excited to talk about, the impending supply shock that will come from the launch of our treasury companies. Maybe just a quick intro. I'm Jeff Park. I'm the CIO of ProCap. We're one of the Bitcoin treasury companies coming online in the near future. Prior to that, I was at Bitwise, the head of Alpha Strategies, and I'm excited to be here.
Matt Cole, Chairman and CEO of Strive.
Alexandre Lézé, board member and director of Bitcoin Strategy at Capital B, Europe's first and largest Bitcoin treasury company. It's great to be with you guys and talk about the supply shock that is incoming and that we are also contributing to with Bitcoin. What do you want to first start with, Jeff?
Yeah, maybe I can kick it off by framing the conversation of what it means to really thinking about scarcity in the face of a supply shock. And I think to really understand scarcity, we have to also take a moment to understand a close cousin, which is liquidity on the other side. And liquidity actually can mean a lot of different things to different people as well. And there are two types of liquidity that I think exist that people can sometimes conflate, and it's important to distinguish these in the context of what scarcity can mean for Bitcoin that I think is additive to the conversation. So when people talk about liquidity, there's market liquidity, which is literally driven by volume and whether you can move big sizes with minimal bid offer, price impact, and slippage, and that is a kind of liquidity driven by volume. But there's actually another definition of liquidity, and this is the slightly more sinister version of liquidity, which I call funding liquidity. And it is the liquidity in which your asset can be pledged to generate liquidity for other things to then sit on top of it. And that's the collateral haircuts, that's kind of the repo operations. This kind of liquidity is also another contribution to our financial system. And so scarcity can also exist, I think, in both of those dimensions. There's liquidity that comes from market, the way scarcity comes in the market factors as well from a trading perspective. And there's scarcity that speaks to its sovereign value for which it actually can't be rehypothecated or margined away into, financializing the denominator of that particular asset. And so I think the beautiful thing about Bitcoin is, and the Bitcoin treasury company operations that we're all part of promoting the awesome possibilities here, is that for the first time, you can leverage the inherent scarcity of Bitcoin as an asset for a funding definition, but unlock the market-based liquidity that can come with treasury companies in which you can actually financialize a whole slew of risk preferences on the back of that asset and create a different kind of liquidity. And that, I think, is kind of the unique opportunity that we're all exploring the white space for and how to perfect that intersection. And if you really think about it hard enough, liquidity and scarcity at the intersection of it is credit. And credit has to be based on an asset that is liquid enough so people can actually think about haircuts, but it also has to be valuable because that's ultimately what investors are looking to think of as a hard asset to which they're lending on. And I think that nexus is the interesting thing that Bitcoin treasury companies are unlocking here.
Yeah, one of the ways that I frame this, which is similar, and I agree with everything you said, is looking at when the Federal Reserve was doing QE, and there was a lot of institutional analysis of stock and flow. And so if you think about stock, it's just where, in the Bitcoin terms, where do the Bitcoins sit, and how permanent are they sitting wherever they're sitting? And then the flow is the dynamics of new Bitcoin into the market, and then the demand to pull Bitcoin into a stock pile somewhere. And so if you think about the early days of Bitcoin, you had very high inflation rates through mining of new Bitcoin. Every time we have a halvening cycle, that goes down more and more. And my view is that that has gone down to a point where I don't think that halvening cycles will drive bull runs or bear runs, but that I'm of the viewpoint of most likely we're in this more super cycle mindset, and that's based on the stock and flow argument. So where are the large stocks and where are they growing? Well, in the past, it was really hard to buy Bitcoin in a retirement account. Now you're starting to see access through Bitcoin ETFs, that people can buy them in their 401k, in their IRA, much easier. I think in the early days, you had to go start a self-directed IRA and open up a LLC and a bank account and do all these crazy things just to be able to buy Bitcoin. Now it's super easy, and likely you'll be able to just buy Bitcoin on Schwab, and probably in the pretty near future. So that helps flow into longer-term capital, not just a brokerage account, but a retirement account. Then you look at Bitcoin treasury companies that are buying Bitcoin as permanent capital. So how many times has Saylor said, never sell your Bitcoin, or I'm not selling my Bitcoin, right? This is a flow into a stockpile that will not move. As smaller governments, but ultimately bigger governments, the United States has a digital Bitcoin stockpile. If they were to actually purchase, that would be likely to be permanent Bitcoin buyership. So these stockpiles are growing, which means that there's less Bitcoin available. And then on the flow side, we can get into that, but the short version is that when you add the ETF flow, the Bitcoin treasury flow, it's substantially greater than the mining flow. And I think that it has a more longer-term nature to it than when it's Bitcoiners on an individual basis trading in brokerage accounts and personal accounts on Coinbase or whatever. And so I think those dynamics lead to supply shock dynamics over the coming years.
Few observations as well on this. The first one would be that, as Pierre Rochard says, there are not enough Bitcoin treasury companies. You could think that there are a lot, and you could ask yourself, is that not too much, and is that not too much offer in the market compared with the demand? And the reason of all of these companies coming up is that you have Bitcoin be recognized at institutional scale, at nation-state level, as the next store of value, directly or indirectly, because at the end of the day, a nation-state needs to continue devalue slowly the currency to make the debt slower. And so you have institutions adopting Bitcoin at scale, and you have Bitcoin treasury companies, of course, taking advantage of this, and you will have a big Bitcoin treasury company in each capital market, and you have various winners in each capital market as well. And the second observation for this is that Bitcoin, as Pierre says, is going to be the most capital-intensive industry. And for this, companies and investors are not yet ready, because capital pools are just starting to get allocated to Bitcoin treasury companies. And what you have seen is that Bitcoin treasury companies starts to be the variable of the volatility before Bitcoin moves. And so even when investors get out of Bitcoin treasury companies, many times they come back to Bitcoin itself. And then when they leave Bitcoin, they go to the Bitcoin treasury company. And so what you get is more companies adopting Bitcoin, and what you get is less selling pressure for Bitcoin. The selling pressure is going into the volatility of the stocks of the Bitcoin treasury companies. And then what you have is an observation, which is that you can indeed still live without a Bitcoin standard. I mean, in France, you can have, I'm from France, in France you can live without speaking English. But if you don't speak English, you are poor, you are weaker in the economic area. And so it's the same with Bitcoin. You can, as an institution, not have it, not have exposure to it, but over time, the institutions that are allocated to Bitcoin and to Bitcoin treasury companies are simply outperforming the market. And so when we speak about the supply shock potential, what we have is today varied capital markets that are adapting to this new asset that is taking over new capital pools. And over time, those treasury companies are going to become the largest potential capitalization in the market. You are already seeing it with Strategy in the US, very high liquidity, very high market capitalization growth, and a prospect of becoming a multi-trillion-dollar company. And so when you have this type of growth of a company in a capital market, then you have everyone that is within the indices exposure that is in some way, shape, or form allocated to Bitcoin. And in this sense, Bitcoin, for Bitcoiners, yes, Bitcoin is the hurdle rate, but then the Bitcoin treasury company becomes the hurdle rate as well. And when you have a strategy outperforming by 2x, 3x, then the hurdle rate becomes, in fact, the Bitcoin treasury company. And even as a Bitcoiner, if you live on a Bitcoin standard, then if you are not exposed in some way to Bitcoin treasury companies, then you might end up with less purchasing power over time because you have then all over Bitcoiners that are starting to get exposure to Bitcoin treasury companies. And so what I would say is happening is that you have a lot of liquidity events and a lot of volatility in Bitcoin treasury company markets, but that overall is also enabling the company to have more liquidity to issue more instruments to acquire more Bitcoin. And so in this sense, we are all contributing towards what is the transfer of more fiat into Bitcoin, but at the same time, fiat printing is infinite. And so you can have a more valuation in terms of Bitcoin and Bitcoin treasury companies, but the number of fiat that is being issued is also keeps increasing. And so yes, there is a form of supply shock happening, but at the same time, there will be still more fiat in the world to be allocated to Bitcoin treasury companies.
Yeah, I agree. I think also when people coined the term supply shock, the framework really anchors to how we've observed historically in traditional markets with commodities in particular. And so that's the other thing that I always think about as well as to like how it would relate to its transferability to understanding Bitcoin's supply shock, right? Because they're different. Bitcoin's digital, right? Physical commodities actually exist in the real world, so the constraints are very different. So, but nonetheless, there's lessons and parallels to study for which we can appreciate. So for example, the way we see supply shocks happen in the commodities market has three variables, right? It's usually reflected in the storage cost somehow. It's usually reflected in the transportation costs, or it's usually otherwise reflected in the financing cost of additional kind of leverage or borrowings you may need to facilitate the credit in trade finance. Bitcoin's different because actually it doesn't have many of those things, right? There isn't really like a transport cost to Bitcoin. You can't really like put a price on that. Storage cost, same thing. It doesn't really physically take up any space, so you're not going to see demand and supply affect that particular curve. So, you know, what have investors been really focusing on? Well, historically, investors look at on-chain exchanges to see how much supply is on there, right? And that can be a little bit misleading too, because, you know, I hear often people saying like, oh my gosh, Coinbase is going to run out of coins and so it's going to go rip through the moon as there's no supply. But that's actually like crazy, right? Like, of course there's supply. And so historically what that signaled was that there were no willing like sellers coming online to actually, you know, sell their coins, right? Because usually what you saw with uptick of the supply was, well, the ancient whales are coming to actually offload supply. That's the only reason they would bring it to an exchange. Hence, there's going to be a selling supply rather than actually saying anything about a buying pressure. So I think what that shows you is that where the supply shock really will come from in crypto will most likely still be a demand-driven shock. And so I wanted to kind of make that point there in the ways that we have to rethink about what supply shocks can mean in crypto, relatively speaking. And from that perspective, there was a really interesting research that was put up by Fidelity recently. It claimed to study through two types of holders. One are institutions like Bitcoin treasury companies that own more than 1,000 Bitcoins. We know that's locked up Bitcoin, so that's definitely long-term holders. And then there's the other cohort, which are those who have held Bitcoin for 7 years or longer and actually haven't really moved them along. Aggregating those two groups, the report predicts that by the end of this year, 28% of Bitcoin will be allocated to that group. And by the end of 2032, that group is actually going to take over closer to 45%. I mean, that's a pretty big number. And I think, to Matt's point, we're now at a point where the emissions schedule in itself is not going to be the source of the market adding supply. 95% of Bitcoin have in mind, but it's really going to come from wrappers and vehicles like Bitcoin treasury companies that actually take the supply offline to engage in those fiat-based kind of opportunities that are possible on the other end to provide access, synthetically speaking. And so there's just going to be different ways to monitor where the leverage sits in the system, but I think it's worth noting that the supply shock in the ways past versus the way that it's going to go in the future, it's just going to look totally different. So whatever we ever knew about Glassnode and all those things that we're tracking, it's just less relevant in the construct of the new wrappers that have come online. Even the ETFs. The ETFs are, customer funds, right? What matters is what are the kinds of people that buy these ETFs? And to that point, like having it in a Roth or IRA account signals a new kind of investor that can come in that isn't like the Millennium hedge funds of the world trading the basis, right? And so, ETFs are ultimately client assets. If people sell the ETF, that Bitcoin is coming back online. It will come to the exchange. So I think the breakthroughs we're going to see is that there's going to be just more meaningfully long-term holder wrappers that are out there that continue to suck up most of the supply in that framework.
Maybe one more just thought on the point on the commodity supply shock part, where when there's demand that flows into commodities, you can see commodity prices go up very quickly, very rapidly. The difference with traditional commodities versus Bitcoin is that you can't get new supply from a business, right? And we've never seen that before. But with traditional commodities, it's not like the price goes up and the new supply can go on the next day or the next month. There is a cycle, right? You have to get new mining rigs going, hire people, and then that eventually brings new supply on over a period of time from maybe it's 6 months to a few years. With Bitcoin, you can't. And so I think that the difference that what I think we're going to have to see play out is that it could create a longer super cycle because the lack of supply being able to come from operations is just not there. And so that kind of gets into the more positively convex nature to Bitcoin prices to the upside that I think you could see in an environment that we're talking about with ETFs and Bitcoin treasury companies. And I mean, the bottom line is no one knows how it's going to play out, but you can see how people could get very bullish, including myself, of where Bitcoin could come and go in the coming years.
I've had over the last months 80 plus conversations with financial institutions across the board, and a lot of the questions was, what about the business model of a Bitcoin treasury company in about 3 to 5 years and so on. And I think what is happening with Bitcoin treasury companies and what we can see from our shareholder base is a supply shock that is starting to arrive on top of another supply shock. Because what we have as shareholders is a mix of short-term investors that are in for the short trade and monetize short-term volatility, but over time, when you get a massive run-up, we've done plus 3,000% and then minus 50%, and you can see a formation of long-term shareholders over time. It's like accelerated bull and bear market runs in Bitcoin treasury companies. And what you can see is an increase on at least the communities on X, on Discord that we have at Capital B, an increase of the understanding of what is Bitcoin, of what are Bitcoin treasury companies, and what is a pure play Bitcoin treasury company that is completely focused on maximizing Bitcoin per share. Our objective is to reach 1% of the total BTC supply over 8 years, and we have shareholders that have said, I am here for 10 years, I am not touching the stock, I am hodling the stock, and I like the fact that the company has pure clarity, that has pure focus, that is completely focused every day on maximizing BTC yield, the increase of sats per share. We were talking about a super cycle. Well, Bitcoin treasury companies that are completely focused on maximizing Bitcoin per share at each capital operation already have a form of super cycle. And this super cycle is the increase of their sats per share over time. And so in some way, the price in fiat doesn't matter other than being able to share sales at an existing premium or at an embedded premium to, of course, the stock price with the credit instruments. And so there is a double arbitrage that is happening is both the Bitcoin treasury company that is, of course, leveraging the elasticity of capital markets to acquire the most inelastic on-off, which is Bitcoin. And on top of that, you have investors that are leveraging the elasticity of the Bitcoin treasury company to increase their compounded sats per share over time so that they have a leverage into the potential of a supply shock on Bitcoin. Because what happens if there is a supply shock on Bitcoin at some point in the future and that people lose confidence into the fiat currency of their own country? Well, you have Bitcoin that goes up in the fiat currency of your choice at a certain moment, and you have, of course, then the stock price of the company that is potentially going up in a levered way. And what is the company going to do with the stock price going up? It is going to buy more Bitcoin and increase the sats per share. And so in that way, Bitcoin treasury companies are Bitcoin accumulation machines that have already, in a matter of 5 years, but even accelerated over the last 6 months, suppressed 1 million whole coiner opportunity. So you have 1 million Bitcoin that have completely disappeared from the supply because they have been absorbed by Bitcoin treasury companies, and those companies are held by millions and tens of millions of shareholders over the world. And so you could call that a speculative attack. You could also call that the most rational thing to do when you know that there is an unlimited supply of fiat and a finite supply of Bitcoin.
We have time for one question. Anybody? Anybody? Bueller?
Thank you. So you guys basically addressed both sides of the question I had, but I want to take it one step further. So the world's never seen an absolutely scarce fungible asset before, so we have a hard time envisioning what supply shocks can look like, and we've never seen an asset, as you guys talked about, where to some extent there's not elasticity around the price. There are certain types of demand buyers of Bitcoin, governments, companies that will keep buying regardless of the price to some extent. So I'm curious, given that all of us in here are in the treasury space, if any of you guys have done the next level research to say, if things continue the way they are, how long into the future can treasury companies stack in big volume? Like we're seeing 1,000+ purchases in one go. We've done research at Arcadia Bitcoin, and we think it's 4 or 5 years, and it's going to be after that, it's going to be smaller stacking continuously into the future because of the supply-demand dynamics of Bitcoin.
Yeah, so 2 comments. One, not your models, but the models are broken, right? And the models are broken because we've never seen an asset like this. And so to be humble, like we don't know. But we think that the digital gold rush is a 10 to 15 year phenomenon, and over time it's going to be harder and harder to stack sats for these companies, and so that's why we do think it is early that people that are able to get going are able to build pretty large stacks of Bitcoin. But I think the focus, and you see this focus across this room, is stack sats. There's a million ways you can monetize a massive balance sheet over time, but that exercise is fruitless right now during the digital gold rush era because, to your point, in 5 years, you won't be able to get anything close to what you can get today.
Yeah, I agree with this. And, I think at some level, anyone can go out and buy as much Bitcoin as they want later, 10, 20 years. It's just the opportunity cost will look different, right? So I think at some point what we're seeing is the monetization of that volatility for the opportunity set today being the advantage for which we're not going to have 20 years later as a company then. Which brings back to the original point of like scarcity, right? Because scarcity in itself is going to create volatility by definition, but the thing is, volatility also can be a catch-all phrase for things to mean bad things, but I would go so far as to say there's things that can be good volatility and things that are bad volatility, right? Earlier this morning, I saw Gary Gensler on CNBC commenting on the rules making around quarterly earnings being moved to semi-annual and whether that's going to be good or bad. And he said, well, it's bad for investors and bad for investor protection because it's going to create more volatility. And I think the point that sometimes people miss is volatility that is created by having symmetric information that is pricing the market very quickly is very good. That's actually good to have volatility where there's liquidity behind it. What's bad is volatility or lack thereof because there's no price discovery. When people say private credit is an amazing opportunity because there's no volatility, that should be frowned upon as something beyond it in itself being a virtue. So I think the other part of this journey that we're all on with Bitcoin Treasury companies now versus 15 years later is the knowing embrace of volatility and the kind of good volatility that I think is ultimately what Bitcoin represents because of the efficient liquidity of the market structure, which is really signaling information alpha. And it's not driven by other kinds of manipulations that otherwise is not available in open source way that all of us can observe.
Matt Cole, Jeff Park, Alexander Lizette, thank you very much. Stay in the room. Next session after this quick lightning talk is my favorite one. I put this on the schedule first, so don't go anywhere.
Good afternoon, everybody. I'm Alan Helm, Director of Business Development here at Bitcoin for Corporations. I'm very excited to chat with you all here today. I'm going to set a world record, 15 slides, 3 minutes, so let's go. Let's speed run this. What is Bitcoin for Corporations? We are a joint partnership with Strategy, and in case you guys didn't see the news today, we just announced a 5-year partnership with them, so very thankful for Michael Saylor, Fong Li, and the entire team at Strategy for continuing on our partnership. And then we also work with David Bailey's BTC Inc., accelerating the corporate Bitcoin adoption narrative. So why does BFC exist? Corporate adoption with Bitcoin on the balance sheet is net new. Just like Bitcoin, the network, there's a lot of education that needs to go on, and we want to accelerate that, whether it's coordinating across investor relations, legal, accounting, media, and internal teams. There's a lot of things that go on in the background. And so we leverage our suite of products across BTC Inc., including Bitcoin Magazine, Bitcoin Magazine Pro, mnav.com, the Bitcoin Conference, and UTXO to accelerate those things. We have the strongest and largest network, bringing in over 40 companies almost, going all the way across from North America, South America, Europe, the APAC region, and even Australia. Bringing together this wide range of innovators allows us to be at the forefront with FASB, the SEC, MICA, FCA in the UK, and other regulatory bodies to give the most up-to-date information for our members looking to run this treasury strategy. You can see here that a lot of our members here today are present, including Treasury, Affinio, BitGo, DDC, Cooler, Samara, Strive, JetKing, Capital B. Reach out, talk to them. They'll tell you about what we've done with the network and how we've assisted them on their treasury strategy. Our members account for 69%, almost 70% of all Bitcoin held on public company balance sheets, which is just showcasing the power of our network. And we really focus on 3 core tenets, which include education, probably the most overlooked, which include research reports, academic reports, thought leadership through just basic articles. Our research team does independent case studies on a quarterly basis for each of our members, which are great for the investor base and shareholder base. We do our best to standardize KPIs and looking at things that you shouldn't be doing in a treasury strategy. Networking and awareness is also super important. We partner with the Bitcoin Conference to bring our quarterly symposiums, which is very much stylized like this event here today. And we also have a dedicated client success management team that gets really intimate, not just with the companies, but with our vendors as well to understand the problems that are going on. Lastly, public and investor relations. We do everything from our real-time treasury management boards to our digital strategy. I see Pierre Richard right here. He hosts our Bitcoin for Corporations show. We also do quarterly earnings report syndication across the board. So reach out to us. I know Peter Boards is in the crowd here somewhere. Reach out to CJ from the strategy team. We're here to support your journey. Very excited to talk for you. Got 3 seconds left. I did it. Thank you all.
Good job. You did it. Alan has this deck of 420 slides. I'm surprised he got to 15. Hey, if you want to come up to these front seats, screw the VIPs. Come up to the front. We've got seats. We looks better optics on the live stream as well. Please feel free to come on up.
A Bitcoin treasury company turning digital assets into real-world innovation. We're reshaping the U.S. building envelope market with high-performance facades and windows powered by technology, AI, and advanced manufacturing. At our core, we're a tech and AI company. We use innovation to make building faster, smarter, and better. And we see that as part of a much bigger picture. With over 30% annual growth and strong margins, our profits power operations, drive expansion, and strengthen our Bitcoin position. We see Bitcoin as the ultimate reserve asset, scarce, incorruptible, and aligned with long-term value creation. We've been stacking Bitcoin since 2021. Not as a side bet, but because we believe it's the strongest asset in the world. For us, Bitcoin is the foundation, the way we protect value and build for the long term. Every step we take, whether it's developing new AI tools, improving manufacturing, or delivering better products, feeds the same mission: to grow a company that lasts, secured by Bitcoin and driven by innovation. Our aim is clear: to stand among the top global Bitcoin companies while transforming how buildings are designed and built. The future is being shaped by technology. The future is secured in Bitcoin. And the future is what we're building. Discover what we're building next.
Hi again, everyone. Good afternoon. This next panel we have, I'm super excited about. It's a topic that's actually pretty close to my heart. For those that don't know me, I am Eleanor Terrett. I'm now the co-host and co-founder of the Crypto in America podcast. But for 9 years before that, I was at Fox Business. It's the sister network of Fox News, so a TradFi media company. And I loved my time there, I really did. It was a great chapter in my life, but they really weren't covering crypto. And so I left. But it seems to still be sort of a theme with TradFi media companies these days. They don't cover, crypto in the same way that some other platforms do. I mean, by a show of hands, how many people here get their crypto information from TradFi media companies? Not a single person. Okay. Well, we're going to talk about that today in this next panel, and I'd love to invite up to the stage the wonderful Natalie Brunell, who has the Coin Stories podcast, Mike Germano, who is from PubKey, but he has a former life as he was at Vice News, and then he was at Bitcoin Magazine. And obviously TJ Miller, who everybody knows. He's an actor and comedian and a Bitcoin maxi. And they're going to be talking about TradFi Media Bitcoin, why the disconnect persists. So welcome them to the stage, everybody.
Hello. It's exciting. In the round. You guys got really great seats, didn't you? Back there. Well, hello.
Hi, everyone.
Hello. I also want to point out, Eleanor, you're the one journalist that everyone was afraid of getting a text message from. You always knew the information at Fox before anyone else, and we were always so afraid of getting a message that she knew something that we weren't allowed to report. So she was one of the good ones.
One of the good ones.
I have a very similar background to Eleanor. I also left my job in mainstream media. I'm a recovering TV MSM reporter, and I'm so grateful that Bitcoin gave me the opportunity to become an entrepreneur and build my own media platform. And I felt a lot of the frustration that Eleanor probably did, where I would try to pitch stories, and when they allowed me to do them, every now and then, I actually did my first Bitcoin story in 2017 about a Bitcoin ATM in Sacramento, but I always had to present Bitcoin as, oh, here's this person who says some good things about it, and here's this person who says the worst things possible about it. You guys decide. And I felt like I was doing a little bit of injustice to Bitcoin because I was starting to understand it so much more as the years went by, and I felt like I wasn't able to cover it with the truth and conviction that I had developed. And at the same time, as many of you probably have noticed with news, our media institutions have lost a lot of trust. I, as a reporter, was also feeling like I wasn't able to cover stories in a way that reflected genuine curiosity and trying to determine the truth. I felt like I had to cover them a certain way. And that was very, very frustrating to me. And I felt a level of cognitive dissonance, and I was starting to get disillusioned. And that's what led me ultimately to making the decision and taking a big risk. I had no idea that I could build my own media platform, but I had to do it because something in my gut and in my heart said that Bitcoin is the truth. I need to pursue this and educate the masses, including all these people in the media, as opposed to just staying in this very stable job, earning my fiat salary, and reporting on stories that I felt weren't covering the full picture in its entirety.
Yeah, I mean, I was on a television is that it? All right, thank you guys so much. It's been great.
Come back, come back. Okay. Okay. All right. Perfect. Okay, so now I get to introduce myself. So thank you so much for that, TJ. Once again, hi, my name is Mike Germano. I'm over at PubKey. I think I saw a couple of you there last night, the ones who look a little tired. Excellent. And for everyone who's coming tonight, thank you very much. We are a true Bitcoin treasury company. We take literally your money and your Bitcoin, and we give you a hot dog, and we give you a beer, and we have our small little Bitcoin treasury. So we do it the old-fashioned way by getting you drunk and making sure you have a good time. So thank you so much for building up our humble stacks. Look, I think one of the reasons why I'm on this panel is having the experience that I did in media, and really what I want to try to say to everyone here, which I think is going to be important, is that the truth is, if this is a treasury event, a lot of you are new faces I've never seen before. I've been around, right? That's great. You're building out, you're doing some good stuff. Don't worry about that. Oh, the storage company, that's an awesome thing. There's a lot of new faces here. You're experts at managing the financial markets, finding, as Michael Saylor said, this untapped capital that you're going to bring to the market in whatever region you are. That's fascinating. You can tell that story. The media is going to want to hear that story from you. But the truth is, the reason why the media has gotten Bitcoin all wrong is because way before you were here, before anyone was here, when Bitcoin launched, there was no PR department, there was no CEO. Traditional media had no idea how to report on this. If you wonder why they failed at doing it, they didn't know who to call. We weren't set up in their traditional structure, and even worse, Bitcoin was launched didn't need the media company. They felt rejected. So when media companies, for all this time, have said, well, we think Bitcoin's a scam, or this isn't going to happen, they can't admit that they're wrong. They can't admit that they were wrong at 2,000, at 4,000, at 8,000, at 642,000. They cannot admit that they're wrong. They still can't admit, they're still trying to tell you to get your 17th COVID booster on your cat, right? So they can't admit that they're wrong. What makes you think they're going to admit that they're wrong in Bitcoin? And even worse, if they do that, they have to tell all their readers and viewers, thank you for trusting us. We lost you a fortune. They will not do that. Now, that's bad for Bitcoin. Why is that good for all of you? Because what Michael Saylor did, really, was that he put a CEO, a name and a face on something and on a company that was relatively new. Just like all of your companies coming out new. You can follow the structure. You get to talk to the regular press about what you're doing. You get to have the ICO. You get to be there ringing the bell. You follow their structure. Your job is to convince people that your management team works, that your business works, right? That this is the best form of capital, that how you're doing it, to have trust in you. I will say, my advice is, you're going to fail probably on trying to convince people that what the value of Bitcoin is. That's not your job. Your job is to tell them why your treasury company works. Now, I would say that the job then of everyone else from the Bitcoin community is how do we keep saying Bitcoin is something valuable? That's our job to try to put out there and make everyone realize and believe it. And the truth is the Bitcoiners might do a better job than you. I know we're not supposed to say that, right? But once again, talk all day about why your instruments make sense. That's where you're going to work. And I just wanted to maybe share. I know some people here don't like Bitcoiners that hold on to their own Bitcoin, and I think said we were sniveling or something. But the key was, if the whole world, as everyone said, changed in November of 2024, when Trump got elected, and you can tell it was a pro-Trump pro-Trump panel cabinet, was because it was the Bitcoin holders who built up a huge community, right? And were a voting base that convinced Trump to actually support Bitcoin. There was no Treasury company that convinced Trump to go pro-Bitcoin. So we both need each other very much. It's not just about buying this or buying that. And once again, want to talk about how sometimes it's difficult dealing with the media, and the best ways to do that. So Eleanor, welcome to the stage. Happy to have you on.
Yeah, welcome.
Little change in regularly scheduled programming here, and I got all ready and I put my sneakers on, but here we are. I'm back. Yeah.
You know what I think would be important from your angle?
Yes.
Once again, I truly do mean this. When you were over at Fox, you were one of the few reporters that actually were doing proper reporting on the space. And it was very rare for us. And I'm not saying we were afraid to talk to you, but we knew you knew information. And you know, there's a huge investment. A lot of people think making Bitcoin content is easy. Well, half these companies that make Bitcoin content, they're going to be promoting their exchange, or they're promoting their new stock, right? To be, what Fox News was unique. They did have some coverage. But I think talk a little bit more about how reporters want to talk to these people, where you think the value are for, I think, everyone here to better understand how to talk to a traditional reporter.
Yeah, I think with a company like Fox or a company like CNBC and Bloomberg, the content, we were always trying to meet you guys sort of halfway, right? I think for a lot of us, there was the meeting you guys at the, I guess jumping the Rubicon. It was the level of understanding, I think, was not always there with a lot of us. I was very fortunate enough, and Natalie knows, Charlie Gasparino was my mentor, my boss at Fox Business, and we kind of jumped into doing this together. I came at it from a very sort of, I wouldn't say easy way in. I'm not a very technical person. The way I kind of came at it was through the regulatory and the policy standpoint. So it was the end of 2021. We started covering the SEC versus Ripple case. And as you guys know, that was sort of one of the first major companies to get sued by the SEC. It was kind of right before Gary Gensler came in, and then he started suing, everybody and their mother. And that sort of became the story, and that's really how I got into my own crypto reporting. But from the technical side of things, I think that really is a struggle with traditional, financial reporters. I think it's gotten a lot better now, and I think kudos to you guys for really making it, understandable to a lot of us. But there's also the hard work involved. I do pride myself on having a lot of conversations. I actually pick up the phone and I talk to people. I think that is an art that's unfortunately been lost, I think, to some of these, maybe younger reporters who have kind of grown up, in the digital age, right, just sending a text messages. But I think, actually meeting in person, actually picking up the phone, and actually, making the effort to go and learn something. What is crypto? What is Bitcoin? How does it work? And actually making that effort to make those connections. I pride myself on my sources and my connections. So, for me, that's how I got the job done, and that's kind of how I got to where I am today. But I appreciate the kind words.
I think one of the biggest problems is that many journalists have something in common with their viewers, which is that they don't have any education in different types of economics, in Austrian economics, in the history of money, and that's something I really had to teach myself. And what we do get when we go to school for journalism, and I got 2 degrees in journalism. Why I did that, I don't know. But I studied a lot of multimedia production and the technical side and storytelling, how to put together a compelling story, which does help. I mean, I think one of the things we need most in Bitcoin is more effective storytellers, especially to the masses, breaking it down in a simple way and in a way that sort of draws on our heartstrings. Because what type of stories do we like to watch and listen to, right? We like to watch the ones that have some action, that are riveting, that there's some drama, there's a conflict, but then there's maybe a resolution, maybe there's something to look forward to. And personally, I mean, I love happy endings. So I think the ultimate happy ending is something like Bitcoin that empowers the individual. And I think in terms of the story with regard to where we are in human history and in our current society, we are really at an inflection point. I mean, I've never imagined growing up in a society that's gotten this divided. Bridging the gap between left and right has felt so much more difficult every single year. And I shared recently in some of my talks and podcasts that the only thing that has given me hope is Bitcoin. I don't know where I would be if I hadn't found it. Maybe I would be a huge gold bug, or maybe I would totally be a doomer that thinks this is all just going to, HE double hockey sticks in a handbasket, because it's just we've pulled apart so much, and the average person feels left behind. Wall Street's doing better than ever. The rich are doing great, and the middle class has been completely destroyed. And so it's not surprising, I think, that they're pulling toward politics, demanding, to put someone in office that's going to redistribute the wealth or hand something to them and make them feel like they're going to be empowered. But we know that they're not, because we know that they have to print. But the average person is not empowered with that knowledge. And so it's incumbent upon us to share that story, share it simply, and tell them why not only the problem is rooted in money, but the solution really is Bitcoin.
Yeah, and look, I know this sounds silly to think working at a Bitcoin bar is important, but I'll tell you why it's important. It's important because it's an actual place, right? We're all here because we want to be connected. You're all believe in Bitcoin. Sometimes you feel a little crazy. We have people come into the bar that flew in yesterday from like Poland, and we had someone from Georgia, and everyone's saying, hey, I just don't want to feel alone. I want to see that there's other people I can look in the eye, talk to, and say, hey, you believe in this too? That physical thing is important. Number two, it's actually about spending Bitcoin. It's using Bitcoin. Now, I know we can't talk about spending Bitcoin here. I know we shouldn't talk about actually using Bitcoin as a medium of exchange, but we do that at PubKey. President Trump, he did it. He bought some crypto burgers. I yelled at him and I said it was a Bitcoin burger. Secret Service almost tackled me, but I've learned my lesson. But hopefully he did too. But the key was, it's a place where actually what we see, which I think is exciting for me, and when you talk about thinking we're going to HE double hockey sticks, which is very Midwestern of you. As a New Yorker, I would use different words. But for a lot of people, you'll see the reason why they're so passionate about Bitcoin is this is kind of a political party, right? I mean, it looks like half a cult. I see people out here with orange ties. It feels like the Book of Mormon version or the Book of Michael Saylor or whatever you guys are doing. So, they call us a cult. I'm just happy you now have a uniform. But I would say that the nice thing about the bar is it brings people together. We're there. We see parents come in and bring their kids, and they're like, "See, this is real. Like, this is real." And then we see like kids bring their parents and be like, "See, I told you, this is like real. You can do stuff with it. You can buy, right?" And so that's important to have a physical location. And obviously, we had to have it here in New York because we had to fight the New York Bit license. It's a home for everyone. I mean, this is a home. And the reason why we made it a dive bar was because that's approachable. That's the truth. It needs to be approachable. That's the beautiful thing about this asset. I think what Michael Saylor did say was like it's the only asset for the rich and the poor, right? And that is absolutely exciting. I never thought of it that way, but when you come into a dive bar, and we're a luxury dive bar, so our food's really good, bathrooms are clean, right? But
Tallow,
yeah, we cook in tallow before it was cool. And so I think it's important because it brings everyone together. It's a great place to make you feel welcome, right? And the worst kept secret is that we're opening our DC location soon, which is going to be massive and a great place. And it wasn't just because it's in DC, it's because that's a place where people need to have conversations the most, right? Bitcoin can bring that conversation. I'm sure we could probably all disagree politically, but the point is we all believe in Bitcoin, and that all makes us feel like we're rooting for the same team. So when you do see people who get excited and passionate about Bitcoin, might get upset about how you're doing Bitcoin financially, it's because they're so passionate about what this asset has brought to their life. So it's not just financial. I know this room wants to see just number go up, but for a lot of people, it's personal here, and that's what takes good storytelling. That's why people take a lot of pride in it, and that's why people might fight you when you tell them what you're doing.
I have a question for both of you, actually. I feel like in the early days when Trump was still trying to, he was, getting in super into crypto, right? It was kind of like the campaign season, when we had him come to Nashville for Bitcoin 2024, and then we obviously had the election win, and then the inauguration, he was doing all these things and making all these promises and following through on the promises too. But then, I feel like now it's kind of died down maybe a little bit just because, we've passed the Genius Act and we're working towards clarity. But I feel like the traditional media in the beginning was very interested. They were kind of sitting up and taking notice. And you guys must have been getting a lot of questions from reporters and a lot of coverage, right, from those outlets like Fox and CNBC and Bloomberg. It's died down to an extent. Do you expect that to continue on that trajectory? Do you think the crypto hype or maybe the interest has died down for good from trad media? Are they just not interested? Is it always going to be that way? What's your take?
No, real quick, I think I have some scary stories to share with that. Is PubKey asked every single politician if they want to come. Just like when I was at Bitcoin Magazine, we asked Trump, we asked every candidate, right? Trump said yes, others didn't, especially at PubKey. Other people might have raised money. We charged Trump $952, so we didn't raise him any money, we actually charged him. We still have those sats, by the way. So the important thing is mainstream media then want to say, you're a Republican outlet, and every time they report on us, well, this is where Donald Trump, yes, obviously that was big, but they're still caring about this story. We're fielding reports from a lot of traditional left-leaning media publications that are, I will be honest, are looking into what the Trump family is doing. They're asking questions. They look at this as it didn't help the narrative of like Bitcoin's a scam, right? And the Trump family is big time into this. They just went public with one of their things. Traditional media wants to pin something on there, so I think it's actually, unfortunately, the negative to Trump winning is that his family getting involved in it has put a major spotlight on it, right? So the positive being is we're all here because regulations dropped, right? And we can actually be free to do things. That's terrific. So I feel a little bit of that gold rush is happening, but I think traditional media is just waiting, to have that argument. The good news is that Trump is a hurricane and does different things every day that the press doesn't have enough time to kind of react to it. But that's a story that they're going to be going after, and I think they're taking very seriously. So something I'm personally concerned about.
I think the best is yet to come. I think more people will pay attention as the price goes up, right? They always tend to do that. I think also we're opening up more and more on-ramps. And the more rails there are and the more that it becomes practical in people's lives, I think they will start to embrace it, even in passive ways. You start to naturally just become more invested in something, even though, you might not study it, but hey, now maybe a company enters into the S&P in the future, it's already in the NASDAQ or it's in your ETF, whatever. And then you start to just pay attention to the stories a little bit more. So I think slowly but surely people will start to focus their attention a little bit more on, hey, maybe I need to own some Bitcoin, I need to learn more about it. But I do think unit bias works against us because people look at a Bitcoin and they probably see it like a car, right? Like you don't want to buy like a fraction of it or you can't. And that's the message we really need to convey is you can start with $5 of Bitcoin or $10 of Bitcoin. That was going to be TJ's message, is saying you could just buy $5 of Bitcoin every week, the amount that you would spend on a coffee or something, and you can start small and it can turn into a meaningful savings. I was telling Eleanor that I set my mom up with an account a few years ago, and we just set her up on a little auto buy, and she forgot. I said, set it and forget it. She forgot about it, and the other day we checked it, and she's like, I have how much in there? And it's just like a little extra nest egg for her, and it makes me so happy. So I think the more access that we offer people, the more that they can say, hey, not only is this approachable, but I feel like I can do it because it's maybe not too technical, or I don't have to buy a whole Bitcoin, or every outlet isn't speaking negatively about it.
Everyone here, if you're here for Treasuries, you're thinking about these large financial plays. Obviously, it's so important for the $5 for Bitcoin, and I just want to stress, we need each other in this conversation. I might not be the biggest Treasury fan and want to do that. I'm always going to advocate for holding on to your own Bitcoin. But the reason why we need each other is because we are the top of the funnel. Every conversation that someone starts to orange pill, we're the ones who want to orange pill people more. We're the ones who want to go out there and annoy people during their Thanksgiving dinner and slightly ruin it. But hopefully maybe your one uncle will take notice, right? We're top of funnel for having them think about maybe your products. Maybe they don't want to hold their own custody and your product comes in, or it's in an industry that they understand. But I cannot stress enough how important it is for you all to understand that Bitcoin is a culture war that is happening against traditional media and against traditional finance. And it is a fun and scary one, but it is one that happens. So while you're all working the financial markets, right, that has its traditional rules in place, and this is the new shiny thing you can add to it, right? There is a Bitcoin, there is a Bitcoin culture war happening. And how you support that is, I believe, going to impact the largest on your success. You all have marketing dollars. What are you going to spend it on, right? You're going to just buy ads here or not? There are some people who are fighting on the Bitcoin side. We're seeing it now as they have, Bitcoin, not just influencers, but they have people who understand the space and can help translate that space to other folks. That might be something smart that your companies, look into doing. What does make your company different, and what type of advocate in the Bitcoin world would best represent that and bring that in for trying to get some, not only your marketing, but help you understand what's happening in this culture war. You can't just jump into it and be like, If you look at it just on numbers and say, well, this is how much it goes up and this is the financial market, you're going to be lost, right? You don't show up to Paris and don't speak French, right? They hate that. So like, once again, you need to understand the language and the world that you're in. And once again, that's why at PubKey, you can always come, and we're looking to make media on this topic as well. So if you would like to sponsor it, we'd love to talk to you after this, because we think some of the best content could be made at your little neighborhood pub that's a couple blocks down from Wall Street. So that's a shitty plug, but I didn't get an advertising spot here, so I used it now.
You want to open it up to some questions?
I think that's a great idea. Anyone have any questions not for TJ?
You hear me? Okay. I'll put on my tinfoil hat for a moment, but do you think there'll be an active push by TradFi or traditional powers to negatively put Bitcoin in a negative light through centralized media sources? Or is that out there?
I don't. I think we have crossed the event horizon. I think it's hard to put the genie back in the bottle. Now, too many people with a legitimate stake in the mainstream, in the TradFi world, own Bitcoin. I don't think that they're going to go against something that Larry Fink owns, that administrations are now starting to embrace, that the SEC is now for, the CFTC. I don't know. I don't see us rewinding time and suddenly having an administration that is hostile toward it, but that's just me.
I would agree with that.
I would highly disagree with that. I don't trust any mainstream media. And for someone who worked in it, let me tell you, when I was at Vice in 2012, we were like, Bitcoin, the next money or the best way to buy internet drugs. And then when I was at Bitcoin Magazine in 2021, Vice reported, they're not wearing masks at the Bitcoin conference. Bitcoin's bad, right? So like, and in between that time, they went a little bit more mainstream and a little tinfoil hattie. But the truth is, Bitcoin's always going to have enemies. Bitcoin itself is trying to, it wasn't created to be a tag-along asset to other public companies. Bitcoin was created to take down Wall Street and to take down the banks and take down other things. I'm really happy you're here all adopting it. It's a smart thing to do financially, right? But there's always going to be enemies to Bitcoin, and mainstream media is going to be the best outlet to go against it. And more importantly, there'll be people who want to advertise a different world. The fact that if you look at the top 3 media outlets that have misreported on Bitcoin and have done a poor job, talk about the New York Times, Washington Post, and MSNBC, the irony that MSNBC, which was Microsoft and NBC, created in the 1990s to be tech forward and to talk about the future, has been the biggest, FUD creator for Bitcoin that was ever imagined, right? New York Times, which was at the ground floor of what was happening in Bitcoin, misreported on it from early dollars, right? And they still won't go. And the Washington Post, which is owned by Jeff Bezos from Amazon, who might know something about electronic money and how to pay for e-com, is the 3rd worst outlet for media. So yes, I do believe you should always be skeptical of mainstream media, and that's why events like this. Ed, what do you had, 190,000 people that were watching this?
Peaked about that high.
190,000. Just so you know, that is more viewers than any show on MSNBC. Okay? Man, Rage Against the Machine, know your enemy, right? Like, your enemy, in my opinion, is the mainstream press, and that's why we need to continue to do things like this. We need to continue to get content out there, you need to continue to get information out there, and you need to continue to talk to your friends, because the press is never your friend.
I want to clarify based on what you just said. I don't think there's going to be pushback in the future to owning Bitcoin as an asset. I think where the pushback will be self-custody and privacy. That's where I think our battlefronts are, because I could see the government and future, centralized agencies wanting to make sure that they control these new rails as much as possible. But I do think it will be embedded in the traditional financial system as an asset. They're just obviously going to want to control and tax as much as they always have.
5 years from now, you're going to read the headline that says, people got rich off Bitcoin. It's not fair. right? Like that's what's going to happen. That's the attack vector. It's going to be jealous people who didn't get in when they wanted to, and now it's so bad what happened here, and they're going to use the mainstream media to cram it down. Why we don't deserve our Bitcoin, and why the government needs to, collect it needs to be in a Coinbase account in order for you to do your taxes. So that's my fear. Bitcoin is inevitable. It's going to happen. But the mainstream media is going to use it to stoke up fear and hatred against Bitcoiners, with the government.
I got one more question here.
Kind of dark.
But first of all, I learned a valuable lesson today. I'm not as funny as I thought I was. Apparently. So 3 minutes. So you each get 1 minute. Accountability. Right? There's I saw this new website, proofofprice.com, right? And they're taking the price predictions off Twitter, logging them, putting them on a chart, and you have to be accountable for what you said, and we're going to see who was right, who was wrong. How do we do the same thing? What's the website? The Death of Bitcoin website? How many times it's been declared dead? It seems like mainstream media or any media or even you can just keep saying things and keep saying things. It's like it's going to rain, it's not going to rain. How do we implement accountability in all media? 1 minute each.
Vote with your eyes and ears and with your money. Put your attention to places of value, places that are accountable, and obviously they will follow because that's where the money and the eyeballs and the ears are.
They've been wrong. I think the best thing to do is honestly publicly ridicule them at all times. And I'm not joking, right? Like show that it's clown world and be like, wow, you were wrong about this, you're wrong about this. I understand a lot of suits are here and you have to be professional. I get that. That's why you have someone who can do the trolling for you. But listen, that's important because once again, if you just don't take them seriously, they lose all their power. So I think that's important accountability. And when they know that they're being laughed at, they might take things more seriously.
Well, I think the resounding no hands when I asked the question in the beginning about who gets their crypto news from mainstream media outlets was everything. And I've actually never seen a whole room completely unanimous before. So I think that gives you everything you need to know. Clearly there's a reason for that, and you guys are going to keep doing what you're doing because someone's clearly doing a bad job. So, accountability, keep doing what you're doing because you have places that you trust and places that you don't trust. So, keep doing what you're doing, keep showing them, who you trust and who you don't. That's what I would say.
And Ed and Tim, congratulations, and everyone else who worked on this. 3 months to put this together. No mainstream press, no nothing. I don't see Bloomberg here. I don't see Fox News here. You guys did this. This is more important than anything else. So congratulations on proving everyone wrong.
Yeah, we're doing another one on Friday.
Yeah, and in general, just we as consumers, we're accountable, right? There's so much information out there now. You have to do your research. You have to look around. You have to see, maybe is there another side that I haven't explored? Have I, been watching things that are maybe a little bit one-sided? I think that when you straw man and steel man arguments and just try to learn from the smartest people, you start to develop your own ability to articulate the message of Bitcoin and anything else really. And we are accountable now because there's so much out there in the digital landscape, so much media out there, and it serves us for the good, but it also provides us with a saturated field where we have to do a lot more work.
Awesome. Eleanor Truitt, Natalie Brunel, Mike Germano, thank you very much. We're going to do a brief video from one of our great sponsors, and then we'll be back with the final session with TJ Miller.
We love you, TJ.
See you all at PubKey.
With Michael Saylor, and then we have to be out of the building at 5:30, so it will have a hard stop.
There's a huge There's a huge opportunity in digital assets today. We are now going through the process of what's called a mega trend. Now, other former mega trends were things like the printing press, automobiles, the internet, smartphones. The new current mega trend is blockchain and digital assets.
These technologies will play a key role in the financial services industry and will soon be considered critical infrastructure as we move towards a digital economy.
And this mega trend is growing today with an adoption rate that is surpassing that of the internet in the late 90s, early 2000s.
It's estimated, up to 42 million Americans today own some form of cryptocurrency.
Off-the-chain capital provides a really traditional Warren Buffett, Graham Dodd style of deep discount value investing in the blockchain markets. The specific strategies that we use with off-the-chain is we're really accessing unique opportunities to buy blockchain assets at a discount through our network. And that's really what gives us our advantage, finding unique ways to buy $1 worth of blockchain assets for 50 cents.
That's our whole business model, is to go out and find early employees and early seed investors who need liquidity. And we buy, the premier blockchain companies that they help build.
The other half of what we do with off-the-chain is finding unique opportunities to acquire digital assets at a discount.
For example, we're one of the largest buyers in the world of Mt. Gox bankruptcy claims. So that enables us to buy Bitcoin at a discount.
Now, this unique strategy with off-the-chain is something that we have not come across with other digital asset funds around the world. You have a lot of investment firms that are competing against the early stage venture deals or the algorithmic trading types of strategies with cryptocurrency. But by us applying a very traditional, proven, value-based model, we've been able to find truly unique assets and build value for our partners in the fund. And that's why we work so hard every day to further the digital asset ecosystem, further the education to our partners, and do the best that we can to steward your capital. There's a huge opportunity.
Twelve, all right. So, what'd you guys think? That work for you? Tim's idea. Want to bring up Annalise, Ted, Adrian, the creative director, Annalise, our project manager, Ted, our business development ninja. This was the team that made this happen in 6 weeks. And another 48 people that were in here all day yesterday. So thank you very much for coming. I hope the format was something new and unique. We are going to, do we have the QR code? On 3, 2, 1. Roll the QR code.
When the director is on stage and also directing at the same time, that's what this looks like.
And the QR, anyways. So yeah, we wanted to do something a little different. We had Mr. Michael Saylor, of course, want to join us, which helps immeasurably. Early bird tickets for January. I'm going to say January 21st, but it probably won't be. It'll most likely be here in New York. But if you want to get an early bird ticket, scan that right now, and that'll be incredibly cheap compared to what they will go up to at the last minute.
We would love for it to be January 21st. It will most likely be the 22nd and 23rd. We'll have one day of one-on-one matchmaking, networking, and a day of a conference. So you can get your ticket now, and we'll have details out shortly.
Continue to listen to Tim's podcast on the Tim Kotzman YouTube channel, and follow us on X. Thank you all very much for coming, for spending your money. Tim had this idea of escalating the ticket prices, and you guys kept paying it. So
it's a free market, Ed. It's a free market.
Yep. And if you do need a creative director to do your videos, your commercials, Adrian, that's what his company does. And we look forward to seeing you in January. With that, we will introduce the final panel, which is basically, I can't remember the title, but it's basically
Bitcoin Treasury Companies, the rise of a new class of financial institutions. Please welcome to the stage Mark Moss, Brian Dixon, and Michael Saylor.
Hard stop at 5:30. They will turn the lights off.
Gentlemen, so we'll try to keep this tight and maybe leave time for a few questions at the end before they turn off the lights, kick us all out. When somebody asks you what's a treasury company, well, a treasury company is a corporation that's capitalized on digital capital that issues securities against the underlying digital capital. Why is it it is a new class of finance company, a new type of company. There's insurance companies, there's banks, there are fund companies, there's finance companies, there are REIT, real estate development companies. There's plenty of types of companies and there's operating companies. Why is a treasury company new and different? It's because the Investment Company Act of 1940 prohibited publicly traded companies from capitalizing or leveraging on securities portfolios. That's why there's never been a Mag 7 treasury company, there's never been an S&P treasury company. You can leverage and you can 100%, this is why Warren Buffett has to sell Apple stock. This is why the Berkshire Hathaway portfolio of securities stays below 40% of its liquid assets. That's why he has so much treasury bills. The Investment Company Act created a carve-out for sovereign debt of the United States government. And so even though those are technically securities, they're deemed to be not securities or commodities for the purposes of the SEC 40 Act. That being the case, for any of these strategies to work, you have to go to 100% or more leverage. If you're only holding 10% of something, it's not enough exposure to make it a type of company. So the treasury company was born with the arrival of digital commodities, and specifically Bitcoin, the digital scarcity. You could lever a public company on gold, but gold is not exciting enough. 99% of investors don't think gold is a good long-term asset. It kind of tries to keep up with the S&P, but as a practical matter, to break through a new thing, it needs to be an order of magnitude better. And so because Bitcoin has been able to outperform the S&P by 3 or 4x, it's enough better that you could justify taking the risk on a brand new revolutionary thing. So what you see is now the rise of 180 public companies capitalized on Bitcoin. You also see an explosion of digital asset treasury companies based on Ethereum and Solana. Why? Because they're de facto being deemed commodities by the current administration. So they have de facto commodity status. If any other token were deemed a security, you couldn't pursue this strategy. That means all told, you got about 250 companies that are digital asset treasuries. And and you would say, well, can I do it with gold? Not really. Gold's too slow, too boring. Real estate, you've got REITs, but real estate underperforms the S&P. Soybeans, oil, people tried all sorts of things, but at the end of the day, if you've got a digital commodity which outperforms the S&P, you have enough performance to create a treasury company. Now the issue is, how will the industry develop? And we're in year 1 of this thing being birthed. And of course, 90% of the investors don't even believe it's a category. They don't even recognize it. 1% are enthusiastic about it. 2 or 3% are stumbling around. And with that as a preamble, I guess, Mark, what are your thoughts? What do you think is going to happen in this industry? And what are your opinions of treasury companies in general?
Well, I'm generally favorable of them. But as far as what I think is going to happen, I mean, we're trying to think into the future. And I think, unless you're Michael Saylor and you've studied the history of technology as well as read the fantasy books, it's hard for most of us to see the future. But when we have a new asset like Bitcoin, that's the digitization of capital, and it moves at the speed of capital, we have a new set of building blocks to build new things. And so we can kind of think about the financial system as we have today and then how this transforms it. And so we can kind of think about maybe what doesn't survive in the financial system and maybe what moves forward in the financial system. And so if you think about the $700 trillion sitting in the financial system that's earning somewhere between 0 to 8% right now today. But we can take this digitization of capital and then we can slice it up, as Saylor showed us, with different types of preferreds and different types of instruments that can provide something. As he said, typically Treasuries has sat in that spot. We have 250 million people in the developed world right now, retirees, depending on some source of income. Again, $700 trillion of capital sitting on that income. And it needs better income, better yield, something safer than bonds. And so this new asset, this new digital asset that moves faster, that gives us this better CAGR, that gives us that room to then leverage into the S&P 500 and leverage into the debt and credit markets, it allows us to do these things. So I think some of the types of new financial institutions that we see kind of getting built on top of this are sort of interesting. Like, obviously, we're still going to have creators creating more than they consume, and there's going to need to be savings. So there's going to be financial institutions that will handle security, that will handle custody, and things like that. I think we'll always have a need for credit. So we'll have financial institutions that are still providing credit. People are still going to need to buy houses. They're still going to buy cars. We're still have entrepreneurs that need capital for businesses as well as scaling businesses. It'll be, as Mises would call it, commodity credit versus circulating credit. We'll be issuing credit off of savings. It's not just conjuring out of thin air. I think insurance is going to be a very interesting financial model in the future, specifically with Bitcoin. Warren Buffett showed us the power of having a float with insurance companies. So imagine if you're good at adjusting risk. If you're good at writing risk, you get the power of the float, put that into a Bitcoin standard. I think that's pretty powerful. I think, obviously, I think about liquidity. So Bitcoin is, of course, peer-to-peer electronic cash. And so, like, I could peer-to-peer electronic cash with any of you here, and that's great. But if you're Walmart with 10,000 stores globally doing $680 billion, peer-to-peer electronic cash isn't really working. So you're still going to need payment providers. You're still going to need to pay hundreds of thousands of employees. You need payroll companies. So a lot of financial institutions in that space. And then ultimately, the last category, I still see, I think, a lot of improvement. I think where these treasury companies move into this financial future is security. So we're still going to need, companies will still need to raise money, we'll still need to bundle the money, we'll still need price discovery in the markets and things like that. But the difference is that we've had, this equity security market for 430 years built on fiat. And I think it all just transitions over to Bitcoin, moves faster, it's stronger, more transparent. And so really what happens is the Wall Street, the financial institutions are still there, but the Wall Street scaffolding that we have today is mostly collapsed. Things move faster, more transparent, and on a Bitcoin standard.
Yeah, from my perspective, one of the things I find very interesting is 13 years ago when I got involved in Bitcoin, there was a concept that I discovered that really inverted my thinking around the opportunity for investing and changed my mind around it. Historically, you have the protocol layer and the application layer. And the protocol layer would be things like IP, Internet Protocol, or HTTP, or SMT for Simple Mail Transfer Protocol. And you could never buy a chunk of that to monetize off its growth and adoption and value over time. You had to invest at the application layer, which was businesses like AOL and Yahoo and Google that had these different providers, and you monetized off that. So all the value accretion occurred at the application layer because we didn't have the chance to buy in at the protocol layer. Then, when blockchain and Bitcoin was developed, that investing scheme got inverted, right? We can now buy a chunk of that protocol and we can own it and hold it. And if you look at the return profile over time versus owning the protocol layer compared to owning the applications built on top, the protocol layer has significantly outperformed the applications. Now with Bitcoin treasury companies, what we're seeing is a merging of both of those things together. We're getting exposure to own the protocol layer with the bridge that is the treasury company itself. And I think that's a phenomenally interesting idea for where the future is going to go for these financial institutions. And the outperformance opportunities with that, I don't think we've even seen the beginning of where that can go. And if we think about it from a systems perspective, when you have an old failing system, i.e. our traditional fiat banking system that exists today, these systems are not going to just naturally adopt Bitcoin because it's going to disrupt their own business models. So what happens? You have to build the brand new system on your own so it disrupts those models, and then they are forced to adopt it over time. And that's what we're seeing with Bitcoin treasury companies. And I think as we think from a future-facing perspective, and I agree with everything that you noted about the different types of products that can come into it, but what about the markets that don't even exist yet and how Bitcoin treasury companies can engage with them? So let's walk through an example. Think of artificial intelligence virtual agents, right? Every time we question Grok or Perplexity or ChatGPT, there is an electricity and computational expense that's required to query that for it to process the data and information that comes back to us, right? Eventually, we will have a virtual economy of trillions and trillions of artificial intelligent bots doing things that we aren't even aware that they're doing, right? And there's going to be a computational and electricity expense with those bots doing that labor. Well, they can't set up a Bank of America account. What can they accept? They can accept something like Bitcoin. So what if maybe the future of Bitcoin treasury companies, one of the products and services they provide is to serve the ever-growing adoption of the artificial intelligence market by providing financial services and products in an internet-native way. So I think that's an interesting thing to think about in future as the years to come.
I think it's interesting to think Bitcoin is the protocol. And when I look at it, I think that's my risk. If you're a Bitcoin maximalist, that's your risk-free rate. And so I think it's like 29% a year for the next 20 years. That's if you want to buy the protocol. And if I want to invest in anything else, it's got to outperform that by a large margin. It's got to, it's got to be like 40% a year or 50% a year. And so the Bitcoin treasury companies create things. Security is an application on the protocol. IBIT is an application on the protocol. MSTR, STRC, their $1 billion, $10 billion, $100 billion application of the protocol. They move. People kept waiting for it. Well, how do we get a circular economy, and how do we get people to spend Bitcoin? Well, $3, $4, $5 billion a day trades in 6 hours in the layer 3, application, like on MSTR, or $4 billion or $3 to $4 billion in IBIT trade every 6 hours. So those the protocol is being fed by the applications, and I think that'll continue, and people are going to invent them at a ferocious rate. I think since this is the last the session of the day, I'd like to throw open the floor to questions for all of you. So maybe you guys could go around, and anybody who's got a question for any of us about Bitcoin treasury companies or approaches or what they think will happen, feel free to throw it out, because I think we can make this interactive. I think for sure, there's the question of which will be the first bank that plugs in Bitcoin, what will be the first insurance company, the first reinsurance company, what happens when you plug this into a company like an Apple or a Microsoft or a tech company, what happens when a government prints its own currency to buy Bitcoin, all of these companies, what happens when a city does it or a state does it. The way you're early is you haven't had a city sell a bond to buy Bitcoin. You haven't had a state finance with Bitcoin. You haven't had a country do it yet. You've had a few companies and people. We have yet to get a positive article in the Wall Street Journal after 5 years. Like I'm going to declare success when we get one article that's positive. Like Bloomberg said some positive things. But we're still very early, and the next 10 years will be, again, it's like the gold rush, but imagine the petrochemical industry in 1870. And and you're looking at plexiglass today and nylon and polyester and the like and lycra, and what were they thinking in 1870, right? Who's got the first question? Go ahead.
I've got the first question here. So, Michael, this might be a tad premature and self-serving in some sense, but if you are president in 28, I'm lobbying for OMB director, and I had seen David Foley here. I put a bug in Larry Lepard's ear as well, that the broader implications. And I joke, but for those of us who number go up is nice, but we got here through kind of being pissed off at the the current system and the GFC and everything we've seen. So, maybe we did come here for number go up, but, we're here for the revolution now. So it was more just nice to, be here and be hanging with our people today. So I guess there wasn't even a question there.
Thanks.
Thank you.
That was an easy one.
Next.
Yeah, some of the recurring themes today have been kind of staying in your lane, keeping it simple and transparent for your investors, but also maintaining that leverage. In the example you used, Michael, was Standard Oil was producing oil and had a runway before the car was invented, and that really spurred that next use case for the oil products. Well, in your mind, what is that next use case going to look like that transforms the marketplace as we know it?
I think the initial use case is digital equity, right? Equity levered equity on Bitcoin itself, and people are getting that. And Metaplanet just sold $1.4 billion of it last week, so that's kind of proof that there's a market there. The next use case is credit, and we saw convertible bond credit. That we became the largest convertible bond issuer in the world. And I would say after my last 20 deals or 20 credit deals, if I was giving advice to a Bitcoin treasury company, I would say you ought to sell an equity which is amplified Bitcoin, try to get to 2x Bitcoin, and you ought to sell a simple credit instrument like a preferred that's a treasury preferred stock, variable yield on top of a currency. Pay 400 basis points more than the Swiss franc risk-free rate, or pay 400 basis points more than the risk-free rate in Europe, or 400 basis points more than the JPY yen rate, or 400 basis points more than SOFR. Go do that. Strip the volatility, strip the duration, strip the delta out of the instrument, and just, if there's anything that equates to gasoline, kerosene, like pure, highly refined crude oil, the equivalent of kerosene in our industry, I think, is pure credit spread, no risk. Right? Just 500 basis points, no vol, no risk. It's like when I asked everybody who's got a bank account, everybody, do you want your bank account to pay you 10% interest? Everybody. So a perfect, it's not the only model. There's 1,000 models. And so I don't want you to think this is the only one, but like I would literally say to someone like a Metaplanet, sell Metaplanet as 2, 3, 4x Bitcoin, sell Meta Yield as 6% in yen. That can become a $1 trillion company, and you don't need any other idea because you're just fixing the entire money market in that currency frame of reference. So I think if you want to be very simple, it's just extract the pure yield, throw away the credit risk and the volatility if you can pull it off. And that's the last thing I did after 5 years of doing other stuff. So I'm just kind of saying you can skip my life. Like the negative of starting now is, oh, you're later than us. The positive starting now is you get to skip my first 4 years of mistakes. And I just gave you the answer. If I could fast forward and do again, I'd be like, I'd skip everything. I would sell Stretch. I would keep the equity. And I would focus upon selling that treasury preferred stock to every insurance company, every credit investor, every retail investor, plug it into every bank. Now again, I can't tell you I'm sure it works forever in 10 years. If it did work and we're back here, then I could say it works. Right now, this is my opinion. Next. Yeah.
Hi there. First of all, a massive thank you to everyone in the room for such a great vibe and for such enriching conversations. The question I have for the panel is, as I've been trying to orange pill people and the family office I'm responsible for, I think one question that I find very hard to answer is, Stretch, Strike, they're all great, but in terms of payment of dividends, what about operating cash flows? How sustainable is it? Will the Bitcoin will need to be sold at some point? So how would you advise me to address that question bang on so that it's a no-brainer?
Yeah, I think the answer is the Treasury company is sitting on a mountain of hard assets. In a rational market, it'll just sell the equity to pay the dividend. In an irrational market where the equity decouples from the Bitcoin fundamentals, you're going to sell the Bitcoin volatility, or you're going to engage in derivatives trading in order to extract the yield directly from the Bitcoin. If necessary, you're probably going to sell a future, right? You're going to sell an out-of-the-money call option against the Bitcoin, or you're going to enter into a basis trade. And in the worst case, you're just going to sell the underlying Bitcoin itself, because as long as Bitcoin is growing at a multiple of the underlying dividend, you always have that as a final option. By the way, the reason that you don't immediately go there is the most tax-efficient thing you can do is sell the equity. When you sell the equity, there's no tax. We could generate billions of dollars by selling derivatives on the Bitcoin. We generate a taxable event, and so we don't do it because it's just not as efficient. and it doesn't expand the capital structure of the company. But if somebody says, well, how are they going to pay the dividend? The answer is you're going to sell the equity. Well, if you can't sell the equity, then the answer is we're going to sell derivatives on the underlying Bitcoin itself. And that market has got, there's $60 billion of liquidity in Bitcoin. So if you can't sell the Bitcoin derivatives, which is a very healthy market, you're going to sell the Bitcoin into the market.
Oh, go ahead, Mark. I was going to say, if I could just add on to that for a second, I would also just sort of challenge you here, Saylor, talking earlier just now about 10 years. I'll be back in 10 years. I'll tell you if it worked. Earlier today, he was talking about, I can't tell you about 15, 25 years. I'll tell you about 10 years. So right now, we have this massive disruption with AI, and all the business models as we see them today are being disrupted. And so the traditional model is we'll pay you back with future cash flows. Okay, what future cash flows? In 10 years, you're still going to have future cash flows versus sitting on the assets. So, right, most people are paying you back on a future, a promise, a future that'll have those cash flows with no guarantee because you have no assets versus actually having the asset base today. He's given you lots of other ways he can pay the dividend. Worst case scenario, we don't come to that, but worst case scenario, you have the asset. And so I think it's a different way that it's being done today because we have this new asset, right, financial capital. But that's how I would sort of address that. One thing I was going to layer on too, because I meet with family offices all the time, and one of the things that helps, I think, them understand when you're advising them is not only are you walking through the mechanics of what Michael and Mark just laid out from like a cash flow perspective, a dividend perspective, but you also have to get them to understand the value of network effects, right? And so when you look at things like Metcalfe's law, where you take the number of users in the network and you square it and you multiply it by the transactional value flowing through the network, and you extrapolate that over time, you're seeing that you're going to have this asset that you're going to hold on to as the adoption rate continues to grow that is going to astronomically outperform basically anything else that we're seeing in the world right now. And so when you really help people wrap their head around from a family office perspective, not only is it a sustainable business from what they're doing in the public markets, but the very base foundation of their business, which is the acquisition and reutilization of Bitcoin and how that gets adopted and the network grows over time with an exponential growth curve, that's just going to impact the stock as well. And so I think that helps them kind of wrap their head around it. Not only is this cash flowing business doing XYZ with these different products that are Bitcoin denominated, it's moving that network adoption along its path as well.
Mark, Brian, pretend he's not sitting next to you. What's something that you think Michael Saylor and Strategy should do or you would like to see them do? Pretend he's not there.
Here's my opinion. I think that over time, when you look at things, I think that we're basically creating a Bitcoin-denominated financial institutions for the future, right? This is going to become, in my opinion, the new type of central banking system, right? You're going to have a massive one in each jurisdiction. They're going to be the largest, and you'll have smaller derivative branches that'll expand over time. So I think the natural progression, if that thesis ultimately plays out, is what does a bank offer today? If we're going to create a global monetary system that's Bitcoin denominated, you have to be able to issue the exact same kinds of products largely that we see today in the markets for consumers and institutional investors to use that we use with traditional finance. So we're going to see lending and mortgages and things of that nature over time. But you have to have enough Bitcoin in stockpile to be able to do that, to make that effective. And I think that's step one. That's what we're going through right now and we're seeing over the last couple years is the aggregation of the Bitcoin, holding it, and then the innovations in financial products that actually merge with the traditional financial products in the existing banking ecosystem is what's going to evolve.
Ed, I'll answer that question, but I'm going to flip it upside down. And it's rather than be critical and tell him what he should do better, I'm going to emphasize a couple points that I think everybody should take note of. And so, one, I would say you hear him over and over and over being laser focused, single-minded focused. And the problem that everybody has is doing too many things. In a private conversation in Prague, you told Alexander, you'll probably reach $1 billion, $100 billion, $1 trillion, but you probably won't because you'll probably try to be a conglomerate and you'll take your eye off the ball. And so this single-minded focus, and most of us try to do too many things, and so I think about that. I would also say, while certainly we haven't seen mainstream media be very favorable, there's also a massive misunderstanding. But to his point, not only has he gone out and shown the model, he's out there constantly trying to educate the world, changing the name of the company, teaching the strategy to everybody for us to follow, cooperation, collaboration, but also education as well. And so I would say rather than trying to tell him what he should do different, I think we should all take note of those things. And so whether you have a background in insurance like Jeff, and maybe insurance is your thing, but for each of us to follow what that thing is that we have, be single-minded focus, educate, collaborate along the way.
Michael, you got 2 minutes. Close it, Michael.
The question is, what would you do better? No, I'm joking.
I think I've talked enough. Next question.
Hi, thank you, Michael, and everyone here today. What an incredible day of knowledge and wisdom and passion as well. I'm a part of the team that is recently launching 21millionstories.com, and we're launching Hollywood-level TV film production for the Bitcoin Treasury space in particular. And I wanted to ask, when you envision the world that you imagine 10 years from now, what kind of TV film content, education, or entertainment do you imagine needs to be out in the world?
It'll be digital, it'll be interactive, it'll probably be AI driven, and it'll be personalized. You know, at some point, I think that all of our education institutions go away and you get like an AI professor that teaches you whatever you want that's better than every professor that ever lived. In fact, it's a combination of every professor that ever lived. And I think at some point the movie becomes a walk-through world. And at some point, all your entertainment becomes personalized. And we can see it happening right now, but I think a decade from now, we'll be blurring the distinction between personalized entertainment and personalized education, which is a good thing.
Thank you, Michael. Thank you, everyone. We will see you in January, and we will see you at PubKey in about an hour. Thank you for coming.
Good night. Thank you.
We saved it.
Yeah, we're going to stop by.
Any insider info? Yeah, buy it 3 years ago when it was $3 grand. Exactly.